A Belgian biotech company for up to $1 billion. Does this help them kind of diversify, Guy, at a time when we know AstraZeneca is, of course, a very heavily watched stock when it comes to the FTSE 100?
Absolutely, one of the key stocks on the FTSE 100 on that index. Let's talk about all of the indexes, though, and give you some numbers. It is Monday morning. How are we starting? As Liz has indicated, fairly flat, but it's time for the opening trade. Is what we're looking at in terms of the flat futures going to translate into actual numbers on our screens? FTSE 100, as you can see, yep, there we go, fairly flat, absolutely nothing there. Lizzie talks about China being a nothing burger. The index indications coming out of Europe already this morning tell a similar story. We climb a little bit, we're up by 0.2%. We have to think about kind of a number of things as we look forward into this week, and it's so uncertain as to which one will provide the volatility. Could be the stock stories, could be the Fed, it could be the geopolitics, it could be what comes out of China. So much to think about in terms of what is happening here. Politics in Europe, maybe something to throw into the mix as well. But this morning, Lizzie, it's a cautious start. So what are we seeing, guys, in terms of the sector story?
Well, if you break it down, you've got about just over half in positive territory. Basic resources leading the gain, so that's up 0.8%. Healthcare just behind, up 0.4%. And if we just dig into some of those names, AstraZeneca, as you flagged, Critty, is up 0.7%. We did have this news that it signed a deal to buy the cell therapy specialist ESO Biotech for up to $1 billion. Basic resources, harking back to this China story. And if we zoom into the luxury picture, actually, you've got a lot of the names in negative territory this morning. So LVMH down 0.2%, Hermes down 0.5%. Burberry, though, up 0.9%. So a mixed bag off a mixed bag press conference.
Absolutely, but right off out of the gate, if we are looking for some sort of China impulse, you kind of hinted at this there as well. Rio Tinto, Glencore, the miners very much in focus for the FTSE 100, and I'm still waiting to see where that German optimism is. Maybe we'll get that in about 2 minutes' time, Guy. But at the moment, that kind of outperformance, the marginal outperformance, I should emphasize, that you saw in the futures picture, not evident at the open.
Absolutely. I think the German positivity comes in the form of what we've seen so far year to date in terms of German stocks. The huge pricing at the moment. If you look at the DAX, it's up by 15%. Comparing that with the US markets in euro terms, currency adjusted, the S&P is down. If you price it in euros, it's down by nearly 9% at the moment. So that spread is just enormous. Can it continue?
Can actually catch up, but do valuations even matter is another piece of this equation. I'm also waiting for the tech story to play out a little bit as well. We're going to get the NVIDIA conference later this week. Is there perhaps a buy the rumor, sell the dip element that comes into the rest of the week, or are we still waiting to hop in?
Yeah, I will say the shipping stocks are moving already, and you flagged this, Critty. You've got Muller-Maersk up 2%, Kuehne Nagel up 1.1%, DSV up 0.7%, and all this coming back to the US vowing to strike more over those Red Sea attacks on the by the Houthi rebels on those civilian and military ships.
I just think there's huge amounts of uncertainty here.
Yeah.
And the potential for this to escalate is definitely there. You've got the Houthis being hit, but the Houthis vowing to hit more ships.
Yeah.
And it's uncertain. If you're a big shipper, do you want to send big tankers, big container ships through the Red Sea at the moment?
But of course, for them, it comes back to Gaza and Israel blocking the aid to Gaza. So it ties into an even bigger geopolitical story for the Houthis.
And of course, the Iranian impulse to respond to all of that. So the key takeaway here is caution, it's volatility. So how do you play it when no one knows what's happening next? Joining us now to perhaps answer that question, Vincent Mortier, CIO over at Amundi, joining us out of Paris. Vincent, a pleasure to have you on the program. Look, we were just talking there about what these vehicles of volatility actually look like when it comes to a world of our favorite word, uncertainty. Vincent, how do you play this market?
Yeah, good morning. I'm glad to be here. So indeed, the market has been very noisy. Many things happening every day. So I think we need to distinguish between the noise and the long-term trends and the fair valuation. So it is very fast and furious in a way. There has been huge repricings, huge volumes, but nevertheless there are some very important trends at play that we need to consider. And so to distinguish between very short-term positioning and more, I would say, strategic valuation and investment. And this is where, I mean, volatility is also a great source of opportunity, in particular for active managers. So I expect more volatility. It used to be on rates, now it's more on equities, which is quite more normal, I would say. So volatility is here to stay, and I suspect it will bring many opportunities for people who are able to have some cash to be deployed and not to jump on the first news, but to have some fundamental valuation approaches as well.
Well, Vincent, do the fundamental valuation kind of metrics even matter at this moment? We heard over the weekend Scott Bessent, of course, the U.S. Treasury Secretary, saying corrections are normal. They're even healthy. Would you agree with that this maybe jitters we're feeling in the market is actually normal and healthy?
Yes, and I suspect it's only the start as regards the US, because of course it has started to correct, but I mean US equities are still expensive at large. In particular, if you factor in new information, and it's fair to say that the US economy is starting to slow down. There are more and more signs of weaknesses. So do you really want to buy 22 around times earnings next year for the US market when EPS growth is starting to decelerate and will be a single digit or even low single digit? And when there are new talks of potential recession in the US, it's not our call scenario, but it is something that starts to be factored in. So valuation will matter because earning growth will be less favorable than before. On Europe, we had a big catch-up from low positioning. So now I think we reached a kind of fair level. So what next is not totally obvious, as you mentioned before. What next catalyst for the European market? And so in terms of fundamental, I mean, in our mind, US is still expensive given the news flow. Asia is still attractive, and Europe is fair.
Okay, so Europe's still fair value. Vincent, you say we've got to wait, that there are going to be opportunities for those that are sitting on the sidelines. What signals are you looking for to get back into this market? Is it just simply the valuation metrics that you've just been discussing in terms of kind of what's overvalued, what's fair value, what's undervalued? What are you looking for, and how long should we be prepared to wait?
Yeah, I'm looking for two things. First, to get more clarity on where the global economy and the US economy in particular will go. Today it's very uncertain, so as long as there will be uncertainty around, it's better to wait a little bit to have more clarity on growth, inflation, and geopolitics. Second, you mentioned valuation. It's a key, of course, a key metric. I don't believe we are yet at a point where valuations are cheap. So if you have the luxury not to be invested or to wait a little bit, there will be opportunities later on. We are only in March, so the year will be long. You mentioned metrics for the start of the year, which is quite extreme in terms of gap of performances. I suspect it will continue to be like this for quite some time.
How much downside, if you look at your tail risk scenarios, how much downside could we potentially see for US stocks? You talk about the fact that they're still expensive. Markets tend to overshoot and go through fair value and go to extremes. Is that the scenario we're looking at here? And what is an extreme scenario for you in terms of what US indices could be showing us?
I mean, today we are around 20 times earnings. I think in the given what we expect from the earnings and the economy, 18 times will be more adequate. So if you make the math between 22 and 18 times, all things being equal, the US market can drop by 20% easily. So it is a kind of drop I would expect before going back overweight US equities. I think today is too early, and at 22 times earnings is too expensive in my mind.
Vincent, good morning. Lizzie here. You mentioned Asia earlier. We had, of course, the Chinese data beating expectations this morning. We've had the Chinese press conference on more stimulus for consumers. Do you buy the idea of a Xi put if the idea of a Trump put seems to be fading? How do you balance the China story and the Europe story when it comes to investing?
Yeah, indeed. China has put together a plan which was expected in a way, a credible plan to boost consumption. It was the missing part in their strategy. I think China has a luxury to have time and have some ammunition also to support the economy. And I strongly believe that Xi is under big pressure to maintain economic growth, which is around 5%, because it is a condition for the stability of the country. And so as a result, I think he will do whatever it takes, to paraphrase now a famous sentence, he will do whatever it takes to boost local economy, local consumption, to incentivize people to spend their huge spendings, because China is a huge spender, is a huge savers. And so as a result, I think there is still some upside to be captured in the Chinese market, because of this tailwind, which is quite powerful. And again, I mean, they have time and ammunition to make it happen. It is maybe a difference to the US.
Yeah. The other thing, Vincent, that interested me over the weekend was this report that US officials are threatening you may find the missiles stop working. Now, I feel like that is really serious when it comes to how European defence spending, increased as it's expected to be, will be spent. There used to be lots of scepticism about whether that money will be going to American defence stocks. Does it actually mean that European governments are forced to buy European if they can't rely necessarily on the US?
No, that's a very strategic and important question. So indeed, it is an interest of Europe long-term to be self-sufficient in terms of military production. It is not yet the case. It takes many time to build credible capabilities. So a few countries are already quite self-sufficient in a way. France is a good example. But as you said, today, around two-thirds of the military spending from Europe is going outside the Europe, in particular to the US. That's a big sovereignty issue. So I think there will be some big pushes to re-internalize in a way this spending towards European makers. But it will take years and years because, again, you don't build such capabilities overnight. So it's a transition to be made. I think the willingness of European leaders to make it happen is strong. So I suspect there will be a support in this space to be more self-sufficient. But again, it will take many, many years.
Vincent, what kind of fiscal multiplier are you modeling out? What kind of expectation is there that's tied to this outperformance? What's the number? What's the figure when it comes to that fiscal multiplier?
Well, it depends on each and every project. If you take Germany, the infrastructure spending plan, which is very important as well. Everybody's talking about defense, but the infrastructure plan is also very important. Will have a high multiplier, so well above 1. So that can be a game changer for Europe because it will spread in terms of impact through Europe. So the infrastructure plan is the one really to monitor. The defense one, the multiplier today as we speak is way below 1 because of this foreign non-European spending. So this is why it's very important that Europe is able to build some capabilities to take over and to regain sovereignty in a way in this space. So we expect a much higher multiplier here, but long term, not short term.
Vincent, will you still be buying European defence stocks after the huge surge we've seen in their valuations?
it has been brutal in terms of price action. So now I would say these stocks are priced for not for perfection, but for something very big to happen. The issue is that yes, there will be more spending. Yes, there will be more business. Question mark is at which margin, and you know, government are careful spenders. So I mean, will that translate into much higher profits? It remains to be seen, because there will be tender offers, there will be competition. So maybe the market has been a little bit ahead of itself here for some reasons, but currently valuations are a little bit demanding, maybe too demanding. So I would wait a little bit to have a pullback in order to reposition aggressively on this sector.
Yeah, we're seeing some of that this morning. Vincent, thank you very much indeed. Always appreciate your time. Vincent Moutier, the CIO, joining us from Amundi. Great to see him. Let's talk about the Core 6 and what we're watching here in Europe this morning. This is what the centre of gravity looks like in Europe. As you can see, there's a lot of red out there this morning, which I think is really interesting. In terms of the nuance, actually, I'm not sure there is that much. We're down kind of 0.75% pretty much across the board on a range of stocks this morning. Novo's popping higher. In fact, the pharma sector is firmly in focus this morning. But let's turn our attention to what is happening in the defence space. Kinetic has seen a huge rise recently. That is unwinding this morning. Why? Let's find out with Joe Easton.
So it is really playing into that theme you were just discussing a moment ago, guys, with these defence stocks having seen this big rise in valuations. Just a little bit of a warning from Kinetic in London has sent that stock sharply lower. They are talking about weaker than expected margins versus analyst expectations. It does seem to be the reason. This stock getting hit hard, down 15%, the worst performer. Also hearing it's feeding through into some of the UK defence firms as well. Rolls-Royce, potentially BAE Systems, a couple of those a little bit underperforming following that warning from Kinetic in London. Then in terms of the best performer today, Phoenix getting a big boost. The UK listed insurance and asset manager seeing some good flows and also benefiting from the insurance division as well. So really a strong report out of that one today, the best performer across the stocks 600. Then in terms of those shipping stocks, we do have our eye on those following the US vowing to strike the Houthi rebels if they don't stop with their attacks on ships in the Red Sea, seeing a little bit of a move higher. In these shares, potentially, we're going to be looking at the shipping rates, see if that feeds through into the market. But one part of the market that's seeing no relief is the UK supermarkets hit once again. Remember, we did see Tesco down another 4% today. Remember, that was down around 8 or 9% on Friday. It was the biggest drop in around 4 years. Sainsbury, I think, was the biggest drop in 5 years on Friday, and we're coming down further. This profit warning from Asda seems to be really stirring up the market. I haven't actually seen anything new out today, so it does look like a bit of continuation, even feeding through into M&S and Ocado. So really a rough couple of days for the UK grocery sector. Then in terms of the rating changes, Deutsche Bank cutting its view on a whole bunch of real estate stocks over in Germany. Vonovia, Leg, I believe, was cut, and maybe TAG as well. Those stocks getting a downgrade. They have seen a bit of a re-rating following the positive fiscal news out of Germany, so potentially a valuation call on those. And then back in UK retail, ASOS is an underperform today. This one over at Exane. They say the outlook is bleak for ASOS, the UK listed fashion retailer. They're citing industry data saying they prefer peers like Zalando in Germany. They've got a 200 pence price target. See it fall into 239. Still some downside. ASOS, one of the worst performers as Exane cuts the stock this morning.
All right, Joe Easton from our equities team walking us through some of those early movers. We thank you so much. At the same time as the European Open, the U.S. pre-market has opened as well. Let me take you through some of the stocks we're watching there. It looks like a lot of the focus is going to be on the tech space. When you look at that underperformance story, thank you, you are going to see Lam Research down about 1.3%. The underperformance, it seems to be in that stock. But you're seeing it across, in terms of volume, some of those major sectors. Intel, Broadcom, all taking a bit of beating. Slight outperformance from NVIDIA, but not the kind that we are used to. Where you are maybe seeing a bright spot is in those quantum computing stocks, at least in the pre-market. A significant amount of volume there. Take a look at that, a 12% rise. We're only a couple minutes in to the U.S. pre-market, so that's going to be something we're watching, Lizzie.
Well, there's also green on the screen, Critty, when it comes to Brent crude, higher for a second day, up 0.7%. We're going to dive into that next as the risks in the Red Sea grow, and of course China has vowed to boost consumption. We'll get more details on those moves coming up. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back. Monday morning, European stocks are doing absolutely nothing. Not exactly the most exciting start to the day, but take a look at what is happening over in the States. You have a negative session potentially in prospect over there. The situation has got a little bit better, but US futures are still negative. Can we blame Scott Bessent for that move this Monday morning, Chrissy?
Certainly isolated to the U.S. then, not really seeing it in the European session, as you point out. We are seeing quite a bit of movement in one particular sector, though, and that is going to be some of those shipping stocks. Take a look at AP Moller Maersk or Hapag-Lloyd as just 2 examples, higher by almost 1%, respectively. A lot of this coming off of the U.S. Ordering strikes when it comes to the Houthis in Yemen. Crude prices also rising marginally after those attacks were ordered. Let's bring in Bloomberg's energy reporter, Anthony DiPaolo, from Dubai. Anthony, a pleasure to have you on the program. We thank you so much for joining us. Walk us through the impact here when it comes to what we're hearing from the U.S. administration.
Good morning, Kriti. Yeah, as you say, it's marginally higher on oil. That's because we have kind of seen this escalating tension in the Middle East for a long time now, and oil markets really have not reacted to it. But what we're hearing now from the U.S. is that they're going to keep this kind of relentless pressure on the Houthis until they stop attacking vessels in the area around the Red Sea, around the Bab el-Mandeb Strait that passes by Yemen. You know, it's a little bit interesting because we haven't seen many attacks recently because the Houthis did say that they were stopping attacks when there was a ceasefire between the Israelis and in the Gaza war. And that, if I remind you, was the reason why the Houthis said they were starting up these attacks as a protest to that Israeli war in Gaza. Now, with some interruption of some food aid into Gaza, the Houthis did say they would again resume attacks, but we are seeing then the U.S. Forces taking those attacks, taking that first step on those attacks. The U.S. has been present with other countries in a naval effort to protect some of those vessels there. So we are seeing this moving a little bit more to the offensive rather than just the defensive.
Nevertheless, Anthony, here is a potential risk that could move the oil price to the upside, but there's so many dominant forces moving into the downside at the moment. I'm assuming from a price point of view, it's hard to break away from that. You've got weak demand coming out of China. Yeah, it might pick up a little bit. You've got the European story, but in particular, you've got the US story as well. The US economy may be rolling over a little bit. How hard is it to fight that narrative at the moment for those that believe that oil prices should be higher?
Yeah, I mean, it's difficult, Guy, and it's been difficult over the past year because, as I said, we really haven't seen oil break out of a tight range even last year. When you talk about those risks there, one thing that we are hearing out of the U.S. administration is a lot of the word Iran. So they're talking about these attacks on the Houthis as a way to pressure Iran and to tell Iran, which is largely credited with supporting the Houthis, telling Iran that those actions need to stop in the region. So that is a potential area of concern if that does lead to any escalation. So the oil market will be taking a bet whether it is heading in that direction or whether that's another step to push the Iranians back to the table. In terms of weak economy, and in terms of weak demand and potential fallout from a trade war, these are the things that are really holding back the oil market right now, and that traders seem to think are the concrete measures at work here.
Yeah, I mean, Anthony, Lizzie here, good morning. Trump says that he's going to be speaking with Putin tomorrow. There could be something to announce out of those talks, he says. What's likely going to be the impact on the oil price? How much of a move could you see off the back of that?
Yeah, I mean, that really depends on whether that is a positive discussion. So far, we have heard pretty positive noises coming out of the administration when they do speak with the Russians or about the potential for talks there. So if there are some more positive moods coming out of that in terms of moving towards a ceasefire there, you would expect that a ceasefire would have some give and take in terms of potentially some sanctions coming off. So that's really the factor there that would impact that, whether the market sees some of those sanctions that are affecting the Russian oil trade coming off. So far, the general mood seems to be people are seeing less pressure on Russia, a little bit more pressure on Iran, Lizzie.
Okay, Bloomberg's Anthony DiPaolo, we thank you as we keep an eye on those talks tomorrow. And speaking of which, critical minerals mining firm TechMet wants to develop a lithium project in Ukraine. And we're going to speak to the CEO and chairman, Brian Mennell, next. This is Bloomberg.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people,
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
the transactions,
Really a record-breaking moment.
Crypto VC is back.
and the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
This is the opening trade. We're 30 minutes into today's session, and it looks like European equities are just about waking up. The Stock 600 up 0.4%. You're seeing a bit more action when it comes to energy. That sector up more than 1% this morning, off the back of oil being up, perhaps, as the US vows unrelenting strikes on the Houthis. That also is boosting the basic. We also have basic resources up on the same reason, and that sector is up 0.9% this morning. But that also comes back to the China story. So a lot to factor in this morning. But we can take a deeper look, Kriti, into the resources story when it comes to Ukraine.
Absolutely, they're very much in focus. Let's go in there next. Irish mining company TechMet, which is partly owned by the U.S. International Development Finance Corporation, planning to develop a lithium deposit in Ukraine. This all, of course, comes as the U.S. and Ukraine seek to finalize a resource deal. I'm pleased to say TechMet's chairman and CEO, Brian Manell, joins us now around the table. Pleasure to have you. Thank you so much for joining us around the table. Brian, walk us through the controversy here. I'll start with a very simple question. Are there critical minerals in Ukraine?
Ukraine does have a lot of potential for substantial production of a number of key critical minerals. There is existing production of certain metals and a lot of projects that have been subject to historical Soviet-era exploration that are likely to be commercially developable.
When it comes to that commercial development, though, what do you need to see to take that from potential to actuality?
Projects that have historical data need to be subject to further confirmatory drilling and feasibility study work before one can define the economics and justify investment in substantial commercial production.
We spoke to a guest last week, Amanda Van Dyke from Critical Minerals Hub here in London, who said actually the Soviet maps aren't good enough to really, in a modern age, take a viable view of whether or not there are the required critical minerals to make it economically possible. How good are these Soviet maps?
The Soviet exploration work geologists were generally of a very high standard. So while the data that we have from Soviet-era exploration is not easily translatable into the systems that we deploy today to define economic potential, and therefore you need to do some confirmatory work, the data is generally of a high standard.
She also said that generally in geology, what's there is probably there in greater abundance, i.e. what we've already discovered probably is there, and we can do more of it. What is there right now that is being explored that we should therefore assume that the geology tells us there'll be more of that could be taken advantage going forward?
There's some interesting lithium projects, one of which we've been engaged with as TechMet over the last year and a half in discussions with the Ukrainian government to prepare for the tendering and acquisition and development of that assets, and there are a couple of others. There is significant potential rare earth metal resources. There are existing production that has potential to be considerably bigger and more important in titanium, uranium. There's some graphite opportunities. So it is relatively diverse and potentially very significant in global critical mineral supply chain security terms.
So potentially very significant, but are we talking $500 billion worth of potential opportunity?
Very difficult to put numbers on it and very difficult to put timeframes on it. To an extent, the scale of development and hence the value that can be derived for the Ukrainian Natural Resources Trust that is being proposed in this Ukrainian-US deal is dependent on the scale of investment in exploration, feasibility study, development, and ultimately production of new projects. And that will follow the implementation of this deal.
Okay. I'm also interested to see, and tell me if I've got this wrong, but your investment partner is Ronald Lauder, the cosmetics heir, who reportedly planted the idea of buying Greenland in President Donald Trump's mind. What sort of opportunity do you see there for TechMet?
Greenland, again, is an extremely interesting territory from a geological potential point of view. There are mining operations and there are exploration projects underway, but it's just the beginning of what could turn Greenland over the coming years and decades into a very interesting mining jurisdiction. A lot of it is relatively early stage.
Can we just... 50%, is that the number that the US government holds in you?
Approximately, yes.
Does that give you an advantage? Does that... when we see this deal being sort of put together in Ukraine, is that something that will allow you greater access? The US wants its boots on the ground. Does that include your company?
Clearly, TechMet is in fact unique in as far as having been the recipient of direct US government equity investment, and therefore we have been through the system in the US since we first received US government investment in 2020 and with a number of follow-on investments, and therefore we are somewhat authorized by the system.
Yeah.
And we do see ourselves as a critical minerals supply chain security champion of the US government and of US interests and the interests of US economic allies. So we are a natural participant, whether we have some sort of competitive advantage relative to other people.
Do you think you do having
industry.
a competitive advantage?
We have some degree of preferential access, yes.
Okay.
What about Russia? Would you be wanting to mine there if Putin allowed?
Russia is a very important mining country with massive strategic resources, existing production and technologies. So it is important to the global critical mineral supply chain landscape, particularly vis-a-vis China, who has overwhelming control across global supply of all of these key metals. So Russia's interesting. I have no personal experience of Russia. The normalization of relations with Russia that would allow for investment and development of non-Russian companies with respect to Russian resources is speculative and some way off. So, we would have no interest in at the present time. That may change in the coming years.
You talked about the scale of investment and this potential that you're seeing in Ukraine and in other parts of the world. What scale of investment, what level would entice or create the U.S. government to create security guarantees? Is there a level in mind? Is there an amount of investment or an amount of scale in mind?
The implementation, or at least the mechanisms and structures to implement the deal, which we expect to be signed in the coming days, remain to be defined. And therefore, the mechanisms of stimulating investment in these resources to build scale and hence value for the structure that is envisaged remain speculative. So in the short term, one's talking with respect to individual projects of millions, and in the medium term, you're looking at hundreds of millions or billions in order to commercialize resources that could be developed on a large scale.
Let me ask you this in a different way then. To accelerate your investment, are there security guarantees you've asked the U.S. government and the Trump administration for?
Clearly, to invest in mining is a long-term business and a capital-intensive business. In order to justify large-scale investment in mining, you require comfort with respect to long-term security and stability. So whatever happens in this space will require sustainable peace.
Brian, great to see you. Thanks for stopping by to see us. We're going to watch this carefully over the next few days. Brian Manel, TechMet's Chair and CEO. Coming up, we're going to turn to what is happening in the United States. Scott Besson isn't worried about the stock market slide as he doubles down on President Trump's recent attempts to play down the market reaction to the ongoing tariff and economic policy story. We are going to get the latest with Barclays' chief U.S. economist. He's next. This is Bloomberg.
drive productivity and improve efficiency, Prudential has made significant investments in data analytics and artificial intelligence. Janella Frias plays a key role in integrating these tools into the company's processes.
We always need people. We're in the people business. But more and more, if we really want to provide the right customer experience, fast access to products, it's about technology. Technology has always been an enabler. Now it's a strategic differentiator.
Give me a sense of AI in Prudential. What are you experimenting with?
A few areas. One is around customer experience. In our individual life business, our underwriting process has gone from about 20 days to minutes. In our group business, we have partnered with a number of different fintechs to really improve customer experience, to bring on board capabilities, things like claims management, where we can process a disability claim faster and help people get to work faster.
How much productivity uplift are you getting and will you get?
We're probably getting 10% at this point, but I think over time that is where the value is, and it will then allow us to take our capacity in the form of people and redirect it to more value-add activities.
In a nutshell, it means turning the menial into meaningful. It can be both a huge saver of time, but it can also provide real insight.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Welcome back to the opening trade. About 42 minutes into today's session, seeing green on the screen, a real departure for what you're seeing in the U.S. session, as Guy pointed out earlier. Stocks Europe 600 higher by about 0.5%. The DAX and the CAC outperforming the FTSE 100, not by a massive margin. We'll see if these gains certainly hold, because at the top of everyone's mind is going to be what is the impact from the volatility story out of the United States, the tariff impact, and married, or perhaps in contradiction, to the fiscal spend story out of Germany and elsewhere. That was the conversation over at the Bank of Spain on Friday. I spoke exclusively to the Bank of Spain governor, ECB Governing Council member Jose Luis Escriva, who said that the ECB's central scenario faces big risks in each direction. Take a listen to that conversation.
There will be primarily inflationary in the United States. In the rest of the world, including Europe, will depend very much on second round effects and retaliation policies, which are still very difficult to anticipate. I would say that, if anything, what is coming from these trade policies from the United States is uncertainty, extreme uncertainty in terms of the impact on the various economies. In principle, they are inflationary, but at the same time, they might impact negatively on demand, and confidence, and in this respect, the net effects in terms of a positive supply shock on inflation and a negative shock on activity, and in turn on inflation exerting downward pressure, is very difficult to go ex ante. So I would say, if anything, the situation has given rise to a very complex and unpredictable environment.
It's quite clear that the ECB is still very much on a cutting path with the uncertainty to provide that sort of safety and even just to come out of that restrictive territory. Does that create space for some sort of policy misstep? And I ask this in the context of this time we saw this in the first Trump administration when the trade wars first came about. You saw global central banks obviously the Federal Reserve, but right here in Europe as well, talking about insurance rate cuts. Is that the way to be thinking about the ECB's approach to specifically in response to the trade war out of the U.S.?
We are now far less restrictive than we were a few months ago, because we have already undertaken a significant correction from previous increase in interest rates. So now we are in a situation which is much closer to normal circumstances, and this has to be acknowledged. And from that, I mean, it's, as I said, at this stage, I would say we have to wait to see exactly all these policies or potential policies and second-round effects, how they really materialize in which direction. It's very difficult.
So how
at this stage to commit to anything.
But I think the question here is also whether or not, simply because we've seen elements of this in the past, whether a policy misstep is in the offing simply because of the inflationary risks that you've just outlined. I think the concern here, though, is that perhaps the ECB is heading to neutral too quickly, and if that's a problem. Is it fair to even ask that question, whether the ECB is still heading to neutral? Is that still the goal?
Well, the concept of neutrality is a diffused one. I mean, I wouldn't, in a way, when we examined what should be the appropriate monetary policy stance at every moment, this requires an examination of quite a number of elements of the environment, of the economic environment, and whether this implies or not to be in a neutral, complete neutral position, I think is not the way I would approach it. First, second, what we should convey to the general public is that we normally work under a centralist scenario with the projections over the next 2 or 3 years. This is our anchor for our decisions, but sometimes the centralist scenario is less likely to materialize, or the likelihood to be attached to it is sometimes larger, sometimes is not as large as we would like, because the uncertainty and the risk to the centralist scenario is very significant. I would say this is precisely the current situation in which the risks to the centralist scenario on both directions are larger than normally. And in a way, I know that sometimes it's not easy for us to recognize the limits of our capacity to predict the future, but it's that way. I mean, the environment in which we have to make decisions is that way. And it's honest, I would say, and humble to tell to the public, look, now the situation is particularly complex, and that's the reason we have to really avoid committing ourselves to any future path.
Bank of Spain governor and ECB governing council member as well, Jose Luis Escriva, of course, there, an exclusive conversation with me in Madrid last week. I thought it was fascinating because I kept asking him, and he loves to use the word humble, I kept asking him, if you are dovish, are cuts a response to perhaps tighter financial conditions you're seeing in the markets, aka higher German yields, stronger euro? Does this kind of dovish mentality counteract that? And he kind of started to give way, and he said, well, it really depends on the tariff impact, because they still can't figure out, are tariffs inflationary or a hit to growth? And they can't, that's the math they can't do.
And the problem is that that's such a huge part of the puzzle, isn't it? Dovish, hawkish, it feels like that's a relatively small kind of band within the middle of the overall debate. Yeah, I'm dovish, I'm hawkish, but yeah, we're going to cut by 25 or maybe a little bit less, or maybe we'll kind of hold. The impact of tariffs and everything else just kind of, that's the rest of it. And the amplitude there, the potential swings are just huge.
I think you got to the absolute crux of the issue for the ECB critique in that it is, does the tariff impact offset the fiscal boost when it comes to growth? I think it's interesting in the Spain case that actually if they're increasing defence spending, actually they don't spend that much on defence anyway. Yep. They're only committing to spending 2% of GDP on defence by 2029. So when you talk about that fiscal multiplier effect, it doesn't really mean a lot in this context of Spanish growth.
No, exactly. And Spain has a different issue with housing and immigration. Their issues are actually more similar to that of the United States than otherwise. I should mention that as we were speaking, of course, we heard De Guindos over at the ECB saying something very similar as well, that inflation will meet the ECB 2% target, but he's highlighting potential pain when it comes to things like deficits and debt issuance. So that's another factor to include as well.
Well, we've got a lot of data on the agenda for the week to consider from the ECB's perspective, but also from the Fed's. US retail sales out today, the NVIDIA conference happening as well in California all week. Tomorrow we get German ZEW numbers, Germany voting on the debt brake tomorrow as well. The central bank palooza, BOJ and Fed on Wednesday, the BOE on Thursday and the SNB, and then Friday we cap it all off with Japanese CPI.
Let's talk about the Fed. Let's talk about what's happening in the U.S. economy and try and understand what is happening there. Mark Giannoni, Chief U.S. Economist at Barclays, joining us around the table this morning. You're quite pessimistic on the outlook. You're probably more pessimistic than most. Why?
Well, thanks for having me. We are quite pessimistic because we think that President Trump has been more willing to put in place tariffs than we initially had thought he would. So far, we've seen already tariffs put in place on China. We've seen tariffs put in place on aluminum, on steel, and a lot more is likely to come by April 2nd. The administration has announced so far. And then we think that the discussion is going to continue, and we'll have retaliation that's going to hurt the U.S. economy as well. And even without all of these tariffs going in place, we've seen a surge in trade policy uncertainty. And that's likely to affect households in the near term and longer term. So we expect actually growth to slow meaningfully from what we have seen in the past 3 quarters.
Okay. So the U.S. economy was showing some signs of weakness. Like there weren't a lot of them, but we were beginning to see maybe the cycle beginning to roll over a little bit. Right. It feels like what we're talking about here is pro-cyclical, i.e. they're speeding up the rate that the cycle is going to deteriorate at. We've seen this in the past. I can go back all the way into the kind of late 20s. Obviously, that kind of didn't end particularly well. We've seen other instances of that further on. How much is what Trump is doing turbocharging what we're seeing in terms of the rollover of the U.S. economy? What's the kind of the beta effect, kind of on the economic data?
Yeah, no, I think you're exactly right. I mean, if you look back at where GDP was growing overall over the past year, we are talking about more than 2.5% growth. Q4 was 2.5% growth, and we had several quarters last year where we had over 3% growth. What we are looking at now is a substantial slowing. We are not anticipating any recession, but we could easily see growth go below 1% this year. We are actually expecting 0.7% by the end of this year on a Q4 basis. So a lot of that is due to the tariff, the trade policy uncertainty, as well as restrictions on immigrations.
But what if Trump brings his tax cuts forward? Your outlook is more stagflationary now, but how would that reverse it?
Well, when we talk about the tax cut, a lot of it is the extension of the Trump tax cut from 2017. So even though that's going to add to the projected deficits, because the deficits so far were projected on the assumptions that the Trump tax cuts from 2017 would be reversed. But now we are going to see an extension of this Trump tax cut. Now, for the everyday person on the street in the U.S., it's not going to change their life. So we don't expect much stimulus from that so-called Trump tax cut this year.
And so when it comes to the Fed, you've also changed your outlook there. You're now looking at 2 Fed cuts this year. What happens if inflation stays stubborn and the economy weakens? If the picture is even more stagflationary, what happens to the Fed?
It's very difficult for the Fed. This is a very difficult shock that they are facing. It's a trade-off shock. You have much higher inflation. You have lower growth, likely associated with a rising unemployment rate. So they'll really have to trade off these two. And it's going to come down to the magnitude. Is the inflation going up a lot more than they had anticipated, which we think they will have to revise up their inflation projections, and to what extent do we see a deterioration on the labor market? So on net, we anticipate that the Fed will cut twice. We don't think that they will show in their dot plot 2 cuts this week. They will want to be hawkish. And the main reason for why they want to be hawkish this week, I think, is that if you look back at what we had last Friday, the University of Michigan inflation expectations, that surged to a level we haven't seen since 1993. This got to send chills down the spine at the Fed.
If there is a hawkish impulse at any point from the Federal Reserve in response to tariffs, do the market conditions, do tighter financial conditions do the job for the Fed?
They do to some extent, and we've seen a pickup in long-term yields over the past couple of weeks. We've seen some tightening in financial conditions, if you want, but they had eased before. So financial conditions are doing their dance here in anticipation of what the Fed is going to do, and in response to all the news about tariffs in particular. But we think the Fed now is is on a holding pattern in the near term. It's not going to move rates like this this week. It's not. We think it's unlikely to move them even in May, as it awaits new information that resolves that uncertainty.
Well, speaking of that new information, you talked about a weakening labor market. Are we setting ourselves up for quite a bit of concern come April payrolls report, largely from the release of or the termination, large-scale termination of federal workers? Is that when that data point shows up?
Yeah, so we'll see. We'll expect to see some effect of that in the March print that we'll have early April. We expect some more negative news to happen potentially in the June print and then in the October print. So there are these discrete points in time this year where we're likely to going to see some disruption or some reduced job numbers due to the government employment and DOGE effect. Now, that said, there's a lot of uncertainty as to who is going to be laid off and how many government employees are going to be laid off. And the courts are still working through that at this point, and we'll have to see ultimately.
I got 30 seconds. Retail sales later today. Right. Are we going to start to see the stock market sell-off impacting upper-end spending? Does that in any way show up today? We expect a rebound on the headline retail sales print because we had a very weak January print. Yep. So we expect a little bit of a rebound there, a 0.7% increase. We expect the control group, which is relevant for underlying consumption, to show a modest increase, barely in line with inflation. But that said, we think a lot of that might reflect some front-loading of spending still before the tariffs come in. Great to see you, Mark. Thanks very much for stopping by to see us. Mark Giannone, Chief US Economist, joining us from Barclays. We've got a conversation coming up with the FTC Chair, Andrew Ferguson. You can catch that 3:10 p.m. UK time. That is it for the opening trade. Hope you enjoyed the Monday show. The brief is up next. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Good morning from our global headquarters in New York. I'm Danny Berger. Manus Cranny is off this week. You're welcome to Bloomberg Brief. Let's set your agenda. not worried after 4 straight weeks of equity declines. Treasury Secretary Scott Bessent says corrections are healthy and normal. Pushing for an end to the war, President Trump says that he'll speak with President Putin tomorrow, saying progress is being made. Pumping up consumption, China maps out its plans to boost spending. Happy Monday to you. I hope you are ready for another busy week. We have central banks abound, Fed, BOJ, BOE, retail sales data today, housing data today. We had a rally on Friday, and some of the steam is taken out of that this morning. S&P 500 futures down 0.5%. Same with NASDAQ 100 futures. By the way, if we post another decline this week, it'll be 5 consecutive weeks of declines. That is the longest losing streak since 2022. Strategists are revisiting their target. RBC's Lori Calvasina downgrading her year-end target to 6,200 from 6,500 on a dimmer economic outlook. Your Treasury market this morning, more stability after a jump in yields on Friday. That UMich figure really upsetting the bond market. Inflation expectations higher, the highest since November 2022. Unease about the economy. Your 2-year yields at 4%, your 10-year yield at 4.2. Oil advancing this morning up nearly 0.9%. China's planning to boost its economy. The risks in the Red Sea are growing, but I should say amid all of that, Goldman Sachs has cut its oil price target on economic weakness and OPEC Plus boosting output. Okay, a couple individual stocks we are keeping our eye on this morning. NVIDIA is gaining in the pre-market. They have a much anticipated AI conference coming up that will be closely watched by investors. Quantum computing stock IonQ also on the rise. It was among one of the top mid-cap stock gainers this week, so that continues up 5% in the pre-market. Tesla, however, is down in the pre-market, 1.7%. It leads tech and Mag 7 stocks lower this morning. We'll see again if that NVIDIA news conference can change any minds. We also had some news that Elon Musk is confirming that Starship, a SpaceX rocket, will be going to Mars by the end of 2026, carrying a Tesla Optimus robot. We'll see whether that actually happens. Now, setting you up for the show today, we're going to be speaking with Maria Waitman of State Street. Later in the hour, we'll be catching up with Kathy Jones of Charles Schwab. 2 conversations you do not want to miss. Now, it's been a brutal month for markets, but U.S. Treasury Secretary Scott Bessent says that a correction is healthy and normal.
I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great.
Joining us now is Maria Waitman, Senior Multi-Asset Strategist at State Street. Maria, great to see you. So is this a healthy and normal correction?
Yes, good morning. Actually, I mean, it's not very often for me to agree with kind of U.S. administration, but yeah, no, I think it's healthy and normal correction. And the reason we're saying that is that the key point for us is that underlying earnings outlook has not been downgraded. So earnings, which is really the hard data that we all want to see, is still there, expected to continue. Yes, valuations a bit lower. We've seen a very substantial position adjustment. And what is really exciting is that we're beginning to see institutional investors coming back. So we see buying of tech again. We're seeing some like unwind of European trade. So to us, yes, it was a correction. Now investors coming back.
This is the confusing thing, is that you see money moving in a way that sentiment isn't necessarily moving. You had, for example, AAII survey of individual investors. Those sentiment figures crashing. But Maria, as you point out, buying has happened. Bank of America pointed this out too. Last week was a record week for 2025 of buying of U.S. assets. What do you make of that disconnect between where some of the sentiment measures are and where some of the money flow is going?
Yeah, I think there are 2 things. One is like media focus on kind of slowdown, recession, trade is huge.
So it's our fault, Maria.
But what is really interesting, investors paying less and less attention to it. So we like measure narrative for like trade, for example, and it was the driver of equity market only like a couple months ago. Not anymore. Like R square of this narrative regression on stock market gone close to 0. Now we're worried about earnings, we're worried about sentiment, consumer spending. So I would say the retail number today would be super, super important. So that's probably number 1. And secondly, soft versus hard data. Again, there is lots of kind of worries and concerns like labor market and future inflation. So that's where concerns are. Actually, hard data is not as weak. And I think that's that's a really important question, and that's why I'm immediately zeroing on earnings. And earnings we haven't seen, and I mean maybe it's too early because tariffs haven't been implemented, but we really are kind of unlikely to see big sharp declines in earnings very quickly.
So let's then talk about what the catalyst is for the correction, the healthy correction to be over. What stops some of the bleed? We heard from Scott Besson, again, the sound we just played, saying that over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great. Is this a market that is waiting for that good news coming from the White House, from good news coming from Powell, from economic good news, Maria? What is the catalyst that gets this away from that healthy correction and allows us to resume a rally?
I mean, we are worried about recession, right? That's kind of an obvious worry given the kind of sentiment data we've seen. I think like today, if we get a strong retail number, I think that would alleviate a lot of those concerns. I think that kind of in the short term, but in the kind of medium term, what we had this idea of U.S. exceptionalism and fantastic growth, and investors really positioned for it. If we look at investor holdings at the start of the year, really elevated positions. A lot of it came out in like last couple of months, and as I said, now investors begin to come back. And you kind of quoting the numbers from Bank of America, very similar idea. So investors beginning to come back, but to restore confidence, I guess we need to see a little bit of retail sales coming stronger. I mean, we're only like a month away from corporate earnings, so that can potentially support as well.
If we look at European equity markets, Maria, there's one sector that stands out. Financials. Commerce Bank up 51% year to date. Unicredit 36. Deutsche Bank 32. You're getting worried about European financials. Why, Maria?
Well, if you want like a shocking headline, is that institutional investor holdings of European banks, so of benchmark position in European banks is bigger than that of the U.S. tech sector. So in reality, the most crowded, the highest concentration risk is European financials, not U.S. tech anymore. And yes, European banks are having really strong underlying fundamentals. We see kind of they're very profitable, they're stable. We see yield curve being steeper, and kind of future profitability can continue to be strong. But investors really positioned for it. And valuation somewhat reflects that as well. So the current valuation in European banks is back to pre-GFC level. So we have a lot of good news priced in. It's hugely concentrated sector. We need to see delivery, and that's oftentimes a difficult situation in Europe.
So just to go back to where we started and incorporating this, Maria, this whole rotation from U.S. to Europe, again, not just a U.S. correction over, but is that simple trade, has that played out? Is that done? And if so, is there an unwind to be had? What does that look like?
I mean, as I said, we're beginning to see, we had about close to a couple of weeks of this kind of unwind of the unwind. So people are coming back to U.S. tech and selling European banks. So that's what we saw in the last couple of weeks. I mean, it's not really kind of reflected in a big way in prices yet. But to us, that kind of the thing we are watching really carefully, because investors have like adjusted positions very substantially. European banks are very crowded. U.S. tech is less so, and we're beginning to see people coming back.
Maria, I just want to wrap this up with gold. We had gold go above $3,000 on Friday. If some of the panic is going to be taken out of markets, if earnings are going to look stronger, if some other parts normalize, does the trend in gold then to normalize? Have we seen the extent of gains for the precious metal?
Yeah, no, I think you're exactly right, Danny. So gold potentially is like a kind of a fear gauge for maybe more retail investors, and it is very elevated. And so if we're beginning to see normalization, I think people can come back to like U.S. equity tax. Those trades would be kind of the other side of the trade, definitely.
Maria, thank you so much for joining us this morning. There is no one else we'd rather start our week with. Maria Waitman of State Street. Great to see you this morning. Let's get you some other top stories that are trending on the terminal today. UBS, speaking of European banks, have trimmed CEO Sergio Matti's pay to $17 million for 2024, the tiniest violin for Matti. That is below the maximum amount that he could receive. Swiss officials have been scrutinizing banker pay. Matti's 2023 compensation had caused an uproar in the country. The finance minister said that it exceeded, quote, the imagination of any normal citizen. AstraZeneca has agreed to buy the Belgian biotech company Esso Biotech for as much as $1 billion. That deal aiming to boost AstraZeneca's cancer capabilities. That transaction also expected to close in the second quarter. Now, it's the end of an era. Forever 21, a brand that drew young women and girls to shop for cheap, trendy clothes, has filed for bankruptcy after years of poor performance. The retailer said it would wind down its U.S. operations while also pursuing a going concern transaction or a sale of some of or all of its assets. This is Forever 21's second bankruptcy. We'll see if this one sticks. Coming up, President Trump says that he'll be speaking with Russian President Vladimir Putin tomorrow. We'll set up your agenda next on your brief.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Wednesday, the Fed decides.
People just want clarity. Business leaders want clarity. Investors want clarity.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
What do they need to see to have confidence in the forward trajectory?
Could our big surprise be a growth slowdown?
What's worse than an economic slowdown? An economic slowdown the Federal Reserve can't respond to.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern.
Speaking to President Putin on Tuesday. A lot of work's been done over the weekend. We want to see if we can bring that war to an end. Maybe we can, maybe we can't, but I think we have a very good chance.
President Trump there aboard Air Force One telling reporters about efforts to end fighting in Ukraine. On the agenda with a phone call, a conversation with Putin is a potential 30-day ceasefire. For more, let's bring in Bloomberg's Greg Sullivan. Greg, the 30-day ceasefire is one that Putin had pushed back on, that they wanted something different. Is there any reason to believe that there will be more accepting of this deal come a conversation with Trump and Putin tomorrow?
Well, it's certainly significant that Trump says he will be speaking to Putin and does hint at the fact that maybe they could come to some sort of agreement. But it's difficult to see what exactly that would be, given that Russia, as you say, has pushed back on the idea of a short-term ceasefire. Additionally, Russia has made lots of demands to come to the ceasefire, such as not arming Ukraine and demands for a more longer-term settlement that are unlikely to be palatable to Ukraine. This, of course, leaves European allies concerned that as Trump speaks to Putin, they could agree on some sort of truce or ceasefire that leaves Ukrainian security guarantees inadequate.
I mean, again, we have Putin saying that Ukrainian troops need to lay down your arms, kind of what we're talking about, Greg. Is there a disconnect about the conversations taking place between the U.S. and Ukraine and the conversations happening with the U.S. and Russia?
There's definitely what we've seen is a one-sided pressure campaign. Most of the pressure that we've seen has been heaped upon Zelensky and Ukraine, whereas Russia has largely escaped somewhat unscathed. We have heard from U.S. officials and Trump himself that they are willing to put new penalties on Russia, but so far there's little evidence that they're preparing to do that. So most of the time, what we've seen is very different conversations happening between Ukraine, high pressure, and between Russia, which has seemed more conciliatory.
Now, elsewhere, Greg, the U.S. has said that it's going to vow unrelenting strikes on Houthis over the ship attacks in the Red Sea. Pete Hegseth was speaking on Fox yesterday morning. Let's just take a listen to what he had to say.
This campaign is about freedom of navigation and restoring deterrence. The minute the Houthis say, we'll stop shooting at your ships, we'll stop shooting at your drones, this campaign will end. But until then, it will be unrelenting.
I think many people need to be reminded that we have been striking at the Houthis. The U.S. has been striking at the Houthis for more than over a year. So, Greg, is this a shift? Is this a significant escalation?
Well, there's a few things here. One is that it does seem that this is a new size and scope. The latest attacks were bigger than what we saw under the Biden administration, but the U.S. so far, U.S. officials are signaling that they're not ready to put boots on the ground, that boots on the ground are not being discussed. That means that it will be very difficult to dislodge the Houthis. So one other thing that we heard was that U.S. officials said this could be read as a warning to Iran. Iran, of course, backs the Houthis, and this could be a U.S. signal toward Iran to stop supplying the Houthis. And in fact, one U.S. official said that Iranian targets in and near Yemen, such as ships, could be on the table.
How do we understand how this is going to be impacting shipping routes, Greg?
Well, the Houthis' attacks have already had an outsized influence on shipping, causing many ships to reconsider taking the Red Sea route between Europe and Asia. But these renewed attacks by the U.S. could have a broader implications for the region as well. There are concerns that the Houthis could lash out against some of their Gulf neighbors in retaliation, and that, of course, will have significant implications for the region.
Greg, thank you so much for that update. That is Bloomberg's Greg Sullivan. Coming up on your Bloomberg Brief, China's economic resilience. The country kicks off the year with some strong data and plans to boost consumer spending. We'll have that for you next on Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And That's helped growth. And by the way, that's deflationary.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
This is Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages this morning. What's making headlines? First up, the New York Times leading with the Trump administration denying that it had violated a court order by deporting hundreds of Venezuelan immigrants to a prison in El Salvador. White House Press Secretary Caroline Leavitt says that the president has broad powers to quickly expel them under an 18th century law meant for wartime. All of that happening despite a court order blocking the administration from doing so. Next up, we have this from the Wall Street Journal, leading with job seekers struggling with salary deflation. Now, the salary difference between those who stay in their roles and those who change jobs has narrowed to the lowest in 10 years. Those who stayed in their jobs increased their wages by about 4.6% in January and February. Those who switched jobs, it was only slightly more at 4.8%. Next up on the Bloomberg, Chinese consumption, investment, and industrial production, all of those exceeded estimates to start the year, pointing to a sign of resilience for the economy, still in need of more stimulus with President Trump's tariff threats going. And perhaps that stimulus is on its way. For more, we are joined by Asia economics reporter Katya Dmitrieva in Hong Kong. Katya, we got the economic data, but from China, we also had plans to boost consumption. How far do those plans go?
Well, that's a great question. It seems like every time we chat, it's always about plans and Chinese economic officials and how they're developing those plans, but we don't really have any solid details or numbers from the press conference today. So we heard that officials do want and are thinking about things like child subsidies. They're thinking about raising employment income in a gradual fashion, but we don't know exactly how they're going to plan to do that. In fact, when a colleague of mine asked officials these questions, the answer was that they are currently studying them. And so that's why you saw stocks not really reacting very much to this press conference, because that's the big question for China's economy, of course, is how they're going to make this about 5% GDP growth target this year, especially when they're so focused on consumption and letting consumption lead as opposed to trade, which of course we know with tariffs will be a lot more difficult.
There was also a bullet point in there in their announcement talking about the Chinese equity market. Katya, is there a desire to shift the avenues of wealth in China to something that looks a little bit more American, something that goes away from just the property market, but to things like stocks and bonds in the region?
Yeah, that's certainly their hope. I mean, the hope is that you move away from just this sort of industrial production, export-led growth, which is sort of the two-track economy we've been seeing, right? So this growth in output and trade and a lot of concern from foreign economies, of course, and companies about the low-priced goods. And then the other side of the economy, consumption, has been pretty weak. To start the year, of course, things came in pretty good. Sort of more like better than expected, a lot better than expected. But in the private sector, we have seen some moves as well with officials. The tech sector being a big one, of course, with DeepSeek and speaking with executives. There's also another meeting coming up in China with President Xi himself due to meet with some global executives, which kind of shows you that they're hoping to lift those animal spirits further and hopefully drive some stock gains as well.
Yeah, that would be really interesting to see just who attends this year. Katya, and the data that we got how much of the surprise, how much of the growth from China is still coming from exports? Exports that might worry the likes of Europe, for example, if the U.S. continues to push back and continues to implement tariffs, and that excess and that capacity seems to be going into different markets, again, like Europe.
Yes, absolutely. There's sort of a global China shock that we're seeing taking place, and it's only expected to get worse as these tariffs come in, because if you have an economy that's still, as we saw today from the press conference and from economic data, that's so reliant on the industrial production, on government spending for that, rather than sort of more of a Western-style model where consumption reigns, then you're in the same situation as you were in last year. And in fact, you're going to have these companies in China who are looking for more markets and selling at a lower price. We've had deflation now in China for several years. There's warnings that that could actually get even worse. And so if you're, for example, in the Eurozone, if you're a company in Canada or the States, you're certainly going to be worried about that, which is another kind of external pressure on China to rebalance things in the economy.
Katya, thank you so much. That is Bloomberg's Katya Dmitrieva in Hong Kong. Coming up, we're going to preview the week ahead. It's a busy one. We'll be speaking with Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. That's coming up on your Bloomberg Brief.
drive productivity and improve efficiency, Prudential has made significant investments in data analytics and artificial intelligence. Janella Frias plays a key role in integrating these tools into the company's processes.
We always need people. We're in the people business. But more and more, if we really want to provide the right customer experience, fast access to products, it's about technology. Technology has always been an enabler. Now it's a strategic differentiator.
Give me a sense of AI in Prudential. What are you experimenting with?
A few areas. One is around customer experience. In our individual life business, our underwriting process has gone from about 20 days to minutes. In our group business, we have partnered with a number of different fintechs to really improve customer experience, to bring on board capabilities, things like claims management, where we can process a disability claim faster and help people get to work faster.
How much productivity uplift are you getting and will you get?
We're probably getting 10% at this point, but I think over time that is where the value is, and it will then allow us to take our capacity in the form of people and redirect it to more value-add activities.
In a nutshell, it means turning the menial into meaningful. It can be both a huge saver of time, but it can also provide real insight.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
From our global headquarters in New York City, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. Not worried. After 4 straight weeks of declines, Treasury Secretary Scott Bessent says corrections are healthy and normal. Pushing for an end to the war, President Trump says that he'll speak with President Putin tomorrow, saying progress is being made. Pumping up consumption, China maps out its plans to boost spending. It is a busy week this week. It kicks off with retail sales data today. Also for central banks, it is busy. The S&P 500 managed a 2% plus rally yesterday. Not yesterday, Friday, but you know, what are days? What does it mean? Monday is the date today. S&P 500 futures and NASDAQ are lower by about 0.4%. If we get another loss this week, it'll be the longest losing streak for this equity market since 2022. By the way, we're getting downgrades abound. RBC's Lori Calvasina, the latest to downgrade her year-end forecast. Most of the sell side citing lower economic outlooks, a lower GDP growth. Now, for your bond market, there was more stability today. There was a jump in yields on Friday after the UMich data. That inflation expectations reached the highest since November of 2022. 4.28 is where you stand on your 10-year yield. Some strength coming in from this oil market. We are up 1%, with the U.S. saying it will have unrelenting strikes rather on the Houthis after their attacks. Meanwhile, you also have China boosting their economic consumption plans, all of that supporting oil. Now, as I mentioned, it is a big week. Let's just try to go through the calendar. We have three major central banks out with decisions. We're going to have the Fed and the BOJ on Wednesday, then the BOE on Thursday. We're also going to get a read on the U.S. consumer today. We're going to get retail sales. By the way, we also have German lawmakers voting on hundreds of billions of euros of spending. That vote starts to kick off tomorrow. There is so much for this bond market to keep track of, and that's even before any policy pronouncements we might get from the White House. Joining us to help set us up for it is Kathy Jones, Chief Fixed Income Strategist at Charles Schwab. Kathy, that is a busy calendar. Just how are you thinking about the setup for this week?
Yeah, well, the first number is going to be the retail sales. I think we're going to be looking at that to see what the strength of the consumer looks like. There was weak in January, but there probably were some weather-related factors there. So looking to see if there is a rebound. And our biggest concern going forward on the economy is, will consumer spending slow down because of the various factors that are at work right here. And so once we get to retail sales, we get through that number, then we really will focus on the Fed and see what the comments are from Fed Chair Powell about the economy and the outlook for policy going forward.
So to pick apart a few things, the University of Michigan figure on Friday, I think spooked some people, Kathy, because yes, there are political biases in that survey, but it showed inflation expectations going up really across income, age, education, political cohorts too. There was a jump in independence. How much do you worry about some of these sentiment readings? Because the sentiment readings have been poor, whereas the hard data has been decent, let's say.
Yeah, I do worry about the sentiment readings, especially inflation expectations. Now, this is a survey, as you mentioned, that really underlying it, the political affiliations have a big influence on. But it is significant that half or more people expect inflation to continue to rise at a pretty hefty pace. I think the effect of tariffs is working its way through the system. And even if we haven't had all the price increases associated with tariffs, the expectation is that we'll get them. So it does concern me because it can constrain what the Fed can do, even if the real economy slows down. If inflation expectations are elevated, it makes it very tough for the Fed to move on policy.
So then you have a front end that's been really pinned down by what the Fed can do. Kathy, what about duration at this point? Do you expect long-term yields to be moving up higher, just given the kind of outlay that you're describing?
Well, in the long run, we actually think they're going to come down a bit. And the reason is that we do see the economy slowing probably visibly in the third and fourth quarters as we see the impact of tariffs affecting spending and all of the uncertainty affecting the ability of businesses to really plan and move forward with expansion. And then we're seeing some deterioration under the surface in the labor market. So you combine all those factors, and I think second half of the year there's a good case for bond yields to come down. But in the short run, we're pretty concerned. We don't want to extend duration here because we think that there's going to be just a continued volatility. And some inflation pressure coming from the tariffs. So it's kind of a sequencing issue, higher in the short run, lower in the long run.
Well, with all of that, we finally have seen some moves in high yield spreads, Kathy, and it's taken a long time for us to get there. They had their biggest move wider last week since the turmoil of last summer. But again, even with that move, it's not necessarily extraordinary. It doesn't look as bad as things look in other risk assets like the equity market, for example. Does that widening continue? Are you seeing signs of cracks in junk bonds?
Yeah, we think in high yield, there's room for them to widen further. As you mentioned, they're still low. They had a big jump, but they're still pretty low. And I think with the equity market floundering here and potentially softening because of all the cross currents in the economy and in policy, there is room for junk bond spreads to widen from here. So we're pretty cautious on high yield. We're much more constructive on investment grade, even though those spreads could widen a bit, not likely to have the impact, the negative impact on total return that you might see in the high yield market.
But isn't there an element, Kathy, where this is a bond market that looks completely different, that it's just higher quality in general because so much of it has been moving to private managers? Is there a degree which the corporate credit bond market just doesn't act as robust of a signal as it once did?
Yeah, I think that's a possibility because, as you mentioned, private credit has taken a lot of the lowest quality off the radar for us and out of the market for us. But you know, the economy is what the economy is. Those spreads are still going to respond. If we have a slowing economy and concerns about rising defaults, we're going to see those spreads widen. So maybe it's higher quality overall than it used to be, but still the dynamic is there that could widen spreads from here.
Kathy, before we let you go, I just want to end on this because tomorrow we're going to get a vote on Germany, tomorrow and Friday, on some of the spending measures that they want to be putting through. The spread between treasuries and bonds has really collapsed. It's around 140 basis points. At its peak, it looked something like 230 basis points just 3 months ago. Has that gone far enough, Kathy? Have markets fully priced in the rewiring of debt that we are about to see with Germany and wider Europe turning to issuing more, to allowing that more spending and putting aside decades of austerity?
Yeah, I don't think it's quite run its course. I think it might have the majority of the spread differential is probably in the market now, but I think longer term, there could be more. You know, 3.5% of GDP on defense spending is a big move for the major economies in Europe. So I think that we could see some more spread widening. And, you know, obviously it's been a very, very long time, right? It's a huge shift in the overall economic outlook for Europe right now relative to, say, the U.S., where we're expected to soften a bit and they're expected to boost spending quite substantially, which could boost growth fairly substantially.
Yeah, a long time coming. Kathy, thank you so much for getting up early, for joining us on this Monday morning. Good luck for your week. I think we all need it. Kathy Jones of Charles Schwab. Coming up, reciprocal tariffs are coming. Not this week, though. At least you get a little bit of a break on that front. Well, we'll see. President Trump indicates that more tariffs are in track when that deadline comes in just 2 weeks' time. Good morning. You're watching Bloomberg Brief.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, And if you want to learn to listen for it, we'll show you how.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
This is Bloomberg Brief. I'm Danny Berger in New York. President Trump signals that he plans to push ahead with a more aggressive tariff regime. He told reporters aboard Air Force One that broad reciprocal tariffs and additional sector-specific tariffs will be imposed come April 2nd.
It's going to be reciprocal. In other words, whatever they're charging, we're charging. Very simple. If they're charging us, we're charging them. It's no longer they charge us and we don't charge them.
Joining us now is Bloomberg government reporter Kate Ackley in Washington. So, Kate, no backing down.
For now, right? We see this. It kind of comes and goes. The tariffs are on. The tariffs are off. It's really roiling the U.S. lobbying community, the business community, not quite sure how to respond. A lot of them are waiting for data. When tariffs actually go into effect, how does it affect prices and inflation? Things like that. We're going to be watching, this week, Congress is out of session. So members of Congress will be back home in their districts. Now, we know that a lot of Republicans have decided not to have town hall meetings, but they'll still be home for the most part. They'll be available to constituents. What are constituents saying about the tariffs that are supposed to take effect April 2nd? Is there a widespread backlash at all? Are business leaders in Republican congressional districts and Republican states, are they mobilizing at all this week, to fight back against the tariffs or to subtly, sort of whisper their concerns to Republican lawmakers about the tariffs? That's what we're going to be following this week.
Well, over the weekend and on Sunday, Kate, there were some really, really brutal polls put out for the Democrats. There was one from NBC saying that just 27% of Americans like the job that the Democrats are doing. CNN put their favorability, their net favorability at 29%. That's apparently the lowest rating in the 33-year history of the survey. Kate, is Trump really likely to listen to either what some of the constituents are saying to their congressional members or what some business leaders are saying? If he's not feeling that pressure from the favorability numbers from the Democrats, regardless of what his polls are doing, will he not feel more emboldened to go forward?
Well, we saw last week, as we were talking about the debate over the government funding situation, we saw divisions within the Democratic Party just, completely open air. Republicans, House and Senate, all kinds of, sniping at one another. So, you talk about the polling for Democrats. Some of that is Democrats, I would assume thinking that their party is not standing up strong enough. We saw a lot of backlash to Senate Democrats' decision to vote for the continuing resolution, the government funding resolution at the end of last week. So you have a lot of division within the Democratic Party. But what I'm talking about is more looking at what are Republican members of Congress hearing. I think what they're hearing and what they say to the administration will obviously have a little bit more sway than what Democratic members are saying. But we are monitoring both and certainly checking on the Democrats' resistance and the divisions within the Democratic Party, which have been on full display recently.
Kate, also on the agenda for the White House this week, tomorrow Trump says that he's going to be speaking with President Putin. What are we expecting out of a potential phone call between the two of them?
Well, what Trump said, and I think this was also aboard Air Force One as well, that he was planning to talk to Putin on Tuesday, as you said, and he mentioned that there was going to be a lot of discussion about land. You know, President Trump has said he wants to end the war in Ukraine. He's been saying things very favorable to Russia, and he's talking about land, you know, sort of dividing up this land in question. So we'll be monitoring that. That's also on the agenda this week.
Well, a busy week, even with congressional members at home. Kate, thank you so much for helping us set it up. Kate Ackley of Bloomberg Government. From the U.S. to China, the country's central bank is looking into plans to boost consumption. That involves increasing low-cost financial support for key consumption areas. Joining us now is Bloomberg's Alan Wan. Alan, great to see you. Just how far do these plans go?
Well, you know, they didn't go far enough. I mean, the market was pretty steady throughout the day. But it's very important. I mean, a lot of economists were saying that it's a good start. It's a skeletal plan, but it's a good start. And the focus is going to be on stabilizing household incomes. Basically, how are you going to promote consumption when people feel like they're getting poorer? So they're going to be measures to stabilize household incomes. There's also going to be efforts to promote consumption of new services. And there'll be government efforts to alleviate the burdens for elderly care, medical care, and health care for folks.
Well, this is a push that the U.S. has also been explicit that they wanted from China, a shift to consumption away from exports. Alan, we also got some China data that surprised to the upside. How much of it is still being driven by exports coming from China?
Yeah, I mean, the first 2 months of the year, I mean, it was all exports, really. It's just the front loading of shipments by exporters and a trading program. Exports are still huge, but I think that the government is trying to pivot towards domestic consumption. But right now, the first 2 months of the year is mostly exports. Everything rose by more than forecasts. But you have to be concerned a little bit, just because it seems a lot of these things are just one-off measures. Whether it's the training program, whether it's a front loading. I mean, the government has to do more, especially in doing more on the domestic consumption side. And today there was a meeting, a joint ministry meeting. And there weren't a lot of details, and I'm afraid that markets will be a little bit underwhelmed coming into the open tomorrow morning.
Well, we're also going to get a meeting with global CEOs coming to China. We don't have the exact details of who's going to be there yet. Qualcomm, Saudi Aramco's Amin Nasser, reportedly among those who are going to be attending. Alan, how much are we going to see this push that China appears to have been making, at least in tech, to try to support and uplift private sector business as well?
Yeah, I mean, it's going to be a very busy week in China next week. You got the China Development Forum, you got Boao, and then later in the week, on the 28th, sources are saying that Xi Jinping is going to meet some global CEOs. So for the CDF, like you just said, there'll be global CEOs from Saudi Aramco, Qualcomm. But one of the more intriguing visitors is Steve Daines, a Republican senator, a politician, who'll be coming here, and he'll be meeting senior leaders to talk about fentanyl, which is one of the reasons that the Trump administration gave to impose tariffs. So that'll be interesting. And then you get a Boao Forum, and we're expecting another senior leader to attend that as well. And then on the 28th, you've got global CEOs. If they stay, maybe they'll stay for the whole week and meet Xi up in Beijing or Boao for all we know. But it's all part of China's push to show that it's over for business at a time when the Trump administration, with its protectionist American first agenda, is going the other way. And it's also an effort by the Chinese government to show that it's supporting private enterprise.
Alan, we are going to look forward to catching up with you after that meeting on the 28th and what the outcome might be. Bloomberg's Alan Wan. Let's turn to the AI race. Bloomberg sources telling us that Apple's top executives overseeing its virtual assistant Siri told staff that delays to key features have been, quote, ugly. For more, let's bring in Bloomberg's Tom McKenzie. Tom, we also have this 100 executive retreat coming from Apple, but it seems like in the background that AI, this crisis, if we'll call it that, seems to have reached a boiling point for them.
Yeah, look, this was an all-hands meeting, and again, this is a Bloomberg scoop reported by Mark Gurman. So an all-hands meeting led by Robbie Walker, who oversees the Siri team, and anyone who's used Siri recently will know that it's pretty clunky. It hasn't changed much, so there is a big focus on ensuring that Siri can be that voice assistant that its customers, that Apple's customers would expect in this world of generative AI. But there is a long way from that, and to your point, there is real tension. It is a boiling point moment right now, almost kind of like breaking moment. The executive Robbie Walker talking about burnout amongst the teams, talking about the situation being very bad. The context is that the Worldwide Developer Conference, that is the biggest event for Apple, took place in June of last year. They unveiled a prototype that was followed by a marketing and advertising campaign. And the truth is, they don't have anything close to a working prototype. They didn't in June. They were hoping to launch it in spring of this year. Now it's been pushed back to next year at the earliest, this updated Siri assistant. And the team has faced all these challenges in terms of engineering challenges and bugs. The idea is that when this voice assistant, when Siri is upgraded, what it'll be able to do is tap your own data on your phone, but also manipulate apps and translate that on screen for you. So it'll be pretty powerful when it comes to pass, when they finally have it out, when they're finally shipping it. The question is, when are they going to do that? And it's been pushed back from spring of this year into next year, again, at the earliest.
They need something to fuel the upgrade cycle, especially in places like China where the data has been bad. Tom, Mark Gorman of Bloomberg has also been doing some reporting on the iPhone 17 to come. I realize more of that's about the hardware itself and not the software, not the AI behind it. But is there anything to suggest that that phone might help us re-enter the upgrade cycle?
Yeah, well, it's the upgrade cycle around hardware that Apple is looking at making progress, of course, and there's a lot of scrutiny in the Chinese market. You were just talking about China there, and in terms of how Apple is partnering with the likes of Baidu and Alibaba to make sure it's not left too far behind. It is playing catch-up when it comes to artificial intelligence. So it does need both the software and the hardware to come together, and the iPhone 17 will be an attempt by Apple to, again, close the gap, frankly, on some of its competitors, many of them in the Chinese markets who are innovating at pace. Talking about management changes, no heads have rolled yet in terms of the Siri team and the artificial intelligence team, but there have been some management changes. And when I've spoken to people at Apple and I've had conversations with them about this, there has been some pretty dispiriting commentary about the AI team at Apple. So that's one to watch as well. Management changes have been put in place. The pressure is certainly on the hardware front and the software front. Now Apple, the stock is down about 14% year to date, Danny.
Yeah, we'll see what changes come. Apparently that new iPhone is going to be very thin, which scares me because I would probably snap something like that. Tom, thank you very much. Bloomberg's Tom McKenzie. Yes, I'm a klutz, and yes, I drop my phone a lot. Okay, coming up, a slew of central bank decisions are on deck. We're going to hear from the BOJ, BOE, Fed. We'll set up your week to come on your brief.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets.
Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning from our world headquarters in New York. I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's your Bloomberg Brief. I'm Danny Berger in New York. Let's set you up for your trading week. First, the data. We're going to get U.S. retail sales data for February. That comes out at 8:30 a.m. Eastern. Then the Fed, BOJ, they both announced rate decisions on Wednesday. Then on Thursday, it is the turn of the BOE. A quick check on your oil markets this morning as we head to the end of the hour. We are looking at advances. We're off the highs. We're up by more than 1% at one point. We're up just 0.9 for NYMEX crude and Brent. Two factors to keep in mind. It is China making plans to boost their consumption. And then at the same time, we have the U.S. announcing that they would do more strikes on the Houthis as they attack in the Red Sea. Even among all of that, we've had Goldman Sachs downgrade their oil forecast, pointing to both OPEC Plus pumping out more and concerns of an economic slowdown. Now that is it for your Bloomberg Brief. Surveillance will take things from here. This is Bloomberg.
What legacy I would love to leave is to make sure that in my village I have infrastructure. So long when I'm gone, things are still working. Then I have done my job. And if some people get inspired through my work and then try to engage themselves for their community and create something that is inspiring for everyone, I will be happy.
What's the best piece of advice you would give to someone young who wants to make a difference actually in this world? In architecture or with something else?
Wow, I'm not the right one to just do that.
I think you are.
Yeah, but with the pressure you have, and then you try to be the good one, the fancy guy, the intellectual one, I have no advice than to believe in yourself and really work hard. You know, when I started, no one would have imagined that I will be able to see my name connected with Aga Khan or Pritzker or sitting in Bloomberg to talk about sustainability, about future of sales. No, myself 5 years ago, if you told me that, I will say no. I will never imagine. So I will encourage everyone to believe in what you're doing and not try to run after the newest of the newest. Just be consistent. Just work on things that matters for you. Really, at the long term, it pays.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
The market is forward-looking, but I'm not sure we are right now forward-looking enough to look through all the weakness that is going to come in the economic data.
I think it's time for some selective buying in the U.S.
There's definitely a soft patch here, and the question is whether all this market turmoil helps push it into something more.
Corrections end on bad news. They don't end on good news.
What you'll probably see in here, the market's trying to find a bottom. There will be a bounce.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Monday following 4 straight weeks of losses, and the White House isn't blinking.
Corrections are healthy, they're normal. What's not healthy is straight up, that you get these euphoric markets. That's how you get a financial crisis. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great. We are going to have a transition, and we are not going to have a crisis.
So up next, the Fed decision, and Fed Chair Jay Powell showing very little interest in stepping in with rate cuts anytime soon, putting even more weight on this week's economic data. As consumer confidence drops and corporate America fires some warning shots, investor focus turning to U.S. retail sales later on this morning. Another read on the consumer, 8:30 Eastern Time.
Which is key, because right now, and it's good that you pointed out the idea that the Trump put maybe isn't as strong as people expected. Well, is the Fed put also a lot more difficult to really engage than people expected? Because even though we do see a softening in consumer demand, the real-time data seems to suggest that we're not seeing a softening in long-term inflation expectations, at least in the margins, which makes it difficult for the Fed to just full throttle embrace the weakness and respond to it.
UMich was spicy going into the weekend, so let's talk about some bullet points from the UMich consumer sentiment read. Consumer sentiment, the lowest since November 2022. Long-term inflation expectations higher. Households expecting higher unemployment at levels we haven't seen in more than a decade.
The consumer sentiment, it's obvious from this survey, is souring right now. And a lot of this is policy driven. If you look at the statement that came out from the director, many consumers had the high level of uncertainty around policy. So it's not even the policy itself. It's the uncertainty waiting for it. And another nugget I thought was so important, nearly 50% of survey respondents just spontaneously started mentioning tariffs in the interviews that they conducted.
Wall Street is souring as well. Check out some of the forecasts we've had over the last week or so. Equity downgrades at HSBC, at Citi, price target cuts at Jardinic, Costin over at Goldman Sachs, and now Lori Calvasina of RBC, dropping the price target on the S&P 500 from 6,600 down to 62.
It's about a 6% decline in some of her expectations for the full year, but she echoed what a lot of other analysts said over the weekend, which is it's difficult to know whether this is an entry point or whether this is just the beginning of a deeper pain in equity markets, because ultimately, as she said, the sentiment, the vibes aren't sending us a clear signal, and that pretty much was what everyone across the board said. Mike Wilson of Morgan Stanley, it will take more than just an oversold market to get more than a tradable rally. Stuart Kaiser of Citi, we will wait for better entry points.
If you're worried about policy, over the weekend, the president doubling down on trade.
Doubling down on trade. Him and Scott Bessent as well over the weekend talking about April 2nd being the big day when it comes to trade. That's when we will get these reciprocal tariffs. Neil Dutta, who'll be joining us, sat down with Paul Krugman and talked about the fact that what the market was pricing in with Trump was tax cuts, deregulations, and then maybe tariffs. But on this program, how many times did we say tariffs is the first lever he can pull? Because he can do it from the White House unilaterally.
Neil Dutta, about 2 hours, 30 minutes away on this program, 8:30 Eastern Time, shortly after we get U.S. retail sales. If you want the scores, equity futures right now pulling back by 0.5% on the S&P 500, following 4 weeks of losses on the S&P, the longest weekly losing streak going all the way back to August. On that losing streak, we'll catch up with Jonathan Stubbs of Berenberg later on this morning, plus Tobin Marcus of Wolf Wolfe Research as President Trump teases even more tariffs, and Lofi Karui of Goldman Sachs turning cautious on US credit. We begin this hour with stocks lower as Treasury Secretary Scott Bessent dismisses market worries. Jonathan Stubbs of Berenberg writing the pullback in US shares in the past couple of months is a better potential entry point. Valuation is still not supportive, but technical indicators are. Jonathan joins us now for more. Jonathan, welcome to the programme, sir. Talk to us about the technical indicators that you're looking at that provide you at least some encouragement.
Yeah, morning. I think, first off, we entered this year hot, and it's actually quite refreshing to hear Bessent's comments. It doesn't appear to be a slave to the market, which I think is healthy. Remember, US equities were 22.5 times on a 12-month forward P. That's the third liquidity-driven sort of bubble that we have seen in the last 50 years. That was start of year. We're back to sort of 20.5 times on a forward PE. Some of the technical indicators, retail sentiment, the sort of the classics of AA, II, sort of bull bear spread. That hit last week. That hit sort of buy territory. RSIs have been sort of hovering around there for a while as well. So there's some sort of technical sort of friction into the US market. But the big question is, what has really changed? What has the Trump administration done to change the whole setup for US equities? Is the US actually now a broken trade on that basis? That's what I've been exploring with investors over the last few weeks.
So do they think it is a broken trade?
I don't think the market's come round to that, but work I did last year showed that the US equity market in market cap terms gained around $30 trillion of value from 07 to 23. And if you calculate a total policy impulse in the US, a sort of broad sort of number for monetary and fiscal, so change in central bank balance sheet, change in government debt, the US total policy impulse over the same period was $30 trillion. So pretty much a one-for-one relationship move with US equity markets. So given the sustainability question over sort of US fiscal, is the US now in a position where it's playing exactly the same policy which has driven American exceptionalism for the last 15 years, or is the Trump administration doing a 180, going in an opposite direction, trying to rewire America, remap the world? I think the latter is the case. So I'm not saying broken trade, but it's definitely a different proposition to investors today, in my view.
Jonathan, what are people waiting for to decide whether this is maybe a tactical trading opportunity versus maybe a bottoming out and a really good buy in the U.S.?
Yeah, I think the tactical opportunity, I can see I've written about. We came into this year saying we would look to buy lower on weakness, etc. We've had that weakness. Some of the tactical sort of technical frictions are there. I was updating our sort of forward grids end of last week, and for the US to enjoy 15% earnings growth, which is above consensus, and to be on what I consider a bull market multiple, which is 20 times PE forward in 12 months' time, that would give US equity markets 6% upside from here. So we have to stretch consensus. We're holding that sort of 20 times bull market rating. To get more than that, we have to see earnings growth 20% or higher, which is very unlikely. Or we're having to go back into that liquidity sort of bubble PE, which I also think is quite unlikely. So I think the US is in for a more sort of sober and somber year trading range. It'll pay investors to sort of stay nimble, nibble when we get the sell-offs like we have, but don't sort of buy into the wholesale change that we're just going bottom left, top right.
You framed it in a way earlier to sort of demonstrate that in the United States, a lot of equity investors have simply been reaping the benefits of a whole host of bazooka of fiscal spending. That fiscal spending bazooka has shifted to Europe, has shifted to China. Is that kind of what equity investors are going to do as well? Is that trade over in terms of the shift to European equities in particular?
Yeah, correct. I mean, I've put this in my sort of regime analysis over the last 3 years. I've called that Brave New World. I write about that all the time, and my framework has been very sort of simple, 3 parts. First, this is a world of political and geopolitical disruption. We're seeing lots of that. Second, this is a world of fiscal activism where big government is the order of the day when it comes to generating growth and even sort of equity market gains. And thirdly, this is higher for longer. So my Brave New World framework hasn't changed, but as you say, there's been a very significant shift and a delta change from a European perspective. I would go as far to say that Trump is actually driving European policy. And our view as of the last 6 months is that Europe had upside risk, still has upside risk, but less so than 6 months ago. The Chinese are obviously having to sort of battle against sort of disinflationary forces and sort of soft growth, but I suspect that they'll sort of muddle through as well. So yeah, I think the worm has turned. I think it's a big worm that's turned. And I think it means investors globally have got to take more balance in their global equity allocation. That probably means lightening up on US exposure and broadening out to the rest of the world. That's what we've been doing over the last few months, and that's what we'd recommend today.
Jonathan, we've certainly seen the Trump effect in Europe when it comes to places like Germany. You talk about how the reset when it comes to Trump 2.0 could have been extended pretend, tweak and modify, or wholesale change. And it looks like, according to your report, they're going for wholesale change. How long could we see the benefits of that, given it's going to cause a tremendous volatility on the pathway?
I think first, again, to recognise the lead in you had earlier, Besant and the Trump administration recognise this. They're trying to manage that narrative real time. And I think everyone takes a step back. The conversation I've had with investors over the last few years is that the US has been and is on an unsustainable path when it comes to debt levels, when it comes to sort of fiscal sustainability. So it needs addressing. A modest tweak doesn't do it. US government debt is forecast by the CBO to go from $36 trillion today to 56 within a decade. America eventually breaks under that weight of debt. So the Trump administration is resetting energy, it's resetting trade, it's resetting national interest, it's trying to reset sort of domestic policy around ideology as well. So this is a wholesale sort of, as I say, rewiring of America, remapping of the world. It's radical, it's ambitious, it's obviously running into huge sort of frictions domestically and internationally. But America doesn't have too many options at this point. Modest tweaks won't do it. It needs wholesale radical surgery. And that's what the Trump administration is trying to put through. We'll see how successful ultimately they'll be.
So far, they're willing to tolerate some pain as well. Unexpected in many ways. Jonathan, got to leave it there. Appreciate the catch-up. Jonathan Stubbs there of Berenberg. Talking about a reset, I think a lot of people have got to reset expectations, and that's what the OECD is doing this morning, cutting the world growth forecast, citing, guess what? Tariff fallout.
This is what a lot of people have been talking about, not only downgrading growth, but increasing inflation expectations and saying the Federal Reserve may remain on hold well into 2026. This is the conundrum that they face. The report is clear to say if the tariffs are not that 25% across the board levy, that potentially growth would be impacted less. They still see slower growth, though, from some of the deglobalization trends that we see around the world.
They're playing catch down. We've seen this from so many houses on Wall Street over the past week, from Goldman, Morgan Stanley, the likes of Deutsche Bank cautioning as well about growth too. JP Morgan, Mike Feroli on Friday, Lisa, doing exactly the same thing going into the weekend.
A lot of people were expecting a little bit more of some sort of fiscal boost on one side. We heard a lot of businesses talking about tax cuts and deregulation as their nodes of optimism. Those have not been the nodes of optimism to start the year because, frankly, we don't see the time horizon for when that will get passed.
Equity futures just a little bit softer to start the week. We're down by about 0.4% on the S&P 500. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Just some of the details of that OECD report that you mentioned, its latest economic outlook. The report says that President Donald Trump's aggressive trade policy is setting the global economy on a path of slower growth and higher inflation. The Paris-based organization has cut its growth forecast for 12 G20 countries, and it warned against ratcheting up retaliatory trade barriers. President Trump says that he will speak to Russian President Vladimir Putin tomorrow as the U.S. presses for an end to the war in Ukraine. Trump says that the discussions will focus on territory, power plants, and dividing up certain assets. Speaking to reporters on Air Force One, the president said, "We are doing pretty well with Russia, and there is a very good chance for a deal." Now, the two astronauts stuck in space may be home as early as tomorrow night. SpaceX's Dragon capsule successfully docked at the International Space Station on Friday. The vessel was carrying a new crew, allowing marooned astronauts Butch Wilmore and Suni Williams to return home after more than 9 months in space. And that's your brief, John.
Just unreal. Absolutely unreal. Danny, thank you. More from Danny later on this hour. Up next on the program, doubling down on tariffs.
April 2nd is a liberating day for our country. We're going to be getting back some of the wealth that very, very foolish presidents gave away because they had no clue what they were doing. We're going to be getting back a lot of the wealth that we so foolishly gave up to other countries, including friend and foe.
That conversation up next with Tobin Marcus of Wolf Research, live from New York City this morning. Good morning.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
So here's the state of play early this Monday morning. Good morning to you. Equity futures negative by 0.4%. A growing list of downgrades on Wall Street. The latest name, RBC's Lori Calvasina, dropping her price target on the S&P for year-end from 6,600 to 62. Mike Wilson of Morgan Stanley Publishing overnight saying tradable rally possibly. Durable rally, short answer, probably not.
And part of it is because not just this question around tariffs, but also growth expectations for earnings have to be pretty high. And that's really what we were just hearing. That's the sort of, I don't know, fly in the ointment at a time where consumers just are not getting out there to shop. We will get the latest read today for retail sales.
The equity read last week was really tough. The bond market did nothing. No comfort at all coming from fixed income. Yields barely moved. This morning we're down 3 basis points. The 10-year 428.13. Under surveillance this morning, doubling down on tariffs.
April 2nd is a liberating day for our country. We're going to be getting back some of the wealth that very, very foolish presidents gave away because they had no clue what they were doing. And April 2nd, I would have made it April 1st, but you know what April 1st is? April Fool's Day, I figured. I don't like doing it, but I made it April 2nd. But it's a liberation day for our country because we're going to be getting back a lot of the wealth that we so foolishly gave up to other countries, including friend and foe.
So here's the latest this morning. President Trump saying both broad reciprocal tariffs and additional sector-specific ones are coming on April 2nd. The president suggesting added levies will be imposed on key industries, including autos, chips and pharma. Joining us now for more, Bloomberg's Tyler Kendall. Tyler, the president not backing down.
No, John, and President Trump, these comments signaling that we could see those reciprocal tariffs and those sector-specific tariffs you mentioned stacked on top of each other instead of just rolled in to one big calculation. And while senior administration officials have long pushed us to that April 2nd date, these comments that you're hearing do signal that President Trump appears ready to opt for that more aggressive tariff regime despite the recent market volatility. Importantly, he also went on to say that he is not expecting to implement any exemptions or carve carve-outs for his steel and aluminum tariffs that he implemented last week. As we know, many of our trading partners opted to negotiate with the U.S. instead of implementing their own retaliation. Of course, Canada and the EU examples to the contrary there. But it remains to be seen if any of those concessions are being made as these negotiations continue. Treasury Secretary Scott Bessent, in an interview over the weekend, did say that some of our most unbalanced trading partners are starting to lower their tariff barriers, although he didn't specify which countries exactly. But John, it's showing that this administration does appear unmoved by the recent correction in equity markets, that they say that they are holding the course here for a more aggressive tariff regime. Both President Trump and Treasury Secretary Scott Bessent saying that this is all part of a pro-growth long-term outlook.
Tyler, when it comes to the tariffs, we have 20% rate now on China, 25% steel and aluminum, and 25% on Canada and Mexico, but a lot of carve-outs if you're trading under USMCA. What can we see on April 2nd?
Right. So we are expecting those reciprocal tariff calculations. We have to keep in mind this White House has said that those will include those non-tariff barriers like the VAT tax, like subsidies, lax IP regulations. The administration is going to roll that all into one. And then those sector-specific tariffs that this White House has said is adjacent to national security concerns like autos, pharmaceuticals, chips that this president wants to see lower and bring down. That's why the European Union we've been talking so much about, because we know that they could be hit particularly hard when both of those tariffs are combined. We know negotiations are already underway. Just look at Friday when we saw that meeting between Commerce Secretary Howard Lutnick and a Canadian delegation, but still not seeing much movement when it comes to how these countries are going to start to lower their barriers ahead of April 2nd. I'll just quickly add that in his interview over the weekend, Treasury Secretary Scott Bessent did give us a range. He said, look at April 2nd, but also look potentially towards June 30th, the whole of the second quarter, as the timeline that we could start to see those tariffs go up and down as those negotiations continue.
Tyler Kendall, appreciate the update from the nation's capital. To extend the conversation, joining us now, Tobin Marcus of Wolf Research. Tobin, welcome to the program, sir. Some people, and I stress some people, have been surprised by the amount of pain the administration is willing to tolerate here. From your perspective, just how far do you think the White House is willing to go in early April?
It seems like they're prepared to go big on this. And I think there's a huge range of outcomes that's possible on April 2nd. The value-added taxes that you were just discussing, that's the big question in terms of the reciprocal tariffs. If they roll out rates that don't incorporate value-added taxes, this will be a quite modest policy. If they do fully incorporate VATs, we're looking at rates in the 10 to 25% range on most of our biggest trading partners. And based on the way the president's talking about it, I think we have to assume that that will be included as they've indicated. Because if they don't, it's, I think, going to be a pretty underwhelming policy relative to the expectations they've been setting.
Well, the administration views differences in sales tax rates as an export subsidy. What can Europe do to get ahead of this?
Right. Countries cannot negotiate away their VATs. That's the entirety of the tax base in most of these countries. That would be like if somebody asked the U.S. to repeal the income tax as concessions in a trade negotiation, which clearly is not going to happen. I think the economic argument about VATs is very weak. They really are neutral to country of import. You're talking about, a German-made and a U.S.-made car. They're both taxed at the VAT rate in Germany. Neither is taxed at the VAT rate in the U.S. So there's no discrimination taking place. But the administration has been arguing that, this looks like an export subsidy because they're rebated at the border.
Tobin, we heard from the president and from Scott Bessent, the Treasury Secretary, both really talking about the big day being April 2nd. Do you expect any announcements, though, like the 200% on champagne and cheese and wine from Europe to happen before April 2nd?
In terms of further retaliation from trading partners, possibly. I think other countries are still digesting a lot of what's already been done. For the most part, I think countries have made their decisions about how and whether to retaliate. There are, I think, some countries where there is further retaliation that's in store, but they seem to be trying to maintain a little bit of strategic maneuvering room. China in particular has hit back a little bit, but not that hard based on the sort of severity of the 20% with which we've already hit them. And I think other trading partners of ours are also making their own calculations. So we'll see, again, exactly how severe they go on April 2nd. I fully expect there will be more retaliation at that time.
Heading into 2025, people were expecting the tariffs. They also were expecting, though, a wave of deregulation as well as tax cuts. That we have seen some deregulation, but tax cuts haven't really been the main discussion for a while. Do you foresee a time later this year where we'll be talking once again about fiscal expansion in the United States and not just some of the cuts?
So Congress has been working hard on the tax cuts. That process is proceeding. I think it's proceeding as quickly as anyone could realistically have hoped. We never thought that was going to get done before summer, and that's still what we're looking at. But that bill is going to be, there will be some nice goodies in there for the corporate sector. You know, we'll probably get 100% bonus depreciation. We'll probably get R&D expensing. Those will pull a little bit of CapEx forward, you know, to the extent that it's not being stepped on by uncertainty. But that's not going to be a massively stimulative bill. And we never thought that it would be. You know, I think it will be a little bit expansionary in the early years, turn contractionary on paper a few years down the road. But you know, most of the cost is extending current policy. There are going to be some real offsets in there, in my view. And we don't have another 14 points to cut the corporate rate like we did in 2017. I think it was never going to be the same, you know, level of favorable tax cuts that we saw during his first term.
They're moving really quickly, Tobin, and they're moving quickly on the foreign policy front as well. Just getting confirmation from the Russian side, something we had indicated by the President of the United States in the last 24 hours, that there will be a call between the Russian and US leader on the phone, scheduled for Tuesday. That confirmed by the Kremlin just moments ago. Tobin, what are you looking for tomorrow? What's the outcome you'd expect from that call?
Yeah, I mean, I think that the Russian side seems like they want to make a show of being a good negotiating partner, but it's not yet completely clear to me that they're willing to kind of foreclose on their ambitions to keep making progress in the near term. I mean, they've believed for quite a while now that they're on the front foot. And so I think it's always been clear that one of the major obstacles to the sort of near-term negotiations Trump is trying to mediate will be, you know, can you get the Russians to settle for the current status quo for now, or are they going to keep making these demands like, you know, Ukraine ceding the remainder of these 4 disputed territories and so forth before even getting into the early ceasefire phase?
Tobin Marcus of Wolf Research. Tobin, appreciate it. A highly anticipated phone call taking place between the President of the United States and the Russian leader set for tomorrow.
And it comes after his special advisor, Steve Witkoff, sat down in Moscow with President Putin. And over the weekend on the Sunday show, Steve Witkoff said he doesn't want to put words in President Putin's mouth, but he thinks that Putin agrees with Trump's philosophy, basically, on how to end this war.
What's the goal in terms of the timeline, though? And I think that's what a lot of people are wondering, is to cease the fighting in the near term and then hash out the details. Putin has talked about not wanting to do that so quickly. So this is sort of going to be an interesting moment.
We'll have more on that story in just a moment. And this one. Up next on the programme, Stephen Trent of Citi on his outlook for the struggling airline industry following that big downgrade to its forecast coming from Delta just last week. From New York City this morning, good morning to you all. You're watching Bloomberg TV.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal-making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones, but we can't say that in Bloomberg.
Maybe moxie?
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're an asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, Ready? Go.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
So here's the tone of the stock market right now, just a little bit softer. We're negative by 1/3% on the S&P 500. Similar move on the Nasdaq 100. Don't forget the Friday, the biggest one-day gain on the S&P going back to November. So the best day of gains so far this year, but not enough to erase that weekly loss. 4 consecutive weeks of losses on the S&P 500. The longest weekly losing streak going all the way back to August of last year. If you set up the bond market, the 2-year, 10-year, 30-year, when you see moves like last week in the equity market, you'd expect a bid in fixed income. You did not get it. Yields were higher on a 10-year by a single basis point. Lisa, the 10-year this morning down 428.
To me, this was the most notable aspect of last week. You could argue it's stagflationary light getting baked into the market expectations. You could also make an argument that this is Germany boosting yields globally because they are going to be borrowing so much money as they intend to have a fiscal injection both into infrastructure as well as defense spending. Nonetheless, there is an ongoing belief that bonds will not be the same kind of buffer at a time where the Fed is somewhat hamstrung from the fact that inflation expectations aren't coming down as quickly.
That's been the story of March so far, with the S&P 500 down around 5% on the month, and bond yields on a 10-year up by close to double digits, even with that decline in equities. Lisa mentioned Germany, so let's finish on foreign exchange and take a sneak peek at the euro this morning. Euro dollar and a new forecast over at SocGen. Kick Jukes looking for 113 in 4Q. Only 2 months ago, we were looking for parity at a lot of houses across Europe. Euro dollar this morning, 109.09.
And a lot of people making the argument that the gains that we've seen so far in the euro versus the dollar have been on the potential fiscal spending, not on potential weakness in the United States. When that starts getting factored in, suddenly that delta gets even bigger.
Key vote for spending in Germany. That vote starts tomorrow, so look out for that. We'll have coverage for you. On our radar this morning, President Donald Trump saying reciprocal and sector-specific tariffs are coming on April 2nd. Trump telling reporters that in certain cases, both types of levies will apply to imported goods.
April 2nd's the big one. They've been talking about this. I thought Tyler in Washington brought up a really good point. Something Scott Besson said over the weekend is it's not just April 2nd. Also look at June 30th. Basically putting the time frame on what will likely be a negotiation. Besson said either tariff barriers come down and the U.S. can export more, or they don't come down and then the U.S. is able to use those revenues. They're trying to at least project that this is going to be a win-win scenario, even though we are seeing it hit sentiment and consumers and, of course, the market.
The most important thing to see on April 2nd, does it give some certainty to consumers and to corporations? Does it give a sense of what the architecture of this tariff deal is? I see out of the corner of my eye you shaking your head. I think a lot of people are saying the uncertainty isn't going to go away, and the uncertainty tax people are trying to grapple with, as well as the framework that we may get.
I just find it hard to have this certainty on April 2nd if already Scott Besson is saying also look at June 30th. It already tells you that this is Trump in full-on negotiating mode, which he has been since he entered office.
And as you've said repeatedly, this is a feature and could be a feature of the rest of his second term. Let's talk about the foreign policy effort. The president saying he'll speak with Russian President Vladimir Putin tomorrow to discuss ending the fighting in Ukraine. Trump telling reporters there is a, quote, a very good chance for a deal, and much of the discussion will be about territory.
So they're discussing already what kind of territory, land. Trump keeps talking about power plants. I imagine they're talking about Zaporizhia, which is the biggest nuclear power plant in Europe. Russians have been holding it since the middle of 2022. One thing that is interesting following this meeting is I want to see signals of when these two individuals could meet, because I had reporting months ago, and at this point now, that they were aiming for an end of February meeting. Well, we are now in March. Steve Witkoff has made already 2 meetings there. When are these two leaders potentially going to sit down?
In the meantime, Russian assets are rallying. And guess what? The OECD came out today, this morning, and improved Russia's 2025 GDP growth forecast to 1.3% from 1.1%. Key question is, how does President Trump and the administration go about doing this while having a deal that is unfair equally, where people are equally unhappy with the outcome at a time where it seems like there's a bit more leverage, at least on the Russian side?
We'll speak to the OECD in about 60 minutes' time, so don't miss that conversation. Wanted to get the latest data out of China because the data was pretty decent. Chinese consumption, investment, and industrial production coming in higher than expected to start the year as the country braces for more tariff pain. Retail sales increasing 4% in the January-February period from a year earlier. That's the most since October.
And it should give people a boost of optimism. But you heap on top of that some of the rhetoric from Chinese authorities about their growth plan. And they're saying all of the sweet nothings that everyone has been waiting for so long, which is we want to boost consumer spending. We want to revive people's income so that they can go out and actually fund this economy. And that's giving people a lot of excitement, which is a reason why you're seeing a pretty positive response in equities.
Then you get into the policies, and the policies less impressive.
Yeah, they don't really do anything.
Right? Nothing at all.
But it sounds great.
Also, the property market remains under immense pressure and unemployment is rising. So even though there are maybe some exciting things going on in China, when it comes to what is happening, when it comes to property and unemployment, it's still not a great game.
That's the latest over in China. Let's bring it back to the United States and turn to the U.S. consumer. Retail sales due at 8:30 Eastern Time. The report coming after a disappointing UMich consumer sentiment survey dropped going into the weekend. Airlines leading the way as corporates start to lower guidance. Delta, American, and Southwest slashing their outlooks, citing weaker than expected demand. Stephen Trent of Citi, still optimistic on the sector, writing the main risk seems to be top down. When and how do we get clarity on the government's plans on tariffs, trade, and foreign relations? Stephen joins us now for more. Stephen, good morning. Good to see you.
Same. Thank you for having me.
I think we've got to start with the downgrades to the outlook for the first quarter that came from some of the airlines, and it was kicked off by Delta just last week. Ed Bastian used the T word. The T word's a scary word on this program. Transitory. Transitory. Just how transitory might this be?
Great question, and I think it's too early to say. So you did have a lot of noise in 1Q. Certainly, as you guys said, the airlines really dislike this uncertainty. So when are we going to get clarity on tariffs, on Dodge cuts, and what does all of this mean for demand? I think that's too early to say. During this quarter, at least so far as well, you did unfortunately have several high-profile aviation accidents. All but one of them were fatal. That is also something that you can't ignore in these short-term moves. But I think overall, what confidence do we have 6 months from now? I think it's way too early to tell. And the underlying fundamentals still look positive.
So let's gut check ourselves, because before we get carried away with too much negativity, not that I would ever be accused of that, I am wondering if it really was all that bad, what some of these airline executives were projecting.
Yeah, so look, I think if you look to your point, nobody so far has changed their full year guide. I think they're also in a wait and see mode to some extent where things go. Are we going to wake up a month from now and we'll have a little bit more clarity after this April 2nd bogey that Mr. Bessemer mentioned? Are we going to wake up and have some wild headline about Greenland and nobody wants to travel? I think it's too early to say, and it's a little too hard to put math on that today. But the underlying fundamentals still look positive. And I think the airlines telegraphed that by not making any cut to the full year guides.
There was a real question about how much of this was driven by consumer discretionary spending, people who might be worried about losing their job, versus companies really pulling back, saying, hunker down, study, you have got nothing to tell any of the clients.
Yeah, look, I think those are all potentially legitimate drivers. I would add to that what's happened on the government level, which is not the largest piece of travel, but with DOGE kicking in, less government employment, I would imagine they're also being stricter about who's allowed to go on business trips from these various agencies. So I think all of that stuff is relevant.
They certainly are. I hear that anecdotally, but also we saw it with United. Who is most vulnerable to that, those government contracts, those government flights?
Yeah, certainly United had not a massive number, but American United sort of talked about having a smallish percent of revenue associated with U.S. government travel. So I don't remember exactly off the top of my head, but very low single digits, I think, in the highest case.
So not enough to pull routes?
No. But you also have to consider some of these markets where the government serves. So Washington, Reagan, of course, where we just had one of those awful accidents. The FAA had actually added a little bit of flights into that corridor recently. So you have a difference in terms of how much flow you get from some of these government employees and what kind of economics you get on them. So they were small numbers. But I think the question is, when the dust clears in all of this, how big are they going to be? We don't really know yet.
You also mentioned fuel prices in your note. A lot of banks are now cutting their forecast to Brent. How much is that going to be very helpful right now for the airlines?
Yeah, so I think lower fuel prices are helpful, and fuel's sort of a funny thing. Fuel prices that are too high are bad news. Fuel prices that are too low, also bad news. The latter signals a recession, for example. But where we are today with WTI in kind of the high 60s or thereabouts, it's at a level where it's not really doing any damage, or it's not dangerously cheap per se. And it did come down from levels where we're going to see lower unit revenue, at least short term. So it's actually good to have a little bit of tailwind from fuel today, but I guess if fuel and crude started to fall wildly, that wouldn't be the best signal in the world.
So I think a couple of things we're still talking about. One, did the weakness in February spill over to March? And within the weakness, is the premium segment, the international long haul, still holding up?
Yeah, so what we see so far, international long haul is still strong. You have a dearth of new equipment per capita in that space. On the wide body side, you really only have with Alaska, you have 4 U.S. airlines that have any wide bodies, really. And loyalty and co-branded card, the same. Domestic's been the main place so far that's been a little bit soft. And, the indications so far is that should at least continue somewhat into March, but too early to say what's going to happen on the month.
Let's finish on domestic. What happens when you start charging for bags? What happens?
Yeah, it depends who you are.
What if you're Southwest?
Yeah, look, so I think on one level, if you're a carrier that's for decades been dealing with passenger flow that is elastic in terms of demand, it's a give and take, no? So I think what you're going to pick up and check bags, you're also going to run some risk of sending some passenger flow away to somebody else. And that also makes you arguably less distinct against basic economy of one of the big three. You're now offering something similar to them, and they have a massive network versus you if you're Southwest.
Next question, why did they do it? What's the logic behind it?
So I think for the discount airlines, there has to be some kind of change, strategically speaking. I think these post-pandemic structural challenges, the way consumers purchase tickets and decide to travel, all of that's changed. We no longer have enough air traffic control capacity per capita to allow these discount carriers to just lay a bunch of capacity and maintain really high block hour utilization. They need to do something on the unit revenue side. So is this going to be the fix? I don't know.
Just quickly, top pick right now for the sector. What is it?
Of the U.S. airlines, United's my favorite one, and then American Airlines and Delta.
All three then? All three of the big players?
We're fans of the network, guys. And they have everything they need to win. We just need the consumer to have a little bit more calmer water.
we'll get another read on the US consumer at 8:30 Eastern Time. Stephen Trent, good to see you, as always. Stephen Trent there of Citi. US retail sales, the next stop for this market. That comes later on this morning. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. A severe storm system over the weekend spawned tornadoes, dust storms, and wildfires that killed at least 36 people. The storm is moving into the southeast and mid-Atlantic, bringing thunderstorms, hail, damaging winds, and the potential for more tornadoes. Forecasters are warning of dangerous winds from Florida to New Jersey. China consumption, investment, and industrial production exceeded estimates in both January and February. China's pro-growth pivot in September fed economic momentum, but the Trump administration's tariffs threatened to halt that growth. It wasn't all good news in the data. The property market stayed under pressure and unemployment rose. Elsewhere, Oracle is accelerating talks with the White House on a deal to run TikTok. Politico reporting that the U.S. administration has significant concerns about what role the app's Chinese founders will play in its ongoing American operation. Vice President J.D. Vance says that he expects President Trump to wrap up a deal for the app ahead of next month's deadline. And that's your brief, John.
Hey, Danny, thank you. More from Danny later on this morning. Up next on the program, the White House isn't blinking.
Corrections are healthy, they're normal. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great.
Up next on the program, we'll get the market view from Lotfi Karui of Goldman Sachs from New York City. You're watching Bloomberg TV.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think at all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
equities off session lows this morning. We're lower by only 0.2% on the S&P 500. In the bond market, yields a little bit lower as well, down by 2 basis points, the 10-year 428.70. Under surveillance this morning, the White House isn't blinking.
Corrections are healthy, they're normal. What's not healthy is straight up, that you get these euphoric markets, that's how you get a financial crisis. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great. We are going to have a transition, and we are not going to have a crisis.
So here's the latest this morning. The Treasury Secretary, Scott Bessent, reiterating the administration's focus is not on the markets, leading some investors to revise their outlooks. Lofi Karui of Goldman Sachs looking for wider credit spreads, writing, since the first tariff headlines broke, our message has been simple. Add hedges and brace for some rebuild and risk premia. Lofi joins us now for more. Lofi, good morning. It's good to see you.
Good morning. Good to see you.
I want to go back several months. I want to go back to the note you put out at the end of 24, going into 25, where you highlighted just how severe the valuation constraints were coming up into the new year. How much of a role do you think that's played in some of the shakeout we've seen so far?
A little bit. Obviously, when valuations are expensive, you don't have a lot of room to stomach these big shocks. But back then, actually, our message was that, yes, the market is expensive. Add hedges, add downside protection, and then wait for any signs that things are shifting, either fundamentally or from a technical standpoint. What we've learned the last 3 to 4 weeks is that things are actually shifting fundamentally. But the trade-off between growth and inflation is, in our view at least, heading into a direction that is unfriendly to risk assets. And so you have to realign yourself with that, and you have to push spreads a little wider.
Things are changing fundamentally when it comes to sentiment, when it comes maybe to demand that we're hearing from airlines, as we were just talking about. Has it really shifted, though, with the creditworthiness of these companies that have locked in borrowing costs for a long time and still seem to have healthier balance sheets than they have historically?
It depends where you look. If you're talking high-quality, IG-rated companies, probably not. I mean, if you implement tariffs, at the end of the day, it's probably worth a couple of points of declines in earnings. That will shift your credit metrics a little bit, but not too much. Where this will make a difference, in my view, is in the very low end of the high-yield market, where we ended the year with tight spreads in hopes that actually the economics of refinancing for some of these over-leveraged capital structures have gotten better. Now, I think what you'll see is spreads moving wider and that economics of refinancing getting a little bit more challenging again.
We just saw a week of the biggest widening in credit spreads going back to last summer's volatility. And I just wonder, is this a repricing of risk, to your point about valuation late last year? Or is this the start of something more significant where people shift maybe to places like, say, Europe and European credit over the United States?
This feels a little different to me relative to late July, early August, where we were actually pounding the table to buy the dip back then. This feels a little different because you need time to process what is effectively a meaningful dose of uncertainty that's been injected in the economy. The starting level for spreads is also very tight, and so it's not like you are being paid actually for this type of shocks. Europe has already outperformed, actually. Europe has had a phenomenal start to the year, both in credit and in equities. I guess I would describe European credit as basically being in the same situation as U.S. credit, 3 months ago, back to that valuation conundrums. So I think it's going to be very hard for Europe to continue to tighten in absolute terms. In relative terms, I think Europe will outperform the U.S.
There's this question at a time when the U.S. is potentially entering into a difficult patch of whether credit still has the canary in the coal mine aspect that it used to, whether it still kind of can forecast the sense of disruption in the fundamental economy that it had the reputation of doing 10, 20 years ago. Has that signaling mechanism been broken?
Yeah, I think that reputation comes entirely from the playbook of the global financial crisis. I don't think things will play out that way this time around. And so what we've seen now is literally credit moving in locksteps with its sort of empirical or beta relationship to the equity market. And so people complain all the time, well, actually credit has not moved. That's not true. We've actually repriced in terms of the change in spreads. If you look at the change in IG that would be implied by an 8.5%, 9% move in the S&P, it's exactly what you've gotten the last 4 weeks. And so it looks like credit is resilient only because the starting level is so tight. But if you look at the change in spreads, it's been commensurate, I would say, with the move in equities.
When John was talking about your note, you talked about the first headline from Donald Trump when it came to tariffs.
Yeah.
Why now? Trump has talked about this from the very beginning, and we knew this was one piece of his broader plan.
Why now? Great question. I think what we've learned is that the administration has greater tolerance for a move lower in the market and even a full slowdown in the economy. To me, that's been the most critical piece of information that we've learned. And then valuation has remained very tight. The two other things I would add is that, and this is a big difference between today and 2018. In 18, rates were very low. They're not today. Actually, you get paid 4%, 4.25%, to invest in cash. And so you have a very valuable degree of freedom. Duration has rallied too, from a peak of 4.75 roughly to 4.25, but can rally more if you have an even bigger slowdown. And so to me, the urgency to buy the dip today is just not there.
I think we all remember December 2018 when the credit market totally froze up. I think that month for high yield, we got zero issuance in December 2018. Is there anything like that happening right now? Anything that would concern the Federal Reserve going into this two-day meeting starting tomorrow?
I think they'll most likely be in wait and see or on the sidelines. We'll learn, in terms of what they do with their own projections, how much they'll push inflation up and then how much they'll push growth down. But at the moment, like us, my guess is that they're processing this flow of information and trying to assess what they will do. Now, the market is pricing in, I think, 2 cuts for this year. That seems quite reasonable to me. You're pricing in 2 cuts not because you think we're going to make progress on inflation, but you're pricing in 2 cuts because you think the Fed will probably adopt some kind of an insurance cuts type of framework, exactly like they did actually in 2018.
Is the primary market still open for deals? We saw some headlines in the last week or so.
Risk aversion has gone up, and so the market is open 100%, but new issue concessions have gone up, and so, issuers have to pay a little bit more relative to the secondary to access the primary market. That's actually in and of itself, it's a healthy thing, because if you reduce supply, you kind of rebalance the market a little bit, and you bring stability to the secondary market.
What are you waiting to understand the depth of what kind of correction we could see, or whether this is going to become something that you can opportunistically go into?
So at the single name level, I would say you're already seeing some opportunities. I mean, certainly the primary market is one way to deploy capital and harvest a little bit of alpha. But what could change my view, look, 2 things. One, you get a valuation reset. So actually you front load a lot of damage, you price it in, you make spreads interesting, then you revisit the conversation. The second thing, I think we need to remember that in the administration's policy agenda, there's a lot of things that are pro-growth. And so if you recalibrate actually that policy mix away from some of the stuff that is actually negative to growth into some of the things that are positive for growth, tax cuts is a good example, deregulation, et cetera, then I think you have a different conversation and you would look at this market a bit differently.
I sense that's still the strategic anchor of a lot of the bulls out there, that the overall policy mix is still pro-risk, pro-growth, and in 6-9 months' time, things might look a little bit different. That's the hope anyway.
The first half of the year is Biden data, and then when Trump data comes into play...
We were told that.
Yeah, then there's going to be a policy mix that's more supportive to things going better.
Lofi, it's good to see you. Thanks for breaking this down. Sharp as always. A clinic on credit from Lofi Karui there of Goldman Sachs. Equity futures right now in the S&P are raising losses, down by just 0.2%. Up next on a program, Bob Elliott of Unlimited, Henrietta Trays of Veda Partners, the OECD Secretary General Matthias Cormann, and Sam Zeef of JP Morgan. From New York City, the second hour of Bloomberg Surveillance. Up next.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zay Poland he did come to me and Susan O'Malley, and they said, Abe Polson says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
We don't know what the pass-through of expected and actual tariffs will be.
The tariff policy on again, off again is impacting the sentiment of consumers.
Tariffs, of course, also in particular impacts anyone who is associated with trade with Canada and Mexico.
Tariffs are going to raise prices, and middle and lower income consumers have to bear more of the weight.
It's going to be very tough to pass this to consumers because the consumer is highly elastic in terms of looking for alternatives.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now. Your next stop for this market, 90 minutes away, 8:30 Eastern Time. U.S. retail sales, another read on the U.S. consumer. Then later this week, a Federal Reserve decision with Chairman Powell, a news conference and forecast. Going into all of that, equity futures erasing this morning's losses, still negative by about 0.2% on the S&P 500. Following 4 weeks of losses, the equity bulls need some better data.
And they need some better data from the companies themselves, who last week indicated that demand has rapidly fallen off a cliff. It raises a question: where is the market most asymmetrically positioned heading into retail sales? For a quickly deteriorating economy where people are stopping spending, or where people are potentially, really hanging in there a little bit better than people expected?
The soft data is soft. The guidance coming from the likes of the airlines, not great. We'll see if we get this at 8:30 Eastern Time. Will that confirm some of the gloom that we've seen in various places across various dimensions over the past few weeks?
Stephen Trent said that some of that weakness has carried into March. We've heard those ongoing warnings for a number of companies. That said, can we say it's still too early? Or are we going to start to see it bleeding into the hard data? Torsten Slok of Apollo last week came on and over the weekend put out a note where he said, expect it to start bleeding into the hard data. At that point, how much more of a downside does this market need to price in?
I know that you, Mitch, is tainted by political views.
It triggers
and we know
people.
There's some problems with that survey, and we know it triggers a lot of people, but the headlines coming from Friday, that was a very ugly read. The weakest read we've seen going back to November 2022. Inflation expectations, long-term inflation expectations, pretty ugly. And then you've got this anxiety around unemployment, which is something that Neil Dutter of Renmac would talk about a little bit later. Anxiety around unemployment started to climb.
Anxiety around unemployment, anxiety around what is going on in terms of policy. This was coming out in the statement. And when it comes to the politics, Jonathan, regarding it, what you heard from the University of Michigan is that consumers from all three political affiliations are in agreement that the outlook has weakened since February. Long-term inflation expectations, 32-year high. This is challenging right now, especially ahead of retail sales.
This does trigger people. I mean, I just want to put that out there. I put out a note about the Inmish survey on X, and I got a lot of hate mail saying, oh, super liberal survey, because people say it breaks down between partisan parties. But what you did see when you dug under the hood was that deterioration was widespread, and it crossed party lines, albeit from a very low base among Republicans. But independents also saw that deterioration and increased their expectations for inflation. All this said, it's going to be difficult for the Fed to justify cutting rates proactively if long-term inflation expectations are creeping up.
There is a political bias in you, Mitch. With that, I don't think we can disagree. That's just the reality of the survey. But I don't think there's a political bias over at Dick's Sporting Goods or American Airlines or Delta, for that matter, over the last few weeks. When they tell you the business is slowing down, I don't think they say that because they like Joe Biden or don't like Donald Trump. I think that's because the business is slowing down.
The real question going forward, Neil Dutta actually addresses this really well, is how much is this slowdown going to bring down prices or continue the disinflation, or do we see that inflationary, stagflationary-like price action that we're seeing right now in markets? Do these companies pass it along to consumers? They spend less but pay higher prices, and that keeps inflation pretty sticky.
Equity futures right now erasing this morning's losses very slowly and then quickly all at once. We're down by just 0.1% now on the S&P 500. Coming up this hour, we'll catch up with Bob Elliott of Unlimited, with markets looking to recover following another week of losses. Henrietta Trays of Veda Partners as President Trump reiterates more tariffs are coming, and the OECD Secretary General, Matthias Cormann, as the organization cuts its global growth forecast. We begin this hour with stocks pushing lower, as Treasury Secretary Scott Bessent says that recent corrections are, quote, healthy. Bob Elliott of Unlimited staying cautious, writing, it's important to note the S&P is back to about where it was in October. A recession is not being priced in. Bob joins us now for more. Bob, good morning. Good to see you.
Good morning.
How would you describe this repricing that we've seen over the past month?
Well, I think what we've done is we've wiped away some of the post-election euphoria that this was going to be, you know, the most pro-business administration in the post-war era, and we were going to have an economic boom. People are tamping that down and basically so far saying, okay, disinflationary boom probably not going to happen, but they're still pricing in pretty good growth conditions in the face of what is a mix of policies that's very growth negative over the course of the next 6 to 12 months.
Mike Wilson of Morgan Stanley publishing coming into the new week saying this is not just about tariffs, it's about other issues. Do you agree with that?
Well, I think it's about the complexity of the whole mix of policies that are here. In many ways, we're seeing sort of a wrecking ball of policies with weaker immigration, tariff policies, cuts and significant pay-fors that are probably going to have to happen in order to get the TCJA passed. And that combination of things is all quite growth negative. And then on top of it, you're seeing a Fed, which is, you know, pretty handcuffed here to respond to any growth weakness that they're seeing. And so that combination of things with an administration that, at least so far, doesn't look responsive to equity market weakness is a pretty bad combination for growth prospects and equity markets ahead.
This is a pretty bearish view. How bearish are you? How much more downside do you see?
Well, if you just look at how much, you know, stocks have outperformed bonds on a risk match basis over the last 3 or 4 years, the U.S. exceptionalism trade, you know, we've corrected 5 to 10% on something that is outperformed by several 100% over the course of 5 years. If investors start to question whether U.S. exceptionalism is the path ahead, there can be considerable repricing that we see in the market.
And something that you pointed out is you see bonds actually outperforming stocks this year, which was a sort of a reversal of what we've seen for the past few years. And yet you do see the Fed constrained. So this isn't necessarily that bonds are performing so well, but rather that stocks are performing so poorly, no?
Well, I think last time I was here, Secretary Bessent was in just ahead of me, and he said he was looking for bonds going down, bond yields going down, you know, every week. And since then, he's gotten stocks going down 4 weeks in a row and kicking off the week going down further. So he might be getting his bond rally, but as I said then, it's for bad reasons, not good reasons.
When was the last time that you saw a mix like this?
This is a very challenging policy mix. This significant growth negative set of policies. I mean, really the last time that we saw such growth negative policies relative to conditions was coming out of the financial crisis, where, you know, we had the Tea Party efforts to constrain fiscal spending at a time when, you know, we needed significant stimulation. Now, of course, the economy is stronger today than it was back then, but that push, that sort of exogenous push, for growth negative policies is similar to that period. And that was a challenging time for Wall Street and also Main Street.
We've heard this a lot from various investors, but their assessment seems to be the following, that the policy mix becomes more positive as the year grows older. Do you disagree with that?
Well, if anything, it's going to take some time to get these policies in place. I mean, particularly the negotiations over appropriations for the next fiscal year, which will happen over the course of the next 6 months, will give us a view into whether there is going to be meaningful cutbacks in terms of government spending and any efforts to really balance or get close towards balancing the budget. I think the thing that's interesting is that budget policy that was passed suggests, several $100 billion a year worth of pay-fors for the TCJA extension. You put that into the budget combined with, some DOGE cuts and things like that, that is definitely likely to cut the overall spending picture in, the next fiscal year.
But Bob, they're talking about maybe getting reconciliation done by Memorial Day. I mean, that's 2 months.
Yeah, and if that's true, then what's going to happen is you're going to start to see that get priced into the market. I think in part what we've seen in the last couple of weeks is not only are we seeing significant policy uncertainty, and that is causing basically anyone with any sort of risk or levered position to cut back on their positioning, but that tilt that we're seeing is increasingly seeing expectations that the new administration is very committed to this set of negative growth policies, and that'll start to get priced in not when the spending happens, but when we actually start to see those policies enacted.
Is the extension of TCJA not enough?
It doesn't do anything. That's the big thing. While the political rhetoric will call this tax cuts, from an economic perspective, it makes no difference. And the reason why that is it's current law. And given that it's current law, simply extending current law avoids what would have otherwise been a big tax hike, which would have been growth negative, but it is not a growth positive on its own.
Would we still have this volatility in the market if Kamala Harris had won? We were sitting here debating whether or not tax hikes would be going up at the end of the year.
I have no idea what we would be if Kamala Harris was in office, but what I do know is the concern, the volatility in terms of a policy perspective is really about the totality of all the policies. And really, I think in the last couple of weeks about the tariff policies. I mean, what is tariff policy over the course of the next 3 to 6 months? Is it 25% tariffs on our biggest trading partners, or is it zero? Because it's been both over the course of the last 30 days. And if you're managing money or running a business, the only thing you can do in that sort of circumstance is pull back, cut back. And that's why we're seeing a broad-based cutback in confidence, not just in the Michigan surveys, but we're also seeing it in CEO confidence, which is now at the weakest level it's been in more than a decade. And given that, it's going to be very hard to get those sort of animal spirits that are hoped for to really continue this economy right now.
Step up Chairman Powell. If things are as bad as you say they are, why isn't he prepared to step in sometime soon?
Well, he is really handcuffed by the inflation picture. I mean, while the headline numbers for PPI and CPI came in below expectations, the PCE expectations continue to be elevated. They're too hot for him to continue to cut. And let's be honest, I don't think he necessarily cares too much if he can hang weaker economic conditions on the new administration.
Just jump in. How unusual is it to see inflation expectations climb against the backdrop of lower energy prices? How unusual is that?
Well, it's pretty unusual, but it's also pretty unusual to shift tariff policy up from essentially, close to zero, multi-decade lows, all the way up to the highest levels since Smoot-Hawley, right? So that is getting priced in. People are digesting that, and that has a meaningful influence on what you're seeing in those expectations.
So are you one of those people going to the Bank of England and loading up a suitcase with gold bars, sticking it on the airplane and going home and hiding?
Well, I certainly couldn't carry a whole suitcase worth of gold bars.
All right, well, what are you doing?
But paper gold looks good in this sort of scenario, and it's a little lighter to trade. Looking at assets that are going to do well in a lower growth environment, particularly relative to stocks, things like bonds and gold relative to stocks, and weaker dollar in the circumstances. The U.S., we haven't really talked about the global picture, but the U.S. is tightening and engaged in growth slowing behavior just at a time when globally we're seeing out of Europe and out of China a real push to reaccelerate those economies. And that will really call into question whether or not the U.S. exceptionalism trade, should continue. And there's a lot of capital that hasn't repriced that trade.
Can you imagine the excess baggage fees, Southwest, trying to move gold around the country?
Well, can you imagine? I mean, the workers' comp for people's backs having to lift that stuff.
Have you ever held a gold bar?
I haven't.
Ridiculously heavy. Just ridiculously
heavy. I mean, we heard about this. It affected GDP expectations for the first quarter.
Absolutely wild. Bob, it's good to see you. Appreciate a catch-up. Thank you, sir. Bob Elliott there of Unlimited. Equity futures just about negative on the S&P 500 with an update on stories elsewhere this morning. With your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John. At least 36 people have died across 6 states since a massive storm system moved across the U.S. starting last week. And another round of storms swept into the eastern U.S. yesterday. The National Weather Service says that severe thunderstorms will bring damaging wind and a few tornadoes this afternoon and evening. Elsewhere, U.S. Defense Secretary Pete Hegseth says that strikes on Houthi militants in Yemen will be unrelenting until the group stops attacking ships in the Red Sea. Donald Trump ordered a new wave of airstrikes over the weekend. Hegseth said that the latest strikes are also warning to Iran, which backs the Houthis. CEOs of some of the world's largest companies will be heading to Beijing next week, with some planning to meet President Xi Jinping. Sources tell Bloomberg that plans are being made for the heads of Qualcomm and Saudi Aramco to meet with the Chinese president. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. Up next on a program, the president doubles down.
April 2nd is a liberating day for our country. We're going to be getting back some of the wealth that very, very foolish presidents gave away, because they had no clue what they were doing.
Henrietta Trace knows what she's doing. She joins us next from Vader Partners from New York City this morning. Good morning.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Equities just a little bit softer here, down by 0.1% on the S&P. Bond yields a little bit lower, down by 2 basis points, 429. So far, not much drama. In the FX market, 109.07, positive by 0.2%. A new call from Kit Jukes over at SocGen, looking for 113 on euro dollar. That currency pair has moved very, very quickly to start the year. That currency pair this morning, positive by 0.25%. Under surveillance this morning, the president doubles down.
April 2nd is a liberating day for our country. We're going to be getting back some of the wealth that very, very foolish presidents gave away, because they had no clue what they were doing. We're going to be getting back a lot of the wealth that we so foolishly gave up to other countries, including friend and foe.
So here's the latest this morning. President Trump pressing ahead with his tariff agenda, confirming reciprocal and sector-specific tariffs will begin in just over 2 weeks' time. Bloomberg's Tyler Kendall joins us now from Washington with more. Tyler, just how misleading is that April 2nd date? How much longer could this all take?
Well, John, it could take months potentially after that. We heard from Treasury Secretary Scott Bessent over the weekend telling us that we should really be looking at a range from April 2nd to, he said, in his words, say June 30th, the end of the second quarter, for those tariff negotiations to go up and down. And it really, after these comments from President Trump over the weekend that he is going to pursue this more aggressive tariff approach, potentially stacking those reciprocal tariffs on top of sector-specific tariffs, we'll have to see how that impacts negotiations with our trading partners, as many opted for talks instead of large-scale retaliation. Importantly, President Trump also there, as you heard him, he alluded to the fact that we are already starting to see tariff revenue come in from the tariffs that have been implemented. Now, we don't have specific numbers, but I do bring it up because we often talk about tariffs as a revenue raiser going hand in hand with implementing President Trump's tax cut agenda. Senior administration officials keep pointing us to the fact that when there is tariff uncertainty, this is all about a longer-term growth agenda. John, Bloomberg News reporting that some in President Trump's orbit are pushing for that tax cut agenda to get done by May. Our read on it is that that is highly unlikely. It does go to show how officials are trying to get more money into consumers' pockets as these indicators that we often watch, like consumer sentiment, the 5 to 10 year inflation expectations, do sour. And while we talk a lot, John, about this potentially higher tolerance that we're seeing from this administration when it comes to market volatility, we're going to start to see a lot of opinion polls come out rating this first few months of the Trump administration. We'll have to see if that serves as any counter to this administration's policies.
Tyler, when it comes to the tariffs, do you get a clear sense if they're a negotiating tactic right now by the administration or they truly are going to be revenue raisers for their tax agenda?
Well, Anne-Marie, this administration is trying to push that it could be a win-win here either way. And they've often pushed that tariffs accomplish a multitude of goals. For example, if we go back to the original tariffs against Canada and Mexico, that was for the border policies. Then steel and aluminum last week is trying to accomplish the national security items, which we're also going to see that rhetoric come back up again with those sector-specific tariffs, particularly when it comes to chips and autos on April 2nd. But this administration really pushing that at least the first step is to rebalance trade, try to get back to an even playing field, and then they will take it from there, particularly when it comes, if they don't lower those tariff barriers, then the positive could be that they will have this revenue raiser, which is going to be important to that long-term fiscal agenda that we keep hearing about.
Tyler, appreciate the update. Tyler Kendall down in Washington, D.C. Tyler mentioned briefly opinion polling. We had some over the weekend. And the standout wasn't about the president. The standout wasn't about the economy. The standout was just how poorly the Democratic Party are polling in this country right now.
I think it's one of the worst polls they've had ever when it goes back to NBC polling. They can just not get it together. And the infighting was on display last week. And this poll was done even before that infighting started. And Chuck Schumer said, okay, we're going to allow the Republicans to pass through this continuing resolution to keep the budget open, which you've seen a tremendous amount, the government open, tremendous amount of pushback, especially from House Democrats.
27% of registered voters view the party positively in an NBC News poll. Unreal. Joining us now to build on some of these conversations, Henrietta Trey's of Vader Partners. Henrietta, welcome to the program. Overall, I would say on net, the people that come on this program don't like tariffs. There is some pushback sometimes, but on the whole, they don't like them. The market participants, they do like tax cuts. Now, we're trying to understand whether we'll get those corresponding tax cuts anytime soon.
Well, if you listen to the White House, they're trying to bill the one thing that is happening here, tariffs, as tax cuts. You know, when Peter Navarro and other economic advisors in the White House come out and say that tariffs are tax cuts, that's obviously, you know, either you're lying to yourself or you're lying to me, but it's not correct. And that's the problem that we run into, because the same is true on the tax cut side. As your previous guest was discussing, the bill that they're trying to pass, you know, by Memorial Day, whenever it passes, I don't care, they're extending the status quo. So there are no tax cuts even built into the $4.6 trillion tax bill that they need to pass this year. So there are tariffs and there are not tax cuts. And when you sell tariffs as tax cuts, you create a pretty material disconnect between the consumer, who is confused now about what they should be expecting, which is why you see pullback at the big box retailers and people delaying big purchases, which is what's, leading to that soft data that's so problematic right now.
Henrietta, what happened to the carrot and stick approach when it came to tariffs and corporate tax rates? I thought if you produced in the United States, potentially you could get a 15% corporate tax rate. Where did that conversation go on Capitol Hill?
That conversation is nowhere right now on Capitol Hill. Each percentage point reduction in the corporate tax rate costs $150 billion. So as I mentioned, we're already at $4.6 trillion just for the status quo. We got to fix the SALT cap, even just to raise it up to $20K for couples filing jointly. We have to extend the child tax credit. The president wants to do things like eliminate taxes on tips, which is itself $175 billion. We do not have the money for a 15% corporate tax rate. And even if you did, I'd like to relay that the Republican conference and members up there do not support additional tax cuts for the business community. They view the 2017 tax bill downfall. The one piece that was really unpopular is that the corporate rate cuts were permanent, and all the individuals in the United States are now subject to a tax increase at the end of this year because of the 2017 bill. So there's not a lot of appetite for tax cuts at the corporate level.
So Henrietta, what kind of extras can we get? Do we get no tax on tips, no tax on Social Security? What could Trump put on this to make it more than just an extension of TCJA?
That's a great question. The no taxes on Social Security is physically not possible. They're not permitted to address Social Security in any capacity using reconciliation instructions. So that's entirely off the table. And just so we're clear, the cost of doing that would be $1.8 trillion. So if it was not physically impossible, it's definitely monetarily impossible. The no taxes on tips piece doesn't have a tremendous amount of support because there's not been enough education or discussion of how to rein that in so that you don't avoid, a CEO saying the $1 million that I made last year is actually just a tip and evading taxes. So they don't have the logistics worked out for that. And then in addition, that's not a universal tax cut for all individuals. It's only a tax cut if you get tips, which not everybody does. So it's disproportionately impactful to different states. That was a big sell in Nevada, but Nevada does not have Republican senators. So it's going to be really difficult to get that over the finish line. There's not a lot in there that can be described even charitably as stimulative. There are a couple of business-related provisions that expired in 2022 that we could provide a short-term extension of, but that's really it.
Henrietta Schrace there of Veda Partners. Henrietta, thank you for the update. Appreciate it. We've had a lot of downgrades to growth off the back of some of the policy volatility of the last few weeks, including downgrades from JP Morgan, from Goldman, from Morgan Stanley. In just a moment, we'll talk about the OECD doing exactly the same thing, dropping their growth forecast and raising their inflation outlook.
Yeah, exactly the mix that people don't want to see, and talking about the Federal Reserve not really having the ammunition to cut into potential weakness.
Coming up on the program, we'll catch up with the OECD Secretary General, Matthias Cormann, on global growth risk. Looking forward to that conversation. Check out the equity market as we go to a commercial break. Equity futures just about negative by 0.1% on the S&P 500. In the bond market, bond yields just a touch lower, down by 2 basis points of 4.29. The next stop for this market, US retail sales in about an hour from now. The last major data point, the last read really on the US consumer going into the Federal Reserve's two-day meeting, which kicks off tomorrow and concludes on Wednesday. Chairman Powell set to deliver a rate decision. No change to interest rates expected, but plenty of changes to the forecasts in store. So look out for the news conference 30 minutes after that decision. From New York City this morning, good morning.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning from our world headquarters in New York. I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday only on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
I mentioned briefly moments ago the downgrades to economic growth we've seen from JP Morgan, Morgan Stanley, and the like. We've also seen downgrades to the equity market view as well, from HSBC and Citi, and more recently from Goldman Sachs and David Costin dropping their price targets on the S&P 500. Lori Calvasina follows today from RBC, cutting the price target on the S&P for year-end from 6,600 down to 62. With that in mind, equity futures right now are raising some of those losses. We're negative by 0.2% on the S&P. On the Nasdaq 100, we're softer by not even 0.1%. Let's get you some morning calls, some morning movers. We can do that with Yahara Hackers. Hey, Yahara.
Hi, John. We start with NVIDIA. Those shares are up 1.3% as we await the company's giant AI conference, which kicks off today. But the big event will be tomorrow with Jensen Huang's speech, where he's expected to unveil more details about future versions of its AI chips. But as we know, a lot is riding on this moment because this year has not been kind to NVIDIA. It has also not been kind to our next stock, which is Tesla. Those shares now are lower by 0.8% and leading the broader tech sector lower. And this I found interesting. A Danish pension fund with $20 billion AUM says it's selling its remaining 200 Tesla shares and blacklisting the company, meaning it won't buy any more shares due to what it says are growing risks posed by its founder and CEO, Elon Musk.
Yahara, thank you. That stock a little bit softer in the pre-market, down by about 0.9%. On our radar this morning, Treasury Secretary Scott Bessent saying recent market turmoil isn't rattling the White House.
Corrections are healthy, they're normal. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great.
The White House, the Treasury, they're not blinking. And going into Wednesday, a question we've all got, well, Chairman Powell.
Yeah, at the same time that we're seeing inflation expectations creep higher in a number of different surveys, you can say what you will about the University of Michigan, this is going to constrain their ability to really say we can proactively cut rates, and that's what we see in market pricing in. If that's the case, if no one's blinking, where's the relief valve for a market that's facing off with slower growth, policy uncertainty, and a Fed with a sticky Fed policy rate?
The problem right now this administration has is right now the markets, the consumers are dealing with only one part of their entire agenda, and that's tariffs. You heard from the Treasury Secretary there talking about when you look at it overall and long term, we're talking about tariffs plus deregulation plus tax cuts. Well, right now, we only have one pillar of that agenda, and that is what's making this so complicated for them.
We're talking about foreign policy too, so let's turn to our next story. The Defense Secretary, Pete Hegseth, saying U.S. strikes on Houthi militants will be, quote, unrelenting until the Yemen-backed group stops attacking vessels in the Red Sea. President Trump on Saturday ordering the first round of attacks on Houthi targets.
So Pete Hegseth, the Defense Secretary over the weekend, really made clear two things. Freedom of navigation, which we have seen basically American troops, men and women, protecting Chinese and Russian vessels, the only ones willing to go through the Red Sea. They want that to end, and also they want to restore deterrence. Your Age Group put out a note, made a very good point. We have seen attacks even under the Biden administration when it comes to the Houthis, but not at this scale. And I spoke to a number of officials over the weekend. What I'm hearing is this is likely going to be definitely days and potentially weeks, and what this administration is willing to do to set deterrence and really go after the Houthis.
I wonder how much this actually ties into the economic story. They've cited inflationary impulses from some of the shipping delays that we've seen, and we have seen that. How much is this part of that? If you open up that corridor and create the freedom of the seas, once again, that reduces some of the pressures, at least on the margins.
They were very critical of the previous administration for totally failing to provide and establish a deterrence in that part of the world. It was kind of shocking. Week on week, month on month, we saw these developments and hardly anything was done.
And maybe now commercial ships, which are going around the Horn of Africa, will actually start, to Lisa's point, use the Red Sea. Also, this is sending a clear message to Tehran and what this administration is willing to accept in terms of Tehran's support for proxy groups like the Houthis.
They have been very clear about that. Just wanted to squeeze this in from the ECB. The ECB Vice President, Luis de Guindos, saying President Trump's policies are causing more economic uncertainty than COVID did. The Vice President joining several policymakers highlighting worry about a brewing trade war. Now, sometimes we're too dramatic. I don't know what happens in our personal lives, but that is very, very dramatic to say something like that.
At the same time, we just heard that from Bob Elliott, that frankly, he hasn't seen this level of uncertainty or at least a negative growth mix going back years. It raises a question about whether there is a sort of well-oiled plan that's getting executed, or whether people outside the U.S. are correct in feeling like it's 200% tariffs one day, 200% tariffs another day that are withdrawn. I mean, it's very difficult to keep track of all the tariffs, let alone see what the overarching plan is, especially if you are on the receiving end of some of these tariffs.
I don't think you can compare this to the pandemic. Being locked in your apartment, needing a passport to go and get a cup of coffee to prove you were vaccinated.
I think that it's a different kind of uncertainty. I mean, there was sort of an existential
uncertainty. To hang out
uncertainty.
in certain bubbles with certain people. I don't know. And also the tariff plan, we don't even
certain
have
people,
yet.
What was wrong with your bubble?
True. Jonathan was in my bubble when he was in London. No offense to Jonathan, but you weren't really allowed to expand outside, the people you saw every single day. On top of that, we don't even have Trump's tariff policy. How are you throwing all these daggers at it when actually we don't have the policy?
In fairness, during the pandemic, and I'm not talking about it from a personal bubble issue, and you can talk about that all you want. I'm talking about this from an economic perspective. And back during the pandemic, there was a sense of economic cooperation between countries. And that created a sense, we'll do what it takes to actually try to revive the economy. A whole host of uncertainty. That, I think, is the aspect that is getting people concerned. What is the framework even that we're operating in?
Curious how willing they are to criticize U.S. policy and how unwilling the Europeans have been to criticize policy coming from China, particularly around the pandemic.
Couldn't agree more.
In the months and years after that. So plenty of questions for the Europeans on that front, that's for sure. Let's get to the OECD, out with its latest economic outlook, saying President Donald Trump's aggressive trade policy is abruptly setting the global economy on a path of slower growth and higher inflation. The organization saying, quote, significant risks remain. Further fragmentation of the global economy is a key concern. Joining us now to discuss is the OECD Secretary General Matthias Cormann. Matthias, welcome to the program, sir. It's fantastic to get your insight on the global economy. When you downgrade overall global economic growth, can you lift the lid on that call for us and just go beneath the surface? Where are the biggest downgrades, revisions to growth on a country-by-country basis?
Well, on a country-by-country basis, I mean, the biggest impacts that we see are in Mexico and in Canada, for obvious reasons. But if I just go back, I mean, at a global level, we are downgrading our growth outlook for this year by 0.2% down to 3.1%, and next year by 0.3% down to 3%. And I mean, it's a function of the data pointing to a weakening in the global economic outlook, but also inflation remaining more elevated than we had previously anticipated. Of course, the very high levels of policy uncertainty, which is weighing on growth, because of its impact on both consumers and investor confidence and likely future investment decisions.
Secretary Matthias, how much do you see the U.S. getting penalized just as much as the rest of the world when it comes to downgrading the growth trajectory as a result of tariffs? Or is it still the idea that the rest of the world will see a bigger hit than the United States?
Well, we do see a negative impact on the economic outlook in the United States, but it's a lesser impact on the basis that the US has a comparatively large domestic economy, of course, and trade as a share of GDP is of less importance in the United States than what it is in other countries around the world. I mean, in particular, when we look at Canada and Mexico, who have got very comparatively higher trade exposure as a proportion of their economy, but also, and in particular, high trade exposure to the US market, then clearly the impact there is somewhat more significant, but the impact is also material and negative in our outlook for the United States.
How much do you have a framework to even price in what the outlook is for trade? I mean, we were just talking about how April 2nd, hopefully we'll get more clarity. We hear from every company the issue isn't just the tariffs, it's a lack of certainty around what the policy is going to be. How do you even come up with a model for this?
Look, I mean, we are making certain assumptions, and certainly, I mean, for us, we work on the basis of what is announced and or legislated policy of an elected government. But the uncertainty in itself is certainly weighing on growth. But as a matter of general principle, what we would say is that there is, when it comes to global economic growth, when it comes to continuing to lift incomes and living standards for people in countries around the world, keeping markets open, having well-functioning global markets, having a rules-based trading system in good working order is still the best recipe. And to the extent that there are issues between countries in terms of fairness or perceived unfairness, in terms of policy issues that need to be addressed, that is best done through bilateral or multilateral dialogue rather than through unilateral measures.
To build on Lisa's point, your calculations don't account for what Trump is set to announce on April 2nd. Also, some other items he's announced, like a 200% tariff threat on European wine, cheese, and champagne coming into the United States. So after April 2nd, or maybe a few months after that, June 30th, do you think you're going to have to revise down some of your growth forecasts?
Well, we are pointing in our revised forecast today. We are pointing to significant downside risks, including, when it comes to further trade fragmentation or increased trade tensions because of further measures, which clearly would be a further negative in terms of the global economic outlook. I mean, at the moment, we can only make our assessments based on the decisions that have been made and announced so far. But if further decisions in the same directions will be made down the track, then of course we would have to revise our assessments. But on the flip side, I mean, there's also positive opportunity. If countries around the world decide to work together to resolve some of these issues, in a better, more efficient way, not relying on tariffs and other trade restrictive measures, there could also be a positive impact on the global economic outlook.
Well, one positive has been the Europeans, and they've been energized on the policy front. They're willing to spend more on defense and infrastructure, and perhaps we can finish the conversation there. That view, that move by the Europeans has been widely celebrated. Can we finish on some words of caution for them? Do you have any?
Well, look, I mean, as a matter of general principle, investment, increased investment in infrastructure, in particular, increased investment in productivity enhancing infrastructure, is a good thing and is an important part of the overall increase in international competitiveness, and it should be part of a broader plan. But of course, in the end, it's all a matter of what is fiscally affordable and fiscally sustainable as well. And part of our advice to countries around the world, including in Europe, is to keep an eye on debt sustainability and on the need to rebuild fiscal buffers and fiscal resilience.
Matthias, enjoyed the conversation. Great piece. It came out early this week. I'm going to give it a good read a little bit later on. Matthias Cormann there, the OECD Secretary General. In the summary page at the very bottom, they say higher government spending on defence could also support growth in the near term, but potentially add to longer-term fiscal pressures. Now, that might not apply to Germany, but for Europe as a whole, got to ask some serious questions. There's been way too much happy talk and groupthink regarding the investment and defence push by the Germans. And I understand why. It's something a lot of people have been calling for a long, long time. But we've got to ask some serious questions as well about what might go wrong.
Yeah, especially at a time where this is over 10 years that you're seeing almost €1 trillion of spending being deployed. You have to imagine what this means for spreads, what this means for the peripheral countries that might not have the same capacity to borrow that maybe Germany does. But also, seriously, how much can this actually boost an economy that's dealing structurally with some challenges and being between China and the United States?
Questions on the foreign policy front as well. You've basically got the Europeans communicating very transparently that in the future we will have our own defence. We will have a massive defence force, and this is how much we're willing to expend. But in the meantime, we don't have it, and we don't have the goods to secure anytime soon, because you're going to have to build these things. You can't buy them overnight. And the Russians are going to be listening very, very carefully, and I imagine calibrating their response to that accordingly.
And whether or not it's Europe building up their defenses, it all comes back to the United States. In the near term, it's backed up by the U.S. In the long term, even if you're spending more on defense, besides a select few like Rheinmetall, you're going to be buying weapons from USA.
A lot to think about. Equity futures right now, the S&P just about negative by 0.1%, with an update on stories elsewhere this morning. With your Bloomberg Brief is Danny Berger. Hey, Danny.
Hey, John. U.S. Defense Secretary Pete Hegseth says that strikes on Houthi militants in Yemen will be unrelenting until the group stops attacking ships in the Red Sea. Donald Trump ordered a new wave of airstrikes over the weekend. Hegseth said that the latest strikes are also a warning to Iran, which backs the Houthis. The Vatican released the first images of Pope Francis in the hospital since he began treatment for double pneumonia last month. In its latest medical update over the weekend, the Vatican says that the Pope is gradually improving and using less mechanical ventilation to help his breathing. Fashion retailer Forever 21 has filed for Chapter 11 bankruptcy. The company has assets of $100 to $500 million and liabilities of $1 to $10 billion. It said in a press release that it would wind down its U.S. operations while pursuing a going concern transaction or a sale of some or all of its assets. That's your Bloomberg Brief, John.
Hey, Danny, thank you. More from Danny in about 30 minutes' time. I'm next on the program, a healthy correction.
Corrections are healthy, they're normal. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great.
I'm next on the program. We'll get the view from JP Morgan. Sam Zeef joins us in just a moment. From New York, this is Bloomberg.
But what about the diagnosis? If the diagnosis at the end is worries about growth rates,
yeah.
How do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit, and that's not good for the economy. Growth is really critical, and I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity. I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute tech news whenever and wherever it happens. I'm Ed Ludlow in Las Vegas, and this is Bloomberg.
Equity futures on the S&P negative, just a touch here, down by 0.2% on the S&P 500. In the equity market, 4 consecutive weeks of declines, the longest weekly losing streak going back to August of last year. Don't forget Friday, though, a really strong finish to the week. The biggest daily gain on the S&P of the year so far. No positive follow-through. We're down by 0.2. And the bond market down by 2 basis points. The 10-year 4.29. Later on this morning, U.S. retail sales. The next stop for this market, 8:30 Eastern Time, about 41 minutes from now. Under surveillance this morning, a healthy correction.
Corrections are healthy. They're normal. What's not healthy is straight up, that you get these euphoric markets. That's how you get a financial crisis. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great. We are going to have a transition, and we are not going to have a crisis.
So here's the latest this morning. The White House isn't blinking as trade tariff policies erode market-based U.S. exceptionalism. Sam Zeef of J.P. Morgan writing, we think this is more of a growth scare than a true slowdown. But that's where you could get another leg weaker in the U.S. dollar. Sam joins us now for more. Sam, good morning. Welcome to the program.
Good morning. Thanks so much.
Let's talk about the policies and how the market has responded to them. The policies themselves aren't that surprising. Tariffs. We were promised tariffs. We've got tariffs. The surprising element to this is how the FX market has responded to said tariffs. What explains that, do you think?
I think the operative word here is uncertainty. So if you think about it, coming into the year, people expected tariffs, but the amount of uncertainty around U.S. economic policy is greater than I think many were thinking, and that's starting to weigh on the soft data in the U.S., weigh on sentiment, weigh on business confidence, which is starting to introduce a little bit of downside risks to the U.S. outlook. At the same time, you have uncertainty over, let's say, the U.S. commitment to global security, at least if you're from a European perspective. And that's now sparking large fiscal stimulus in Europe, largely focused on defense, but infrastructure as well. And that's starting to raise expectations for fiscal stimulus and growth in the Eurozone. And so you have uncertainty, but if you combine the two, you're starting to narrow that gap between U.S. growth and rates and the rest of the world. And that's what the market is starting to price in, with the dollar starting to weaken year to date.
There's an argument being made that right now the dollar weakness and the euro strength is only pricing in the fiscal spending in Europe, not necessarily the weakness in U.S. growth. Do you agree with that?
I would. I'd say the market has gone a long way to pricing optimism in Europe. Think about the rate moves we've had, the kind of neutral rate estimation in the market's eyes for the euro area, where the ECB's terminal rate is. Those are both increased 25 to 50 basis points, really to the upper end of, I'd say, accepted ranges. You're not pricing in a lot of growth pessimism in the U.S. You've taken out some of the optimism from earlier this year, but growth pessimism, the Fed's still only priced to cut to 3.5%. The 10-year yield is around 4.25%. Think about last fall, last summer, when you had the Somme rule triggered, a lot of recession fears in the U.S. economy. 10-year yield was 100 basis points lower than it is today almost. You had the Fed price to cut 50 to 75 basis points more than it currently is. So that's where that leg of extra dollar weakness, if the market was going to price that type of slowdown in the U.S., that's where the next leg would come from.
It is highly unusual to see the dollar weaken at a time that's risk-off, at a time when you see equities also losing value and there is uncertainty economically globally. A lot of people have raised the question, is this the beginning of a new shift, of a paradigm shift, where suddenly it's a reversal of the trend we've seen into the dollar over the past decade? Do you agree? Do you think that that's what this is?
Well, where that risk-off has been concentrated has been in U.S. equities and in U.S. tech, which has been the main dominant driver, let's say, for the last 10 years. I would say that you're starting to see a little bit of a shift in the dollar's relationship with risk assets. If it continues, you're going to lose one of those things that's really built up these big overweights to U.S. assets. So think about it. Global investors for the last 5 to 10 years or even longer have built up big overweights to U.S. assets because they're safe, they're liquid, the dollar provides a natural hedge when there's a risk-off environment. U.S. tech has been the main outperformer. If the market starts to question a few of those, there's very, very large capital shifts that can occur. We're not really starting to see signs of that, but I think that's something we're watching really closely. Hard to get data on it, but it's really important to just note that even just small amounts of shifts, a couple percentage points among these global investors, is hundreds of billions of dollars.
We do know Trump hates trade deficits. If there's a weaker dollar, potentially that can cut into that. Do you think a weaker dollar is actually welcomed by this administration?
I'd say the weaker dollar is one thing that can help rebalance trade. It's not the only thing, right? And so it's something that we're trying to pay attention to. Like usually on most models, you would need a very large depreciation of the dollar to be large, persistent, stay in place for a large period of time to rebalance global trade. I don't presume to know what the administration is exactly trying to do, but it's a reason that we're starting in the private bank to think about the right types of diversification across asset classes and across geographies. And so trying to take the market at face value, respect the risks, and invest globally.
Right type of diversification, meaning you're buying more gold?
Definitely buying more gold. That's definitely the first destination of kind of global investors that are looking for alternatives to U.S. dollars, but also investing globally, right? And making sure that we're not ignoring other geographies that are starting to see a pickup in momentum. And also, of course, just investing across asset classes. So not just in U.S. equities, but looking at bonds as well.
This has been a sales pitch for the best part of a decade. You've got to buy international.
Yep.
Are people finally buying? Do you feel that capitulation?
I won't call it capitulation yet, but it's definitely getting more conversations in our internal investment committee meetings and everywhere else as well. Rather than starting to shift all of your U.S. allocation into global, a recognition that this is why you have it. It hasn't been fun. It's been a detractor in some portfolios. You know, we hear it, everybody hears it, but this is why you have it for times like this.
The ECB's not having fun. Shall we finish on that? I like Louis de Guindos, by the way, the vice president. He's a very nice guy.
You're going to bring
Charming
this back
man.
up.
Of course.
All right, carry on.
He says it's the most uncertain time, even with the pandemic in mind. He thinks it's more uncertain now than the pandemic. What's your view on that?
I was listening before. I'm going to give him a little bit of defense here, which is to say that for a central bank, it is a tough environment, the current one, because you're getting some downside growth risks. Inflation is still above target. Inflation expectations are always fickle, so you don't want to necessarily ease too early, let's say. And so I think from a central banker perspective, it is uncertain. You're not exactly sure what to do. Pandemic, much larger shock than anything we're living from today, but it was very clear what to do. You ease policy, you ease aggressively. I'm going to cut him some slack and say that's what he's talking about.
Does Chairman Powell need to confront the same thing on Wednesday?
I think they're dealing with the same uncertainty, right? And I do think that what the Fed is basically saying is we're going to stay on hold for a little while. We're watching this. Let's see what the policies actually end up being. Let's see what the data tell us to do. But a big reason that we think that actually fixed income, even U.S. dollar fixed income, is looking quite interesting from an asymmetric return profile is because at worst, the Fed stays on hold for a while. You get the yield that's written on the tin. It's hard to imagine a big backup in yields with downside growth risks. But if something does materialize that's much worse and the Fed does have to ease, they'll provide protection in a portfolio.
Sam, appreciate it. Sam Zeef there of JP Morgan. Didn't provide much protection last week, did they?
No.
Or the last couple of weeks, for that matter.
Because of concerns about inflation that remains sticky. I just want to say that was a much better defense of Louis de Guindos. And frankly, it's not saying that this shock is the same. I'm not saying that, some of these policies are us burrowing into our homes and a camera and our kids on the couch.
They say it was the obvious thing to do back then. I just don't think we've paid the price for it yet. That's all.
Could be. I think that you're right.
That's all. Up next on the programme, Samir Samana of Wells Fargo, Tom Forday of Maxim Group, Neil Dutta of Renmag, Colin Martin of Charles Schwab. From New York City, the third hour of Bloomberg Surveillance. Up next.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
What about artificial intelligence? Is artificial intelligence going to enable you and others to say, we have enough information to know exactly what something is going to be worth in terms of insuring it or not?
Artificial intelligence is finding its way into our business in a variety of different factors. I think the first piece is getting much better insight into data, which allows us to make better decisions on underwriting. It's also a great opportunity to service business better in terms of like call centers and different ways of what's using robotics and other AI will be very helpful. But it is an emerging practice within the industry, and one that is evolving very quickly. So it's also going to present risks that other companies, how they use it and how they use large language models, and making sure the decision making is very sound. So it's complicated, but it definitely is benefiting the business today.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
The market is forward-looking, but I'm not sure we are right now forward-looking enough to look through all the weakness that is going to come in the economic data.
I think it's time for some selective buying in the U.S.
There's definitely a soft patch here, and the question is whether all this market turmoil helps push it into something more.
Corrections end on bad news. They don't end on good news.
What you'll probably see in here, the market's trying to find a bottom. There will be a bounce.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
So the opening bell about 90 minutes away as we kick off the third hour of Bloomberg Surveillance. Your scores look like this. Equity futures on the S&P 500 softer by a little more than 1/4%. On the Nasdaq 100, softer also, weaker, lower, negative by 0.1%. And the underperformance comes from the small caps, the Russell. This can all change in about 29 minutes' time when we get U.S. retail sales, another read on the U.S. consumer, and the last big read going into the Federal Reserve 2 days away.
It's going to be important to tell whether the deceleration does continue. We did see last month this deceleration, a decline of 0.9%. The expectation is for an increase. If you do get a deceleration, how much does that just turbocharge some of the concerns about a growth slowdown in the face of, yes, uncertainty, but also already slowing growth, and that's something Neil Dutta has been really clear on.
And Neil's talked about anxiety over unemployment starting to rise, consumer sentiment starting to drop, and some of the companies in corporate America, I'm thinking of Delta Airlines in the last week, starting to tell you that in the middle of February, spending started to stall for some consumers and for some businesses alike.
Kohl's, Dick's Sporting Goods, the airlines are starting to show you that consumers are pushing back. And of course, the Michigan survey on Friday talking about consumers, talking about the uncertainty of policy out of Washington, D.C. Long-term inflation expectations hitting a 32-year high because of those tariff concerns. When you think about retail sales, when it comes to tariffs, and you talked about this earlier, Lisa, you think people front load and are buying a lot right now because they're concerned of prices going up? Or has the consumer actually been hit? They're worried about maybe losing their job and a lot of anxiety. and they are deciding that they're not going to go out and spend.
There was a study highlighted by the Financial Times by Retail Next, which is a consultancy, that said that footfall in U.S. stores fell 4.3% in the early weeks of March. So people are saying that it's more of the latter and not the former in terms of people front-loading, especially because they're already seeing prices creep up in certain places, and they are already feeling the hit from some of that uncertainty.
Step up Chairman Powell. So Chairman Powell goes into this news conference on Wednesday with some new forecasts, and we'll see what we get in those forecasts. Some people anticipating lower growth forecasts, but what will happen with the outlook for inflation? And this is a really curious time because everyone's talking about the prospect of higher prices. At the same time, energy prices are dropping. That's pretty unusual. That's not something we're used to.
And you've made this point. It is a correct one. Why are they dropping? Are they dropping because of supply, or are they dropping because of demand? And the answer is both. The expectation for OPEC to actually increase some of their production and ongoing pumping at the same time that demand is expected to slow. We see the projections coming out that is the case. Again, this goes back to the difficulty of a stagflation-like playbook. And that is what I think a lot of people are trying to wrap their heads around. How long can inflation remain sticky if growth and demand truly is falling?
The Federal Reserve decision 2 days away. Equity futures right now down by 1/3 of 1%. That data is just around the corner. U.S. retail sales 8:30 Eastern Time. Coming up on the program, we'll catch up with Samir Samana of Wells Fargo as the White House calls the stock correction healthy. Tom Forday of Maxim with Apple down double digits so far this month, and Neil Dutter of Renmac reacting to that economic data later this hour. We begin this hour with stocks looking to snap the longest weekly losing streak going back to August. Samir Samana of Wells Fargo staying constructive. We expect stock prices to march higher by year end, driven primarily by earnings growth that should broaden to more cyclically oriented areas of the market. Samir joins us now for more. Samir, welcome to the program, sir. I have to say, a key feature of your outlook is still U.S. outperformance, U.S. economic resilience. Now, that was consensus at the start of the year. 2-3 months later, it's on the edge of contrarian. Samir, why are you sticking with the call?
Yeah, and I mean, look, I think it has just as much to do with the international side as it does the U.S. side, right? I mean, if you look at, kind of what's happened with Chinese equities over the past, I'll just call it 5 to 10 years, there's been these false dawns, and they happen. And, the way we've always likened it is the Chinese tend to kind of drive a car with, one foot on the accelerator, one foot on the brake as they go down the road. And the last tap was probably on the accelerator, but the next one could easily be on the brake. So you do want to be a little careful chasing performance there, and that's really been the driver for emerging market equities, where we remain unfavorable. On the developed side, same thing. Europe has had many kind of, times when it seemed like they were, moving towards greater cohesion, the valuations were cheap, and that we were finally going to kind of unlock that value. And then something happened in order to make kind of the political stuff, take a step backwards. So I really do think the U.S. still remains the cleanest story, and the administration really does want America to come first.
If these are false dawns abroad, potentially head fakes, what do you make of the dislocations we're seeing in big tech?
Yeah, so we also think big tech probably rebounds from here. Again, the multiples had probably gotten a little lofty. I think expectations had probably gotten a little bit lofty. I think anybody who thought that there wasn't going to be competition around AI and was surprised by DeepSeek probably wasn't doing their homework to begin with. And now that expectations have reset, I think tech looks really interesting at these levels.
Flows can take on a life of their own, Samir, and that's something we were just discussing with Sam Zeef, this concern that given the fact that the dollar has weakened in tandem with big tech, it could prompt some rethink globally of whether the U.S. truly is a hedged story, whether you can buy using dollars that will rally if there is some sort of downturn and get that as sort of an offset. Do you see anything like that happening, or how concerned are you about some sort of global shift away from the U.S.?
I mean, we've always been kind of neutral on developed market equities, so we do want people to have a full allocation there. Interestingly, we think the dollar probably rallies from here. And, again, if you think that inflation is going to stay higher, it means the Fed probably has less room to cut than some of the other central banks, which, again, should be supportive of the dollar. And then if you see tech, kind of starting to bottom out as we think it will, we think some of that hot money, which, has chased returns abroad, probably comes back home.
So what do you reject that we're hearing about, or the market is sniffing out, about slowing growth that we heard particularly last week from the airlines? Why is that not something that really is a warning sign to you?
It probably is, and look, it's probably a warning sign on the consumer side. So, the areas that we like tend to be more on the manufacturing side. We like industrials, we like energy. Refining spreads are finally starting to kind of perk up. We like financials. The curve has, finally, gotten to positive territory, so we think they'll do okay, although, there could be some credit quality concerns if there's a bigger economic slowdown, not in our base case. And then we like comm services. So when you look at kind of the areas that we favor, along with large caps and mid caps in the U.S., it's a very high quality portfolio. So this is not a swing for the fences type of portfolio. Where I guess maybe the market has gotten things wrong is the consumer's been tapped for years now. I mean, I remember just day after day, week after week, we would just talk about, hey, look, when does the low-end consumer, just finally tap out and the high-end consumer finally, kind of hit the skids? And I think some of that has been a long time coming, but some of it's probably precipitated by the tariffs.
When it comes to the tariffs and the policy right now, you think that Trump is going to have a targeted tariff approach. Why?
I mean, because he said as much, right? I mean, again, I think he wants to kind of start with shock and awe, and then I think they'll probably settle into something that, is, in his mind, probably what maybe kind of cures the ills that he sees, and then they'll move on. They'll move on to deregulation, they'll move on to taxes. Like, I don't think we'll be talking about tariffs to this extent at the end of 2025.
When it comes to them moving on, we haven't heard a lot about deregulation, and when it comes to the tax cuts, Bob Elliott, our guest earlier today, said basically it's just extension of TCJA, which is the current law right now. Is that enough to really boost excitement in this market?
I think I come back again to, all right, what's your alternative, right? You've got long rates kind of in that 4 to 4.5% range, as I've been, telling people, look, after tax, after inflation, you're almost left with nothing on the Treasury curve. If you move out to corporates or high yield, now you're taking some of the same risks. I would argue, I would take high quality equities probably over high yield at this point, and you at least get, still a pretty solid kind of 5% earnings yield. Then you throw in the buybacks, you throw in the dividends. We still think equities probably offer kind of, low teens type returns. Now, again, it does come with some risk, but we think after the pullback, you've already taken a good bit of the discounting kind of out of the equation.
Samir, how much protection are Treasuries providing in a portfolio right now, given the fact that, just to take score for the month so far, we're down 5% on the S&P 500, and bond yields aren't dropping. They're doing the opposite now. That wasn't the way we started the year. It wasn't the way we started this administration, but there has been a subtle shift over the last 2 weeks, and I'd love your thoughts from you and the team.
Yeah, and that's just it, right? Is that, look, if inflation is not going away, which has been our base case for some time, we've been on the north end of consensus for as far back as I can remember. We just didn't think inflation was going away. If anything, we continue to worry very much about a second wave of inflation, right? Especially if, the tariffs cause wages to start kind of perking up, and then there's, again, call it that upward spiral. Not our base case, but that's the side that the risks are coming in at. And so what history tells you, and even recent history tells you, is when you have inflation as the problem front and center, stocks and bonds can both struggle at the same time, which is kind of what you're seeing now. And that's why I think gold's doing a little bit better. Commodities, where we're favorable, is doing a little bit better. You may want to sneak a little bit of that money, as I mentioned, to the developed market equities. So I think it's okay to have some diversification in that type of scenario. But yeah, I think it's going to be really tough for bonds to outperform from here.
Samir, it sounds like you prefer the U.S. You still do think that it's the cleanest shirt and whatever cliche you'd like to put out there. At the same time, it sounds like you don't expect big returns this year. Is that correct?
I mean, from current levels, we do. I think our year-end target for the S&P is 6,600. So, if you throw in the dividend yield, that is, again, kind of, mid-teens type returns into year-end. If you start to think out into the first quarter of next year, now maybe you're talking high teens. We just upgraded mid-caps to favorable. We think they could do, as much, if not better than that. So, I guess what I would tell investors is don't wait for the narrative to shift, right? Right now, there's this really negative narrative around tariffs, around inflation not going away, around a growth slowdown. I promise you it'll change as we get into the summer months, and at that point, the markets will respond first, and investors will find themselves trying to kind of catch up to where markets are going.
Samir, appreciate the clarity on your view from you and the team. Thank you, sir. Samir Samana there of Wells Fargo. A key feature of their point has been U.S. economic leadership, and that was very, very consensus at the start of 2025. And as we work our way through the year, it's on the edge of contrarian now.
I would argue it is contrarian to say that the U.S. is going to be the outperformer, that you've got, in the mid-teens in terms of outperformance for U.S. equities at a time where big tech is supposed to rebound. Other people, whether it's Stuart Kaiser, whether it's Lori Calvasina, we don't know. These signals are getting a little confusing.
Let's go to the forecast from the OECD. So they've got US growth down for 2025 at 2.2%. Eurozone GDP growth projected to be about 1% in 2025. Now, in terms of levels, you'll get the outperformance for the US versus, say, Europe. Probably, most likely. As a lot of people always say on this program, what the market's interested in is better or worse. And things in the United States, based on projections, are worse than people thought they would be only a few months ago.
And they are better than they thought that they would be elsewhere when you have the promise of fiscal spending. We can't emphasize it enough, and I think you put it really well. This idea, have we paid for some of the fiscal bazooka that we engaged with during the pandemic? And is now the time where you're going to have to ultimately pay for it? And if you don't, you're going to get penalized in the debt market. It is an interesting time coming off one of the biggest dislocations we've seen in a long time.
It feels like Secretary Besson's the only guy out there saying, yes, we need to pay the price for this, and it means a detox.
Well, other people say that there is a price to pay for it, but we don't want to pay it. At the same time, I think the issue isn't that there is not a crisis. I think a lot of people agree with that. It's what is the cohesive plan to get there? Are we cutting enough to actually make a dent when it comes to reducing the deficit?
Looking potentially at a major realignment across several dimensions. Equity futures right now on the S&P, slightly softer, we're down 1/3%. Big economic data points, 17 minutes away. US retail sales just around the corner. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. The U.S. Mid-Atlantic is on alert as a powerful storm system sweeps over the region. The Storm Prediction Center said more than 50 million people from western New York to central Florida were in the track of the storm. This comes after at least 36 people were killed across 6 states when a massive storm system moved across the South and Midwest last week. President Trump may be raising the possibility of new investigations into the January 6th committee. In a Truth Social post, Trump declared President Biden's pardons for the committee members void because Biden signed them with an auto pen. Last year, a federal appeals court found that a pardon doesn't have to be even in writing. And March Madness is upon us. The Auburn Tigers were named the men's top seed with Duke, Houston, and Florida also getting named as #1 seeds in their conferences. The tournament begins tomorrow with the first 4 games tipping off in Dayton, Ohio, ahead of the main bracket action on Thursday. And that's your brief, John.
Danny, thank you. I just wish I had a snapshot of Bramo's face just then. Not doing your bracket, Lisa.
Well, no. I just feel like it's, you know, sports roulette.
All right, that's a no. Okay. Up next, the Morning Calls Plus. Tom Forte of Maxim Group on how Apple can bounce back from its double-digit drop so far this month. A conversation up next, live from New York. You're watching Bloomberg TV.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
US tech is influencing global markets.
Technology
technology is driving business across Europe.
Companies in Asia are betting on tech.
Equity futures here just a little bit softer. We're down by 1/3 on the Nasdaq 100, down by 2 on a Russell, negative by 0.6. That's the price action. Let's get you some morning calls. First up, MoffettNathanson upgrading Netflix to buy, calling its ability to monetize engagement underappreciated. That stock up by 1.2%. Your second call from JP Morgan upgrading Norwegian Cruise Line to overweight, seeing no change to demand trends despite emerging consumer concerns. Interesting one, that. Goes against the grain with the airlines, that's for sure. That stock is up by 4% in early trading. And finally, Mizuho lowering its price target on Tesla to 430, expecting February sales to underperform in several key regions. Was that horses, barn doors, and all that stuff? Stock is down by 1.2%.
It's just, I remember how we used to not care about deliveries with Tesla.
Yes.
It was a belief stock. It was a sort of dream stock. And now it's both.
The bulls will tell you it's still a story stock, right?
Yeah.
It's the future. It's away from what they're going to do with EVs.
Yeah, but even Dan Ives kind of moving away from that and saying it is the moment of truth. Either come or don't come back to Tesla, or else stay at Doge, and maybe we're not going to have such a great go of it.
Stock is down in the pre-market by 1.2%. Let's stick with the Mag 7 names. Apple shares under pressure, down nearly 15% so far this year. A slow revenue growth and uncertainty around its AI offerings weigh on the stock. Tom Forte of Maxim Group has a hold rating on the stock with a 215 price target, noting its AI smartphone is a potential catalyst. Tom joins us now for more. Tom, welcome to the program. Always good to get your thoughts on the name. Let's talk about Apple right now. What do you think is behind the recent weakness over the last few weeks?
Yeah, so I'm actually encouraged because I think for the first time in a long time, some of the risks for Apple are starting to get priced into the shares. When you think about, are we in a global trade war, or are we on the verge of a global trade war when it comes to Trump's tariff policies? And in particular, you think about a trade war with China, which is a high teens % of sales, and still where Apple manufactures most of their devices. I'm actually encouraged that the stock's starting to price in some of the risk.
So, Tom, when we go into the next earnings release, are you expecting some weakness in China and some weakness that's already priced? Because we did drop another 11%, close to 11% last week alone.
Double-digit declines in China in the December quarter. And the concern would be that a prolonged trade war with China would inspire more consumers in China to buy from Huawei and not from Apple. Add to that the fact that Apple's been unable to roll out their AI feature set in China, and I think you're going to see continued weakness there.
So, Tom, what would make you actually be enthusiastic about this stock, given that there are a lot of fundamental challenges, and you're encouraged by a 14% drawdown so far this year, but not really changing your hold rating?
Yeah, so Lisa, what would get me more excited is Apple still generates a ton of free cash flow. And generally speaking, when they report the March quarter, they update their returning capital to shareholders policy. So I think lost in the shuffle on the Trump tariff policy is Trump's tax plan. And when you think about Apple, and they pointed this out when they announced their $500 billion investment in the U.S., that they're one of the largest taxpayers in the U.S., and a prolonged period of lower tax rates means more free cash flow and a greater opportunity to buy back stock. That gets me, excited, I guess.
So later this year, you could see, if those tax cuts get extended, that there could be some sort of stock repurchasing that maybe, you guess, could get you excited or move away from a hold. What's your concern level about some sort of tit for tat between the U.S. and China, roping Apple into it and make Tim Cook have to choose in a way that the ultimate diplomat just hasn't had to do yet?
So historically, as you pointed out, Lisa, he is the ultimate diplomat, CEO by day and diplomat by night. Does an amazing job balancing the company's relationship between the two countries. Elon probably second best with Tesla. What would get me more excited is evidence that the upgrade cycle, that there is an upgrade cycle as it pertains to AI. We haven't had that evidence to date, given that they rolled out the new hardware the 16th of September, and they've been rolling out the software piecemeal with the AI feature set, and you haven't seen very good Apple iPhone sales. So maybe as the year progresses, you start to see evidence of an upgrade cycle, or at least better than what we're expecting right now.
Tom, let's think about the backdrop for this decline, particularly over the last 2 weeks or so, and for that matter, over the last several months. We've seen a major sentiment shift away from the United States to Europe to China. And with that, multiples have had to come down. And Tom, I just wonder, and if you can go beyond just a single name coverage just for a moment, just indulge me. Do you think there is a possibility here that perhaps the scarring from several events over the last couple of months could be long-lasting, that maybe the willingness of investors to pay up for US equity names, particularly US tech and major tech names, that winners might not be there through the rest of this year?
So the argument against that, Jonathan, would be that the US has been the source of most of the globe's major tech companies. Yes, you have Alibaba, Tencent, and some other giants in China, but you're talking about Apple, Amazon, Meta, Facebook. Sorry, Meta and Facebook, same thing, Google. So the innovations come out of the US, the multiples, I think, will follow the innovation, and there's reason to believe long-term that the US will remain the epicenter for tech and for stocks in general.
I guess what I'm getting at, Tom, is how much of this is really about tariffs? How much of this is really about still dealing with the fallout from the DeepSeek revelation from the back end of January?
Well, the problem, Jonathan, with the DeepSeek revelation is that every major US tech firm basically reaffirmed that they're going to spend a ton of money advancing their AI efforts. So I think that we should expect there to be competition, especially from China, for AI. Let's see how Amazon, Apple, and others ramp their AI efforts, and if the CapEx spending is worthwhile. I definitely believe for Amazon it will be. So let's see how things play out.
So what do you have to see to actually raise it to a buy at a time where potentially there are all of these headwinds, there is competition, there is the upgrade cycle, and at a certain point you also just have structurally higher rates potentially that could impact valuations?
So it is possible, Lisa, that the stock just trades down lower, so there's more upside to our price target. So, you know, the risks getting priced in to a greater extent. Love to see signs of improving sales in iPhone. But again, they generate a ton of free cash flow. We haven't talked at all about their services story. That's very compelling. That's where all the upside came in the December quarter. They recently added Apple TV to Android devices. So I think the services story is quite good still, higher margin than the hardware. So there are things to like. I just would like the shares to get priced in a little more risk.
There's also a concern longer term, and this is something that Peter Scheer of Academy Securities raised over the weekend, that as the trade wars drag out, that Americana brands, the ones that really represent the United States, will get penalized in foreign sales, akin to what we've seen maybe in Tesla anecdotally. Do you believe that that is something that could pose a challenge for the likes of Apple, which has traditionally been associated with Americana?
The answer is absolutely. And really the worst example, Lisa, is the Canadians taking the American liquor off the shelves, essentially. So yes, I do think that a prolonged trade war, nationalism, consumers in China buying from Huawei instead of Apple, brands that are associated with the U.S., even though they are global brands like Apple, having negative views outside the U.S. on a prolonged trade war, that's certainly a risk.
Hey, Tom, appreciate it, as always, to get some clarity from you, sir. Tom Forte there of Maxim Group on Apple. Apple down by close to 11% last week. Pretty ugly week at the moment. In a moment, we'll get US retail sales. And I think a big question for the likes of Neil Dutter of Renmac. If you have an iPhone, which is a wonderful product, and it lasts, and you don't need to upgrade it every single year, and anxiety about employment is going up, and confidence about the economy is going down, are you going to upgrade for an iPhone anytime soon?
The answer has been for a long time, based on the Jonathan Farrow Index, that not so much. And that really is going to be the key tell at a time where it's $1,000. And why bother?
In a wait-and-see economy, why would you rush?
Yeah, I mean, that's probably...
In a wait-and-see. Show me the new products. Show me that AI. Show me why it's going to change my life.
You
and
wouldn't
maybe
really... What do you want it to do?
Life.
Yeah.
Cook? Battery life.
I'm a very simple man. It's the battery life. Retail sales. Up next from New York. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rise in course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
25 seconds away from a much-anticipated US retail sales print. Mike McKee's going to break that down in just a moment. Your scores going into it look like this. Negative by 1/3% on the S&P, down by 1/10 on the Nasdaq 100. In the bond market, 2-year, 10-year, 30-year. Your yield curve shaping up as follows. The 10-year this morning, your yield is down 2 or 3 basis points. The 10-year, 428.51. With that economic data, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, the economic data is the hard data people have been looking for, and it is worse than anticipated. We had a question about whether the hard data would follow the soft down. Retail sales on a headline basis up just 0.2%. Ex-autos up 0.3, and ex-autos and gasoline up 0.5%. A retail sales control group is reasonably strong, though, up 1% after a negative 0.8% drop in the month before. We'll take a look at what the movers were in just a moment. The Empire Manufacturing Index, another soft data, comes in terrible. Down 26 points to -20, with new orders, shipments, employment, and hours worked all falling. Prices paid rise 5 points to 44.9. That's the highest level in more than 2 years. Optimism about business activity in the future falls 10 points after dropping 15 points last month. So it looks like at this point, people are not confident in the future, and to a certain extent, they're spending less.
Micah McKee, let's put it this way. Some conflicting data, some tension, a tug of war between the soft data and the hard data, and that tension continues. So I'll just give you a snapshot of what the bond market is doing in response to it. Initially going into this print, yields were lower by 2 to 3 basis points across the curve. We erased some of that move, now higher on the front end by a single basis point, just north of 4%. In the equity market, I'm sure for many of you, you don't know what to do with this. You're not alone. Equity futures just about unchanged on the session, down by 0.2%. Headline retail sales, month under month, a downside surprise of 0.2% against an estimate of 0.6%, but the control group, a punchy 1% against an estimate of 0.4%, and then you've got a really ugly Empire Manufacturing read in the mix as well for the month of March. So, Lisa, put that all together, what have you got?
You basically have a situation that's not weakening fast enough for the Federal Reserve to cut rates in an imminent way, but you have weakening growth and, as Mike was talking about with Empire Manufacturing, ongoing concerns about price pressures, even with reduced demand. This is not what you want to see. I want to point out that revisions were all to the downside when it comes to retail sales for the prior month. So not weakening quickly enough to necessarily warrant an emergency rate cut of any sort, but definitely on the weaker side.
Mike McKee, just want a quick explanation. I know you're going through the details as we speak. What explains the downside surprise on headline versus the outperformance, the upside surprise on a control group?
Well, we had a big drop in motor vehicles and parts, autos down 0.6%, and a 1% drop in gasoline prices. So that's weighing on the headline. The only thing that's really good, though, in the report is non-store retailers retailers, e-commerce up 2.4%. But food services and drinking places, sporting goods, clothing stores, health and personal care stores, everything else is down during the month. So it is not a very good report overall. We stayed home, I guess, in February. Maybe it was the bad weather, and ordered stuff instead of going out and buying.
Mike McKee on the latest. Neil Dutta joins us now to extend the conversation. Neil Dutta of Renmac. Neil, welcome to the program, sir. You've noted the soft data, the anxiety over employment specifically. I just want your thoughts initially on retail sales. Do those two things stack up?
Well, I mean, the retail sales data was basically an online story. I mean, last month, a lot of the weakness that people didn't foresee was a function of online retail. And this month, a lot of the strength that people see was a function of online retail. So that kind of just swung around. If you take that out, you know, the underlying story is still weaker. You know, I think it's interesting that food services and drinking places, you know, basically restaurants are down, you know, 3 months in a row, you know, or down, sorry, over the last 3 months, and pretty meaningfully over that period. I mean, that's sort of a bread and butter type of discretionary purchase. If you're not feeling good, you're not going to go out to eat. And that's exactly what's been happening.
Neil, you've been clear about how this weakening trend has been in place for quite a while, that really since late last year, you could start to see it in the data. And this is part of the economic cycle as much as anything else, if not more. I am wondering if you're surprised by the pace of some of the deterioration, especially in light of the pressure that increasingly is being put on the Fed not to cut rates because of inflation expectations.
Well, I mean, I don't think there's a smoking gun yet in the hard data. I mean, I want to be clear about that. You know, there's no sign of collapse. There's no real discontinuity in the hard data. I mean, that's a classic Greenspan sort of tell for trying to figure out when, you know, if we're in a recession or going into one. But you clearly see weakness in, you know, soft measures of economic activity. And, you know, obviously there's been a fairly rapid speed in terms of the weakness in consumer sentiment. As an example, the March Empire data, sort of the same thing. Obviously, if you're doing tariffs, I mean, that's going to weigh on the goods sector, you know, disproportionately, and you're seeing that. But you've yet to see that really translate into hard measures of activity. I think at some level, Lisa, I mean, the fact that the economy, I mean, residential investment's been quite sluggish. You know, a lot of the cyclical areas, you know, manufacturing's been quite sluggish. So if these cyclical areas have been relatively soft to begin with, it mitigates some of the downside, because if you're sort of bouncing along the bottom, it's hard to go further down into the basement.
One thing that you've laid out, Neil, and I thought it was really profound, especially in your conversation with Paul Krugman over the weekend, was the degree to which some people are underestimating the amount of state and local funding that's being cut right now, and how some of the federal cuts might look really small on kind of a national spending level, but when you start to get those cuts at state and local levels, that's where it's going to bite more significantly. I'm wondering, how quickly are we starting to see some of those cuts filter into some of the economic data that we're getting out, like spending, like consumer confidence?
Well, I think the area to watch is really state and local government employment. I mean, that had been a steady tailwind for jobs growth over the last, you know, year or so, and that's, you know, shifting into a much lower gear. You know, remember, state and local governments were adding, you know, 30 basis points of GDP growth, and that's probably poised to go to zero, maybe even slightly negative this year. You know, that's what we're seeing in the upcoming fiscal year. You know, states have exhausted their pandemic relief money, you know, that's already started to weigh on sort of public sector construction spending. I think employment's going to be the next leg of that.
Neil, when it comes to this administration and their pain tolerance, over the weekend, Treasury Secretary Scott Bessent, someone I know you know well, said over the long term, if we have good tax policy, deregulation, energy security, then the markets will do great. But in the short term right now, the only policy we keep getting out of this administration is tariffs. What's their threshold for how painful they're willing to take what we're seeing in the financial markets and consumer sentiment?
Well, I don't know the level of the put. I mean, I just know that it's lower than where we are now. I mean, look, I do think it's more about what they're doing, not the uncertainty around what they're doing that's driving the markets. But, I keep, you and I have talked about this, Anne Marie. Did people not know what they signed up for? I think what we're seeing is when Trump won, everyone knew that it was some combination of tax cuts, deregulation, and tariffs. But they bet on it in that order, which is why you saw expectations for growth, at least in the first and second quarter, go up after the election. But obviously, we see what the order is, and any day that they're not talking about tax cuts and deregulation is a day they're talking about tariffs, and the signaling of that means that they're pursuing a lot of growth unfriendly initiatives first.
Neil, why do you think there was this consensus around the sequencing? Because it's very clear, if you understand Washington, that the only lever Donald Trump could pull on his own when he got into office was unilaterally tariffs.
Well, yeah, I mean, I don't know, Anne Marie. Maybe you should get into the private sector forecasting business, because I think that was a great call. But look, I mean, not only that, I mean, any legislation was going to be a very, very tall lift as well, as you know, because the Congress was so thinly divided. I mean, I think at some level, because it's going to take them longer to get some of this tax stuff through the finish line, that's probably why one reason why they are front loading the tariff agenda.
Neil, I haven't watched it yet, but people want to know, is Krugman Data going to become a regular thing? Do we get a second series?
Well, you'd have to ask Paul, but it was quite the honor to be on with him.
Neil, appreciate the input as always, sir. Neil Data of Renmac. Did you watch that over the weekend?
I did. You saw Neil almost fanboy a little bit in the beginning, am I right?
Well, I mean, honestly, I understand it. It was really interesting conversation.
Mutual respect.
That's what I was going to say.
They should come on the program together.
We should make that happen. Got to deal with something else first, though. Need to talk about the economic data. Mike McKee's back with us. Got a busy week ahead as well, Mike. That was the last big read on the US consumer going into this Federal Reserve meeting on Wednesday. When you piece it all together, Mike, what's the review? What's the conclusion of where we are right now?
Well, we seem to be on a slowing trend. The question is, how fast do we continue to slow, and how far down do we go? We get a lot of data this week that will add to the overall impressions that the Fed and the markets have after the dismal empire number and the poor retail sales number. Tomorrow we get housing starts, import prices, which feed into that PCE number, the last piece of that, and industrial production. That's going to be interesting. What's happening with the factory sector at this point, given the consumer sector seems to be weakening? Wednesday, obviously, the Fed meeting and Jay Powell's press conference. And then Thursday, claims, we're watching that, Philly Fed and existing home sales. The more important number, though, for the markets might be coming out later this morning. We get the first update of the Atlanta Fed's GDP now in about 2 weeks since they put out that negative 2.4% figure. A lot of people don't realize this is just cumulative adding up what we know for the moment, not a forecast, but it did influence a lot of people's views of the economy. And today they're going to update it with the latest data, so we'll see how that moves.
Look out for that. Like the green as well, Mike. Should have done the same thing. St. Patrick's Day. Happy St. Patrick's Day to you all out there, particularly the Irish here in New York City getting ready for that big parade. Terrible weather for it.
Yeah, well,
isn't it?
Yeah, but that's par for the course. They'll still be happy.
That's part of being a New Yorker,
exactly.
Is it, Brower?
Yeah,
nice,
and
all
also
right.
Irish.
Colin Martin and Charles Schwab with us now for more. Colin, good morning.
Morning.
Good to see you, sir. If you're in the bond market right now, I think you want a better understanding of whether you need to be focused on growth, inflation, or both.
I think both. I mean, that's really what it comes down to. The risks are kind of balanced to both right now. I don't think we're going to get too many insights this Wednesday about where the Fed is tilted. I'm sure they're going to keep it pretty open-ended. I think for now, the growth concerns appear to be more on the sentiment and consumer confidence, and we're still waiting for that hard data. Obviously, we got the number this morning. Looks like it was kind of mixed, a little soft in the headline, a little bit better on the control. So I think we'll need to start to see more hard data roll over before we get a little bit more concerned. So our guidance right now is we think ultimately the direction of interest rates is probably a little bit lower. But for now, we're not making a big bet about that because I think a lot of it does rely on the hard versus soft argument.
For much of this year, the bond market appeared to be more focused on downside risk to growth versus upside risk to inflation. Neil Data was with us just moments ago, and he's highlighted the anxiety that's rising around the labour market. And for that reason, I think economists at the moment say that should dampen any concerns around second-round effects from tariffs. If you're worried about your job, you're not going to your employer and asking for a raise. You're not going to see that get away from you. You should go to your employer and ask for a raise. I'm just throwing that out there. But anyway, that seems to be the conclusion right now. Is that the right conclusion?
I think so. The labor market is still relatively strong, but there's a but. That's kind of how I'm looking at it right now. Most of the data supports a relatively strong market. The unemployment rate's still relatively low. We're seeing employment gains, but they've slowed down. I think that's a big part. We've seen the participation rate tick down a little bit. JOLTS is kind of mixed. We saw a little tick up in quits data. That's something we look at about if you're asking for a raise, are you willing to move to another job? So that is something that's important, but you hit the nail on the head. If you're worried about your job and you have this anxiety about what's going to happen because of all the political uncertainty right now, what that translates to business from a high level, that's going to impact our spending habits. So I think that is important right now. Right now, things are looking pretty good, but there are pockets of weakness on the edges.
So how can inflation continue if people are concerned about spending? And it sounds like a pretty basic question, but there's this argument that if you have a one-time price shift with tariffs, they don't actually translate into higher inflation longer term, just because if you dampen demand, well, guess what? You don't have that kind of inflation.
Yeah, that's right. That would dampen inflation to a degree. And also when we look at the tariffs, one-off price change versus potentially a sustained increase in prices. We do think the tariffs should be a little bit inflationary, but you're right that if we get some slower growth there, we get a lot of uncertainty, especially on the business level. If we get this on again, off again tariffs, that slows down activity, and maybe inflation doesn't accelerate the way that it would have minus all that anxiety. But we still think inflation is going to be sticky. It's hard to see it come significantly lower given all the things we're seeing right now, especially with tariffs.
How complicated is the situation in terms of U.S. rates when you have rates globally in the developed world going up on the heels of fiscal spend elsewhere?
Yeah, very. It complicates the issue. When we look at the global markets, one thing we've looked at for a while is just that yield advantage that the U.S. offers. And it's still relatively wide right now, but it's come down a little bit. But you also have to factor in the dollar. And if we're seeing other yields rise across the globe, we've seen a weaker dollar lately, that can impact how attractive global investments could be. So it is something we're looking at right now, but it also complicates the issue here in the U.S. All these things, we just see a lot of volatility right now. So the guidance we're providing is to not make a crazy move in either direction. We're not super short duration, we're not super long duration. We're really just at your benchmark duration until we get more clear signs that either growth is slowing significantly or inflation's reaccelerating.
I feel as though the message has been clear from the Treasury Secretary, though, in terms of this is a transition. He also, over the weekend, did not rule out, say there's no guarantees that we can't have a recession. Are they preparing America potentially for this quote-unquote transition, aka maybe a recession?
They could be. I mean, they are laying the breadcrumbs out there for what we could expect. I think given where we were coming into the year, valuations were pretty stretched across the board, whether it's equities. I'm not an equity guy, but I know that PEs were relatively high. But we saw that in the credit markets also, very low credit spreads. So a natural correction can be considered healthy. I think the swiftness is what's capturing a lot of investors' attention, and will it be prolonged? I think it's easy to say that now when we're down, 10% or less with stocks, and the rising credit spreads it was sharp, but they're still low. If we see that continue and that 10% decline in equities becomes a 20% decline, maybe that message changes a little bit.
Do we see the Fed chair potentially dangle a rate cut?
I don't think so. They want to stay as apolitical as possible. So I think they'll lay out kind of the dual risks they have. I think they won't mention it in this statement, I'm sure, but Powell will get the question about all the uncertainty, the political uncertainty we're seeing, and how that's playing into their outlook, especially inflation expectations. I mean, we saw the jump at the University of Michigan last week. I don't know how much they weigh that versus market-based, but there's so many different indicators out there. You can't ignore that jump that we saw in that 5 to 10 year inflation expectations, highest since I think the early 90s or so. So they'll try to stay away from the political fray, but they clearly have to be considering these potential outcomes as they're coming up with policy.
One of the biggest reasons we pay attention to you, Mitch, is because they do. They responded to it so quickly in the rate hiking cycle of a number of years ago.
That's why the most interesting move on Friday was not stocks selling off in the heels of some sort of negativity. It wasn't necessarily long-term bonds selling off in terms of long-term inflation expectations. It was the short end on expectations that the Fed would have to respond to the University of Michigan sentiment inflation survey and not cut rates more quickly.
It was easy to stand on the sidelines and say you don't want to talk about policy when there wasn't any policy. There's some policies now. We've got some tariffs. They've got to respond to that in the news conference on Wednesday.
They have to answer the question, are they inflationary? Are you modeling into your base case that this is going to structurally be more inflationary? And do you have to fight that with Fed policy at a time of weakening growth?
Get them to say the transitory word in the news conference.
That's not going to happen.
Yeah?
Is that what you're going to go for?
I'm not going to be there. Mike will be. Colin, it's good to see you. Appreciate it. Thank you. Colin Martin there of Charles Schwab. Equities just turning positive as we inch closer towards the opening bout. That opening bout about 42 minutes away. Equities up by about 0.1%. With an update on stories elsewhere this morning with your Bloomberg Brief, it's Danny Berger. Hey, Danny.
Hey, John. President Trump says that he will speak to Russian President Vladimir Putin tomorrow, pressing for an end to the war in Ukraine. Trump says they will focus on territory, power plants, and dividing up certain assets. Speaking to reporters on Air Force One, the president said, "We are doing pretty well with Russia, and there is a very good chance for a deal." Elsewhere, Oracle is accelerating talks with the White House on a deal to run TikTok. Politico reporting that the U.S. administration has significant concerns about what role the app's Chinese founders will play in its ongoing American operation. Vice President J.D. Vance says that he expects President Trump to wrap up a deal for the popular app ahead of next month's deadline. And in sports, Newcastle upset Liverpool to win the Carabao Cup final 2-1. It's the Magpies' first domestic trophy in 70 years and their first overall since 1969. Elsewhere, the Players' Championship is headed for a 3-hole playoff after Rory McIlroy and J.J. Spaun tied in yesterday's play. McIlroy is looking to secure his 28th career PGA Tour victory. And that's your brief. John.
Danny, thank you. Thanks for this morning. I think that playoff begins in about 11 minutes' time, so I'll be at my desk watching the golf.
How do you know? I have no idea.
Here so quickly.
I know.
Can I just take a beat? Congratulations to Newcastle fans. If you're not familiar with Newcastle fans, genuinely, they are some of the best fans on the planet. Win or lose, they sell out that stadium every single week they play at home. I couldn't be happier for you all. Just absolutely fantastic.
And that game made people also want to be a Newcastle fan because they played really well, and Liverpool, not so much.
I remember the Christmas holiday period going back years. Okay, there was a game in the Midlands, West Brom versus Newcastle. It's freezing, okay? Behind the goal, Newcastle fans, shirts off in the freezing cold. And they travelled down from Newcastle, which must be like a 5-hour drive or something. Absolutely ridiculous.
Is it passion? Is it crazy?
I think it's a little bit of both. It's a little bit of both. Congratulations to you all. Up next on the programme, let's set you up for the day ahead. That's around the corner from New York. This is Bloomberg.
Behind the bright lights and adrenaline of pro sport is an equally exciting world of negotiations and deal making.
That's what we cover each week on our podcast, The Deal.
I love the fact that you have, we say the cojones. I can't say that in Bloomberg.
Maybe moxie.
Yeah, moxie. I'm Alex Rodriguez, former baseball player turned business executive.
And I'm Jason Kelly, a journalist at Bloomberg. Over the next couple months, we'll hear from all-stars like Billie Jean King.
Well, what should I learn? What should I do? I said, learn the business.
Jay Williams.
You're the asset, but how do you become the principal?
Paul Rabel.
We're going to be the league of digital, and that's why you're going to invest.
Adina Friedman.
I definitely am competitive.
David Rubenstein.
People don't come up to me on the street and say, let's talk about this private equity deal you did recently. No, nobody does that. They say, let's talk about the team.
And so many more.
You need a clap?
No, I never. Go.
Good morning.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Equity futures turning positive briefly. Equity futures just about positive on the S&P and up 0.2 on the Nasdaq 100. As we count you down to the opening bell, here's the trading diary for the week ahead. On Tuesday, President Trump speaking with the Russian leader Vladimir Putin. Wednesday, a Bank of Japan rate decision. Then at 2 p.m., it's the Fed's turn, followed by a Chairman Powell news conference later that afternoon. On Thursday, a Bank of England rate decision plus another round of jobless claims and earnings from Nike and FedEx after the closing bell. Joining us now for some final thoughts, Bloomberg's Tyler Kendall down in Washington, D.C. Tyler, welcome back. That call coming up in the next 24 hours, how high are the stakes?
Oh, well, incredibly high, John. And of course, it comes on the heels of Anne Marie's scoop that Special Envoy Steve Witkoff was in Russia last week negotiating face-to-face with Vladimir Putin. Now, President Trump has said that he feels that this could be a chance for some very good progress and that he has the potential to potentially announce a deal after that call. He previewed that land territory will be one of those big concessions that we are going to look for. Also saying that energy infrastructure as well as power plants are something that they are trying to figure out the path forward here. National Security Advisor Mike Waltz over the weekend saying that they know all the components for the deal. Now they are just trying to hammer it out.
Tyler, you've got to lean against the wind and tell me you need to seek shelter. You make it really dramatic. Got to make it more dramatic than it is. Tyler, I appreciate it. Tyler Kendall down in Washington, D.C. Stay safe. The weather's been absolutely brutal over the last few days.
I think there was plenty of inherent drama there. You could hear the cans kind of blowing behind her and her hair.
The North Lawn can get very dramatic, especially when they bring out the lawnmowers as well, not just the wind.
That's about as dramatic as it gets for a reporter in the White House, eh?
Well, I don't know about
the
that.
lawnmowers coming out first thing in the morning.
For a broadcaster, it's a little dramatic.
All right, coming up tomorrow, let's get to the lineup. Peter Chu of Academy, Kit Jukes of SocGen, Tom Becker of BlackRock, Stephanie Roth of Wolf Research, joining us to break down the first day of a two-day meeting for the Federal Reserve. It will conclude on Wednesday, and it's going to be a fascinating one. This White House is not blinking, will Chairman Powell.
At a time when you have inflation expectations that are climbing, a lot of people aren't expecting that. Do they expect higher inflation and slower growth going forward? And how do they message that?
Look out for those forecasts on Wednesday afternoon. Live from New York City this morning. Good morning to you all. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
To drive productivity and improve efficiency, Prudential has made significant investments in data analytics and artificial intelligence. Janella Frias plays a key role in integrating these tools into the company's processes.
We always need people. We're in the people business. But more and more, if we really want to provide the right customer experience, fast access to products, it's about technology. Technology has always been an enabler. Now it's a strategic differentiator.
Give me a sense of AI in Prudential. What are you experimenting with?
A few areas. One is around customer experience. In our individual life business, our underwriting process has gone from about 20 days to minutes. In our group business, we have partnered with a number of different fintechs to really improve customer experience, to bring on board capabilities, things like claims management, where we can process a disability claim faster and help people get to work faster.
How much productivity uplift are you getting and will you get?
We're probably getting 10% at this point, but I think over time that is where the value is, and it will then allow us to take our capacity in the form of people and redirect it to more value-add activities.
In a nutshell, it means turning the menial into meaningful. It can be both a huge saver of time, but it can also provide real insight.
What makes it India's time?
It's us women who are going to transform India. I truly feel that the time for Indian women has come. They're not only breaking glass ceilings, but they are redefining, you know, whether it is in sport, whether it's in medicine, whether it's in creative arts. They are everywhere, and I have so much positive energy that comes back to me when I'm talking to Indian women. And I just think that all these little girls and boys, I don't want to discriminate, who are now in school-going age, imagine once education, sports, we empower them. What a difference they would make not only to India, but to the planet and the world. And the world needs it now than ever before.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
All right, we are looking a little bit of a bounce this morning, 30 minutes until the start of cash trading. I'm Matt Miller.
I'm Sonali Bassett. Katie Greifeld is on assignment, and Bloomberg Open Interest starts right now.
Coming up, Fed Chair Jay Powell faces a tricky task this week of assuring investors the economy remains on a solid footing. Retail data out this morning adds to concerns of a pullback in consumer spending. And Treasury Secretary Scott Bessent says he's not worried about the market, but Wall Street doesn't seem convinced. RBC's Lori Calvasina cut her S&P 500 target on growth risks, and she joins Open Interest this hour. Also, our big stocks focus today, NVIDIA investors hope a keynote speech from CEO Jensen Huang at the chip giant's much anticipated AI conference this week will give the stock and the sector some badly needed momentum. Let's take a look right now at where markets are trading. We did see a little bit of bounce, very little. NASDAQ 100 futures are still up 0.1%. Maybe that's on hopes the GTC conference from NVIDIA will give us something. You can see S&P futures right now, little change, but there's a red arrow. And the 10-year yield also very little change, holding at that 430 level that Sonali has been watching so closely. I'm watching NVIDIA stock right now because it's a pivotal week for that company and that sector. NVIDIA developers, it's a developers conference getting underway. The GTC, which I think is GPU Technology Conference, pushing the shares in the pre-market up 1% and change. And you're watching something related.
I am. Pour one out for the humanoids. That is what Morgan Stanley is watching, the humanoid trade here. That is in part in Tesla. The idea here is that the NVIDIA conference could have implications on Tesla's stock, which has seen investor sentiment plummet this year. And remember, Tesla is one of your worst performers on the S&P 500, certainly the worst on the Magnificent Seven. Let's see if NVIDIA can help turn it around. Meanwhile, also politics in focus because Treasury Secretary Scott Bessent says he's not worried about the decline that's wiped out trillions of dollars from the stock market. Bessent spoke on NBC's Meet the Press on Sunday.
Corrections are healthy, they're normal. What's not healthy is straight up, that you get these euphoric markets. That's how you get a financial crisis. I'm not worried about the markets. Over the long term, if we put good tax policy in place, deregulation, and energy security, the markets will do great. We are going to have a transition, and we are not going to have a crisis.
All right, so Scott Bessent there assuring the market, but the market's not really assured, right? We've had a number of people cutting targets. Again this week, Lori Calvasina, who's going to join us shortly, has cut her target. And Mike Wilson, in a note I was reading over the weekend, says, you know, the pro-market policy coming out of the Trump administration isn't going to come out till later in the second half at the earliest. So they've really got to reassure us with something else first.
Well, that's the problem. Where's the bottom? Is it in April after we see the next wave of tariffs, or is it later this year after we see the brunt of that pain really come through? That's what no one can tell. And until that's kind of cleared up, it's hard to know how to buy the bottom, isn't it?
And the wealth effect may be hurting consumer sentiment. Take a look at the retail data that we had out across the last hour. Shanali and I were looking at the ECAN function, E-C-A-N Go, on your Bloomberg terminal, and just breaking it down into sectors over the last year. The auto sales have been a real problem. Click into that blue box there, and you can see this is auto sales and auto parts. They just continue to come down. So Mike McKee joins us here on set with his own look at the data. Mike, you've had a half hour now to look through it. What do you see?
Well, it's kind of interesting because this is the first hard data that we've had after a lot of soft data looked at rather negative for the economy. And the headline numbers, as you point out, not so good. Headline sales up just 0.2 after a drop of 1.2% last month. The control group, however, rises 1% after falling 8% the previous month. So basically, consumer spending flat for the last 2 months. The biggest moves were in food and drink, and clothing and department stores. They were down big. Non-store retailers up 2.4%. Now, Matt, you asked what I thought. Here's the thing. February, the weather was terrible, so maybe people were not going out to buy cars, going out to the car lots. We'll have to see how this month does. And we then saw the non-store retailers rise. People stayed home and bought stuff. Then we had a really bad Empire Manufacturing down 20 points, and then the prices paid the highest in 2 years. That sent short-end rates up, a little bit of an inflation scare there. But speaking of those hard data, the number that will probably matter today to people on Wall Street is the Atlanta Fed's GDP Now number. It's the first time it's been updated. It's going to be updated today with these latest figures. First time since they printed that negative 2.4% that got everybody so freaked out.
Yeah, I'm looking forward to seeing how the market really starts to react to that. Of course, a lot of data ahead this weekend, an FOMC decision. We're going to be seeing so much of you this week, Michael McKee. We thank you so much for your analysis. Also happening this week, we've been talking about it, NVIDIA's GPU Technology Conference. Shareholders are now hoping that CEO Jensen Huang's keynote speech Wednesday will boost optimism around the stock, which has been a bit of a bear this year so far. Let's discuss it more with Bloomberg Intelligence senior analyst Mandeep Singh. How high are expectations for this event?
Oh, I would say, you know, given it's a product-focused conference, you are going to see a new chip launch, a variation of Blackwell. And look, everyone still feels the market is undersupplied when it comes to GPUs. All the hyperscalers have raised their capex for this year. On the supply side, your TSMC and Micron have said they expect doubling of AI revenue. So all that, I think, is supportive of demand for NVIDIA. The only wild card is everyone is talking about the plateauing of pre-training and the fact that focus is shifting to reasoning and inference time compute.
That's a DeepSeek result.
That's the DeepSeek result. And that, to me, is the biggest sort of concern around NVIDIA as a stock, what it means for its growth rate, because in the end, this is a cyclical market. And everyone recognizes, you know, even though there's a long CapEx cycle and it's typically lumpy, there will be an air pocket sometime, and I think they will have to answer it.
It's interesting. You know, I learned so much about this at the conference that you and Anurag put on here a few months ago, and I talked to the CEO of Samba Nova at that conference, and they were making the same point pre-DeepSeek, right? Yeah. Not everybody needs to spend trillions of dollars to build their own large language model. It's the inference that counts. Are we seeing those stocks, though, do well now in the wake of that?
Well, so think of, you know, who is the biggest inference player out there? It's still NVIDIA. So that's the thing, right? NVIDIA dominates both the training side as well as the inferencing side. The question is, if everyone was building, you know, 100,000 GPU cluster and Grok did that, Meta is talking about, you know, acquiring a campus where they can put 200,000 GPUs together. That supports NVIDIA demands more than, you know, the inference side where you will have multiple data centers, but not the same scale. And that's the big difference is, are you going to see fragmented supply when it comes to the GPUs, or are you going to see bigger and bigger clusters? I mean, there were even talks about a 1 million GPU cluster.
Wow.
That is very supportive of NVIDIA
Have you
demand.
ever looked up yourself on Grok?
No, I haven't. I just like to say the word
morning.
Grok.
It'll make your morning. It's very kind to the people who are looking up some information.
I'll check it out.
Yeah, it's a nice ego boost. Anyways, you think about how much has sold off in the fray this year. One thing that Morgan Stanley points out is how much other companies can potentially benefit. Humanoid companies can benefit off the heels of this week. I want to pull out what we saw from Morgan Stanley's analysts who said that they believe the challenges facing Tesla's current business in particular are widely reported and well known, while the opportunities in the future business are potentially greatly underestimated. What role does NVIDIA play for the humanoids?
Absolutely. I mean, they've been very good about staying ahead in terms of the new markets that have come about. And I do think they will talk about humanoids as a growth market. Our view is, and we are holding another conference, the one that Matt was referring to on April 2nd, where we'll talk about humanoids as a potential addressable market. But look, you need a lot of precision when it comes to driving these humanoids using AI. AI still hallucinates. So the fact that, you know, you're talking about driving a humanoid with an AI model that can hallucinate, I don't think it's ready for prime time yet, but we'll find out more from Jensen when he gives his keynote at NVIDIA.
RoboCop. Have you seen RoboCop?
I have not seen RoboCop.
Awesome movie.
I'm more comfortable with like a humanoid vacuum than I am a humanoid car at this point, but
By the way, you
we'll
have
see.
a conference on April 2nd. I don't believe I've been invited
You
yet.
are invited, Matt. You will be hosting a couple of sessions for sure.
I hope so.
Things
I
in
hope
mind
so.
for you more than you realize.
Mandeep, thanks so much for joining us. Mandeep Singh there from Bloomberg Intelligence. Now let's get a quick check on what's going on in futures this morning. Take a look at the back and forth, the bouncing up and down that we've seen on the S&P. Right now, completely unchanged. So Mr. Market hasn't made up his mind yet. NASDAQ futures are up 0.1%. And I suspect that is on optimism for the GTC, right? GPU Technology Conference being held by NVIDIA. That's going to go on all week, so we could get news out of it at any moment. We're also watching defense stocks right now. Lockheed Martin could hit a choppy patch as Canada's U.S. trade tiff prompts a review of the F-35 fighter deal, right? It's agreed to buy 88 F-35 Lightning jets. And now, over the weekend, the defense minister said that Canada, as well as Portugal, they're going to look at maybe changing that contract around a little bit, which could be a concern.
Yeah, very interesting to watch what's going on there. But I also want to pull apart and look at some things that are happening in the consumer world as well. I'm looking at Affirm because they are moving lower because Walmart partnered with Klarna for buy now, pay later. Matt, this is an extraordinarily heated space. Affirm is not down as much as it was a little earlier, but it is still down more than 6% pre-market. You are seeing others also fluctuate off of different reasons. But Affirm, remember, has a market value of almost $15 billion. That is what Klarna is looking to seek in an IPO, trying to raise $1 billion. They're out talking to investors right now. It's another data point they can give them. The reason we're also looking at SoFi, of course, is they also are in now the lending business in a big way to consumers. They partnered with Wyndham this morning. It's all kind of very tied together when you think about these financing businesses. People are watching them very closely. Ally is actually down because of that auto sales figure that we were talking about a little earlier this morning.
Right. The headline, though, is Affirm gets replaced by Klarna. It's not just that Klarna partners up with Walmart, like, oh, they got a new JV. They're displacing Affirm, and that's a big move for the stock. Still ahead, RBC cuts its S&P 500 year-end target on growth risks. Lori Calvasina joins us at the desk in just a few minutes to talk about what's going on with her targets and if we could see a sustained bounce now. Plus, President Trump and Putin are set to discuss ending the war in Ukraine tomorrow. More on that next. This is Open Interest.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
What is the issue between the type of information that's being collected by investors and the marking issue that you're describing?
But what mark-to-market assets do is it forces honesty into the situation. We're talking right after the DeepSeek model surprised everybody in its efficiency. It took hundreds of billions off of market caps because it legitimately raised concerns that maybe the future of AI was different. I guarantee you that if you look at other portfolios that aren't marked, they didn't move. If private assets are going to eat the world, as they say, with the equity market halving in the number of names, you come to a world that is increasingly an echo chamber. Imagine you have a firm that has some public assets and some private assets. If you see your public assets in AI going down by 20%, you're going to be thinking very, very deeply about what your private assets are worth differently than someone who just has the latter.
Up to the minute economic news, whenever and wherever it happens. I'm Jennifer Zabasanja in Luanda, Angola, and this is Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Getting out of high interest, look at what's making headlines around the world. The OECD predicts the pace of global expansion will slow to 3.1% this year. The Paris-based club of 38 rich countries cut its outlook for global growth, pointing to trade barriers and uncertainty as the reason for the drag. The Kremlin has confirmed that Russian President Vladimir Putin is due to speak with President Trump tomorrow. The U.S. is pushing for a 30-day ceasefire in the war in Ukraine. Trump told reporters aboard Air Force One on Sunday, there's a very good chance for a deal. Those are his words. And the White House is defending its move to expel hundreds of alleged members of a Venezuelan gang to El Salvador for imprisonment. A federal judge ordered a halt to some of those deportations. White House Press Secretary Carolyn Leavitt said that the order does not conflict with the administration's actions. Sonali?
And Matt, we're going to look at some of the sectors that have been impacted by what is going on under the market today. We're looking deeper into chip stocks, of course. We're waiting for that big event from NVIDIA. Listening to CEO Jensen Huang on Wednesday, you were seeing NVIDIA on the move this morning prior to really anything happening with that event. Tesla, though, still down. We've been talking about it. Morgan Stanley seeing a potential for some change there. Our own Mandeep Singh at Bloomberg Intelligence sees a long way to go, though, in terms of gains for Tesla, in terms of humanoid activity based on what NVIDIA has got going on.
Yeah, and Baidu out with a new chatbot over the weekend called Ernie. Ernie X1 is apparently better at explaining its reasoning to users. We're looking at retailers and auto retailers, especially because of the retail sales number that came out. You had a little bit of a disappointment for auto sales, but here are the big retail movers pre-market. Walmart down right now, as well as Costco and Home Depot. Amazon putting up gains. I think really the defense sector is one of the most interesting to watch today because of that move by a Canadian minister that over the weekend joining Portugal and saying they're going to reevaluate their contract to buy F-35s. That affects a slew of companies from Lockheed Martin to Raytheon to Northrop Grumman. I mean, there's like 10 General Electric companies working on this project. So if they pull out of that.
I think that is interesting. You're talking about Canada making this move. The question of the push-pull between international countries here pulling into their defense spending while the U.S. has been talking about cutting down some of their defense spending is still an uncertain outcome here, I think, for a lot of these folks.
Yeah, absolutely. Let's get a quick check on futures ahead of the opening bell coming up in just 12 minutes time. We see little change in terms of S&P futures right now, down about 0.04% after that correction, and then a pretty sweet recovery on Friday. NASDAQ futures are gaining, but also very little change right now, so not a lot of movement ahead of the opening bell. When we come back, Lori Calvasina joins us, RBC Capital Markets head of U.S. Equity Strategy. She's cut her outlook. We'll ask her if she thinks we could see a sustained rally after this. This is Bloomberg.
Listen carefully. Can you hear the rhythm in the markets? Not just in the syncopations triggered by inflation, but in the preludes leading to global elections, in the dissonance that moves the Nikkei, and the rising course conducted by AI. There's music in the markets, and if you want to learn to listen for it, we'll show you how.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onim, only on Bloomberg.
Quick check on futures ahead of the opening bell. We just got about 9 minutes to go. S&P futures, NASDAQ futures, Russell futures, little change, but all showing red arrows at the moment. Let's talk about this with Lori Calvasina, RBC Capital Markets head of U.S. Equity Strategy. RBC, they just lowered their year-end target for the S&P 500 to 6,200 from 6,600. So, Lori, you're still, positive from here, right? You just don't think we're going to get as much bang as you previously had thought. Why is that?
So, this was honestly triggered last week. Our economic and rate strategy team updated their forecast, and this is something they do on a pretty regular cadence. But their GDP number went from 2% down to 1.6%, and that triggers a change on one of the models that we use to come up with the S&P forecast. So we have 5 different models. It's very quantitative. My clients joke I'm all about the math, less about the story. But one of those models, and we had signaled this as something we were struggling with in the year ahead outlook, that when you are in the 2 to 3% GDP range, and consensus has been around 2-3, our team was previously right at 2, it's a good environment for the stock market, right? And we all had this idea that the vibes were going to be strong and we had a more business-friendly political backdrop. But they took the number down to 1.6, and that's right in the middle of this kind of 1 to 2% range. That is a very tricky environment for the stock market. You're down more often than up, and your average gain is about, actually it's a decline of about minus 3.4%. So that was one of the changes that flowed through. There were also some changes to our valuation model, which is based on PCE, 10-year yields and Fed funds. And so we had to make some adjustments there. We also made some adjustments to our earnings number, which went from 271 to 264. And a lot of that was the GDP, as well as us reining in our own margin assumptions. So it kind of all fit together. And look, I'll tell you, Matt, that 6,200 is predicated on the idea that this is about the low, right? This sort of 10% type number. We're not going to get too much worse from that. My conviction in that is not huge. You know, we have to sort of watch the market in here. I see some things on the sentiment side that say this could be a bottom, but I see other things that say maybe we need to go more. So we're just going to have to watch the market a little bit in here.
Not to be a Debbie Downer on a Monday morning, but I think
you can be. The sentiment is very bad,
it's
right?
very bad, and I think privately people say worse things that they're saying publicly, right? So what is...
That would be a concern because they're saying very bad things publicly. Look at the AAII bullish bearish. Joe, you have that. Pull up the AAII chart and look how bearish the market is publicly, the street is publicly.
You know, I can't tell you
the worst since 2022.
How many people wish they said they sold when I was down in Miami for future proof this weekend. Those are RIAs. These are people managing other portfolio stocks. What is the downside risk?
So look, we've got this new table in the report, and we've been talking about this as a framework I've used for years, but we call it like the 4 tiers of fear. And I know that's a very sort of scary, you know, sort of label to put on it, but it has been coming up, right? When people have been saying, you know, what is this that we're dealing with? What does this look like? 5 to 10% is tier 1, garden variety pullback. We're in that, we're at the bottom. So what's the next tier of fear? I think it's what I call tier 2, the growth scares, which is a 14 to 20% drawdown. And that's, if that happens, that takes the S&P to sort of like a 4,900, 5,300 roughly. That idea is based on the post-GFC pre-COVID growth scares, which were all in that range. So 2010, 2011, 15, 16 industrial recession, and the 2018 trade war, which was under Trump's first term. That was a 20% drawdown peak to trough, and a 6% decline on the year. So that's kind of the next tier of fear. Otherwise, it's recession, 25 to 33%. Crisis, you lose 50% of the market value. I don't think we're in tier 3 or 4, but I do think the risks of tier 2 have significantly risen. And if we don't hold around this 10% mark, I think that's where we're going.
Well, and Shonali on our call this morning was talking about the damage that's been done technically, right? As we broke through 200-day moving averages on, I mean, every major U.S. index, right? And I think it's even worse for the Russell 2000, like down below its 200-week moving average. Yeah. What kind of value do you give to technical analysis, Lori?
So I think it's important the traders watch it. It informs sentiment. And you know, you go back to AAII, I have this whole list of things I look at when you're in really bad markets to gauge whether fear has gone too far. And we have to watch that kind of data because we are all subject to that same kind of fear. AAII is technically sending you a buy signal, right? It is so bad. It's actually at GFC lows as well. It does tend to get stuck there for a little while, but on a back test, 9 months later, we should be up about 10%. Things like CFTC, the weekly positioning data, that's early innings of declining. We only have that data through last Tuesday. We'll see where we are this coming Friday, but you've got things like that that need to catch down, and I think that's probably the sentiment you're picking up. I'll also tell you, Shonali, though, I was at a dinner last week, and, you know, I was talking to a bunch of people who wanted to buy the dip. So, you know, and still saying there was a Trump put, and I sort of joked, and I said, well, you know, we're not really going to bottom until nobody's saying there's a Trump put. Yeah. You know, so we're dealing with those kinds of dynamics.
Yeah, Lori, stick with us. Perhaps just as much of an issue as is there a Fed put anymore, as long as people are looking for a Fed and Trump put. That is Lori Calvasina of RBC. She is sticking with us, and we are less than 4 minutes to the opening bell. It's a tough open. It's a tough tape out there. Stick with us. We'll bring you everything you need to know at the market open. This is Bloomberg.
in recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern. Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We are seeing futures that are bouncing back and forth between gains and losses this morning. Right now, we're looking at all red arrows, but they're very slight, right? 0.07% down on S&P futures. The same is true on NASDAQ futures. Russell 2000 futures moving a little bit lower. And as we were talking about before, they've been hit the hardest in terms of technical damage. You hear the opening bell on the New York Stock Exchange. British American Tobacco and R.J. Reynolds celebrating 150 years of making smokes. They're the Camel guys there. Down on the NASDAQ market site, Yahoo Sports has some kind of March Madness like bracket challenge, but it doesn't matter because Bloomberg, we have our own bracket challenge. If you type in BRKT GO, then you can enter your own bracket on the Bloomberg and compete against the smartest minds on Wall Street. In terms of what's going on in the indexes right now, let's take a look at the live trade a few seconds after the kickoff. You can see things are settling lower. So S&P 500 as well as NASDAQ 100 futures down about 0.1%. I am telling you, wait this week to see what we get out of that NVIDIA conference, because any huge announcements by Jensen Huang could drive up the big tech stock, could drive up the Mag 7, and that would pull up, obviously, these two indexes with it. The Russell 2000 index, the small caps, lower quality stocks doing worse, right? Down 0.2%. We'll continue to keep an eye on that, but this is really where growth scare hurts. This is really where rates hurt, and I don't know how much they're going to be helped by a big AI conference. In terms of the stocks to watch, individual stocks, NVIDIA obviously is a huge focus, the second or third biggest stock in the world, depending on Microsoft's market cap. Right now, NVIDIA gaining, but only about 0.5% to 122.17. That conference this week really could be a catalyst, as Shonali was pointing out earlier, for Tesla. It could be a catalyst for Micron, the memory maker. It could be a catalyst for Baidu with their new chatbot, Ernie X1 out. So NVIDIA is one, Shonali, that we're watching very closely.
But I think the operative word of what you had there is could. This is such a market built on hope, and one place it could help, to your point here, is Tesla. It's now almost wiping out all of its gains from Friday. We have it down more than 3.6%, fluctuating a bit at the market open. Remember, Matt, what's fascinating, Tesla at $240 is about $20 below its one-year average. So analysts like those at Morgan Stanley are believing that what NVIDIA says about the humanoid potential of what it does in AI could impact Tesla. Could be a while until we see it, but of course, this is off its lows for a year, but meaningfully lower than its average.
Yeah, let's get back right now to Lori Calvasina to talk a little bit about the broader market, and maybe we can bring in some of those threads, right? We had retail sales that were kind of disappointing. We have hope for AI, but that's like a B2B play. Lori Calvasina from RBC Capital Markets. You have cut, as we were talking about, your target, but still 6,200, so still a ways up from here. What drives us there? Is the big tech play? Is the AI conference? Is, NVIDIA charging $1 million a chip? Is that going to help?
I think it's that we've simply got to get to the other side of this moment that we're stuck in right now. I think if we look back historically, when we have sort of these GDP blips in a given quarter, sometimes those lead to growth scares and sometimes they don't, right? And so I think it's really just kind of the relief on the other side. And, we're all talking about the retail sales data this morning. I haven't really had a chance to dig into it too deeply, but what I'm seeing based on how the headlines are fluctuating is that the market is trying to figure this out. And I think that's what it ultimately comes down to, right? Are we just going through a sentiment shock, or is this sentiment shock really creating some lasting damage with tails? And we just don't know that yet. We've got to get this hard data in and parse it and go through it, and we've got to get a little bit of duration on this hard data as well. I think, frankly, we need to reset earnings. I don't think people are going to trust anything I say on valuation until we get a sense that there's a little bit more certainty into earnings outlooks.
It's interesting, when you look at the sectors for the year, I think I'm just stunned by how much consumer discretionary has lagged the broader market. I get it, fine. A lot of that is things like Tesla and Amazon as well. But with retail sales the way they are and a lot more consumer sentiment data ahead, even if you have investors parsing even home sales now to see how the retail sector is doing, how much more pain is there and what does it mean for the broader market?
So look, I'll tell you, Shonali, two thoughts on that is I spent some time last week going through conference transcripts and earnings call transcripts of retailers and other consumer-related sectors across the Russell 3000. So not just the big cap companies, but the small cap companies. And I was stunned how many things seem to be hitting the consumer right now. It's not just tariffs and policy uncertainty, weather, fires, interest rates, inflation, the flu. I don't think that's gotten enough airtime in the media, just how nasty this flu season has been. What that means, though, is, it is going to take a lot to sort of repair that damage, right? There's a lot of different fronts that have to be attacked. I think the other thing, too, frankly, is if you look at the University of Michigan data, we're close to recession lows. And if you want to sort of back up a step and maybe look at small businesses, there's a little bit of a conundrum in that data because you've got sentiment and optimism and economic optimism that's been, kind of taken a hit, right, but is up around all-time highs. So it's telling you there's froth that needs to come out. But then uncertainty is almost back to peak. So which is it? Are people too scared or are people too optimistic? It's a really confusing moment for the consumer right now.
Speaking of the consumer, we are almost exactly 1 month from big bank earnings, the unofficial start to earnings season. And if the consumer is weakening, you have to wonder how that really rolls through into those first set of earnings results. Can you believe it? I'm already looking.
Shonali is already thinking about big bank earnings.
How could you not?
And I'm like, at least we have a month until big bank earnings.
I love them.
How are they going to do, Lori? If you have this kind of concern about the consumer, you have this much concern about, you mentioned small businesses, right?
Yeah.
The NFIB, commitment to expansion is very low.
Yeah.
So that can't be good.
Well, and their commitment to raise prices is moving up, right?
Yeah.
So you're seeing that. Look, I'll tell you, our financials conference, the bank sounded calm, cool, and collected. They acknowledged, I think, especially on day 2 of our conference, that there was a pause that they were seeing in terms of activity. I think, one of the gentlemen who presented said, we all just need to turn the news off. I know that's not good for you guys, but, just sort of speak into the idea, right, of the news flow and how that was impacting activity.
But remember when Jamie Dimon said, even bankers who didn't vote for Donald Trump are dancing in the streets right now? They're probably not dancing as much this year.
Well, certainly the M&A activity, right, has been depressed, and that directly relates to confidence. And if you even look at that Business Roundtable survey last week, right, I think the headlines were all, sort of it's resilient, but it went down a little bit versus the last quarter, and it's been in a pretty weak recovery off the lows. So I don't think anybody's dancing right now.
Lori, not to make this about bonds, but to the point that you're making earlier, you have a 2-year yield that was sustainably below 4%. pretty much for the last 2.5 weeks.
Yeah.
You are now well above 4% once again on that 2-year, and I'm wondering, at what point do these kind of sticky higher interest rates matter? You're already perhaps seeing it in the Russell 2000. Where else does it count?
So I've been more focused on the 10-year yield, and I know obviously, that's where a lot of the conversation has been happening, trying to take that yield lower. What I see on my data is that makes sense. I mean, it's really the thing that matters, frankly, more than the Fed funds rate. If I'm looking at interest expense, or if I'm, looking at or if I'm looking at debt levels over time, or effective interest rates that companies are paying. I will tell you, in my earnings forecast, I modeled in the 4.2% number that our team is highlighting for the end of the year, but they also have it going lower in the interim before coming back up, so that all flowed through into my model. So I have interest expense coming way down in that earnings calculation for this year, and that's helping my new number. Unfortunately, it's not offsetting the weaker GDP reads, it's not offsetting my more pessimistic margin assumptions, but it is helping.
Laurie, we thank you so much for setting the stage. Of course, it's a complicated market and a lot of negative sentiment out there, but we take a measured tone here.
I love it when Laurie goes on Nathan Hager's radio show in the morning before she comes on with us. So I get a little bit of a preview, and it makes things so great.
But we have now an outline of every tier of fear.
Tiers for fears.
Tiers for fear. We're gonna be keeping a close eye on those tiers. We also want to talk about some things moving under the radar, because Intel is on a tear, Matt. If you take a look at it, it is a very warm reception for the incoming CEO, Lip-Bu Tan. He has been signaling that he's going to stick with the plan for its foundry business to make chips for other companies. The market seems to like it. You are seeing Intel now up more than 5.7%. It was up more than 6% a little earlier.
Yeah, I think the market likes the idea that he's going to cut some jobs as well. So restructuring the company's approach to AI.
Hard for Ohio.
They haven't gone there quite yet, but you're right. It's a very difficult story for the great state of Ohio. At least we won the national championship in football. Coming up, we are taking a look at Apple as it looks to make seismic changes this fall. That story, a little bit of Mark Gurman's scoop in there. Next. This is Bloomberg. This is Open Interest.
People, I think, from Homeland Security and or the CIA or NSA have gone to Capitol Hill and said that TikTok is a danger to our national security. But the public hasn't been given that much detailed information about what the threat is. How much of a threat to our national security is TikTok?
The People's Republic of China acts adversely to the interests of the United States in different ways. One of those ways is through the dissemination of disinformation, the intentional communication of false statements, and TikTok is an extraordinary avenue through which to disseminate disinformation to millions and millions of people.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
This is Open Interest, and it's time now for our top calls. Some of the analyst action in focus this morning. First up, we're watching JP Morgan upgrading Norwegian Cruise Lines to overweight after the stock posted its biggest gains in a month on Friday. The Wall Street Journal says it's wave season for bookings. They need that boost. A lot of uncertainty around the cruise lines, up now 3.8%. Next up, we're watching DocuSign getting an upgrade from William Blair. The analyst is bullish on the new product cycle's ability to re-accelerate growth back to double digits. Also on the rise, we're watching DocuSign up almost 2.3%. And finally, we're watching MoffettNathanson raising Netflix to a buy from neutral. And the analyst is saying that the company's ability to better monetize is underappreciated. Netflix up 4.2%. I've been watching a lot of that lately, Matt.
What have you been watching on Netflix?
Everything. It's the way that I go to bed at night these days. But there is a lot of good content.
You watched
out
that
there.
basketball show, right? The Goldie
Oh my
Hawn.
God, Kate Hudson is killing it.
Yeah. All right, I got to check that out. Let's talk about Apple. The latest iPhone shaping up to be a foundational shift. This fall, the iPhone 17 is going to hit stores, and customers will notice a much slimmer phone without a charging port. It's a sea change for Apple, accompanied by the dramatic overhaul of iOS 19. We bring in Anurag Rana of Bloomberg Intelligence out of Chicago to talk about this. So Anurag, what do we know now about this? I guess it's an iPhone Air, very thin, and so you won't even have a charging port.
Yeah, I think we have to all thank Mark Gurman for a lot of good information on this. I read it with a lot of curiosity also when the article came out. The thing that really is remarkable is for the first time, I would say, in a long, in many years, you're seeing some hardware development that will probably make the phone a lot more cooler than what it is right now. It's it's a little bit of a utilitarian device because we haven't seen much changes in the form factor. The only one thing I would say is everything I read, I liked about it, except the fact that the camera is not going to be that big. I think that is one of the most important factors for any phone right now. So we know it's not going to be the Pro model. That's going to take a couple of years. I think that's where the bigger excitement is going to be on the Pro or the Pro Plus rather than just on the base level model.
I also want to point out here just how Apple has been doing on the year, because it's actually the second worst performer all year in the Magnificent Seven. It is down more than 14% on the year at a time where people are generally worried about consumer sentiment out there and worried about consumer credit. People forget you have to often borrow to take out an iPhone. Do they deserve that kind of a drawdown?
I think you will have to see that Apple hasn't done much on the top line for a long period of time. Last year, we saw a bunch of excitement because of AI features coming in. But frankly speaking, that has not led to any refresh cycle of the iPhone as some people were expecting. From our side, there are two major things that really need to happen or Apple needs to get over with. One is the fight that they have in the US about the App Store fee that they're charging. I think that is going to be one overhang. And the second overhang is the money that they get from Google. We do not know whether that big payment that they receive from Google, will they be able to still get that down the road because of regulatory reasons or not. I think those are the two overhangs that bother me more than, frankly speaking, the device or anything related to AI.
Anurag, we are watching closely the NVIDIA GTC this week. That's their GPU tech conference. And of course, the big focus is artificial intelligence. That seems to be what Apple has missed out on thus far. Are they going to be able to incorporate artificial intelligence in the new iPhone and the new slate of products this year? enough to encourage a super cycle of purchases?
See, the problem is the phone, costs so much that I really am always afraid of calling a super cycle on anything. But I do think that once you see these features being launched in China, for example, that's a big market for them. I think it can help them over there. They really are struggling in China right now. They've already said that they have seen, you could say, a better adoption of the phone in geographies where AI has been released. Where I think Apple has an advantage is they really do not need to go out and create the best large language model out there. They control the distribution of what I would arguably say one of the most rich franchises out there because of the iOS. So they can actually license those models from anybody. So I think once it's launched in China, it should help the phone sales. But I'm so away from calling it a super cycle.
All right, Anurag, thanks very much for joining us. Anurag Rana there of Bloomberg Intelligence, coming from the Windy City, doesn't want to call it a super cycle.
Myth or reality is what I want to know. I want all
You don't believe in the super cycle?
I am a show me woman.
Right. Well, but if it happens and we can show you, then you're a believer.
Yeah,
so
absolutely. Can always be turn into
I think we've seen them in the past, and we could see that happen again. But as Anurag points out, it's very expensive. In terms of 18 minutes into the trade, what's going on with the major averages? You can see green arrows now across the screen. The S&P 500 up 0.4%. The Nasdaq 100 gaining as well right now, and we're looking at a 1/3% gain. Russell 2000 shares doing twice as well as the rest of the indexes, the major indexes there. I'm looking to see who the biggest points gainers are, and Netflix is right up there, maybe because of the Goldie Hawn show. And Berkshire Hathaway.
Goldie Hawn's daughter.
Her daughter, Kate Hudson,
yes.
right? And Berkshire Hathaway, look, they have so much cash, right?
Yeah.
If there is somebody out there that could buy the dip in size, Warren Buffett has to be the man.
Right, and also if you have the 2-year rising to 4.05%, as we saw this morning, then cash feels good. I would also say, though, if you look under the hood of the S&P 500, the sectors that are gaining are quite defensive still. You have healthcare, energy, utilities, consumer staples, real estate. You're seeing green on the screen, but it doesn't scream confident.
Yeah, because the biggest losers are NVIDIA, right? Tesla, Amazon, Broadcom. So those big tech stocks that should be getting a boost from this GTC are not. Coming up, the OECD says Trump's aggressive trade policies have abruptly set the world onto a path of slower growth. More on that outlook and how Wall Street is coping. This is Open Interest.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bringing you the latest in tech and AI news whenever and wherever it happens. I'm Tom McKenzie in Paris, and this is Bloomberg.
While cyclicality has suffered domestically, cyclicality is alive and well in Europe. It's alive and well in Asia. The cyclicals in Europe continue to outperform. The cyclicals in Asia continue to outperform. So, kind of our big call this year was cyclicality isn't extinguished domestically. It's just migrating globally.
That's strategist partner Chris Verone on the show last week. We're going to talk also about how Wall Street strategists are coping with what's going on, because you're looking also now at all the gains that are being seen this morning. Very volatile. You're looking at the NASDAQ 100 that was up just a few moments ago, now erasing a lot of its gains. It's not quite at session lows on the day, but it is trying to regain that bid. Across Wall Street, you're looking at strategists trying to cope with this dynamic. Are we at the low? Are we not? And one of the biggest bulls on Wall Street, Ed Yardeni, is seeing some pressure under the surface. We're going to bring in Bloomberg's Michael Masika to talk more about what's going on. I was really struck over the weekend by Yardeni's note, because he said that he's calling it now the Trump thump. This idea that the best trade has been to short the S&P 500 since February, yet you're looking at a lot of investors now without even the firepower to go short. He says that they're not convinced that the correction is over despite the rally on Friday, and that there's extremely bearish sentiment readings, which tend to be bullish from a contrarian perspective, but he doesn't know if this time is true. So when you're looking across the street, Michael, ultimately, how many people are willing to dive into what has been extremely negative sentiment relative to what we've had in the past year?
Well, that's a good question. To be perfectly honest with you, it doesn't seem that the buy the dip moment that we expect has happened yet. There's been some deep buying. Some investors are looking